Good morning, everyone, and welcome to Traders Corner's Stocks and Options Special Online Trading Summit. On our panel today, we've handpicked 7 professional trading experts of the highest caliber who are all recognized as professional stocks or options traders and analysts. The good news, they've agreed to share their insights on today's market environment and also their most consistent and profitable trading strategies with us today in a free educational forum. So let's not waste any more time. Today's show is packed with great information. Our first presenter is a true expert on trading the markets. He was inducted into the Traders Hall of Fame in 2007. You've probably seen him on CNBC, Fox News, Bloomberg Television. He's the founder of BigTrends.com, which provides investors with specific real-time stock and option strategies and investment education to profit from significant market trends. Here to present how to trade same week options in 48 hours or less is Mr. Price Headley. Welcome back to Traders Corner, Price.
Oh, thank you so much, Rob. Great to be with you all, and excited to kick off what I know is a information-packed series of presentations today. So definitely, folks, you want to hang with it throughout because you're going to learn a lot here today. I want to focus you on what's probably been the hottest trend in the options market, which is very short-term options. You hear about the phrase 0 DTE, 0 days to expiration, kicked around. We're going to talk about how to trade same week options that are expiring by this Friday in 48 hours or less with this strategy I want to teach you about today. As we kick it off, and feel free to pop in any questions you want in the chat box, by the way. We'll seek to get them covered certainly by the end of the presentation. Just want to remind you as we get going that the information that I'm providing you in today's presentation is based on our proprietary research, and it's intended for illustrative purposes only. These should not be considered specific advisory recommendations here today. As you know, stock and options trading have large potential rewards, but also large potential risk. The past performance of any trading system or methodology is not necessarily indicative of future results. Do see our terms of use on our BigTrends.com homepage for more information in this regard. So what I want you to walk away from in my presentation to kick it off is 3 tactics for trading these same week options. First of all, you've got to pick when you're going to trade. So we choose certain days of the week. Only on those certain days will we enter a trade. So it means that you're trying to sort of pinpoint where's the sweet spot for really getting the increased leverage, and the fact that as you get closer to expiration, you have a decreased amount of time you have to pay for with that option. So we can take advantage of that. It's still definitely a more of a aggressive type of a trading strategy where we're looking for some pretty big targets, and then we have to give it a little bit of room so we don't get whipsawed, faked out on our stops. We're going to talk about stops and targets today. We're also going to talk about, we don't use just one indicator, but actually 2 different indicators signaling together at the same time, getting a fresh new entry signal. That's what gives us what we call double confirmation, that both indicators are saying, yes, we should be getting into that trade. It helps you to sort of avoid some of the fake outs and the whipsaws, and give you that increased confidence to be able to follow the system. And then the third point is using the proper stop and target ratio. So you have a favorable risk reward with a stop that's not too tight, but also can still preserve capital and help you still get out and move on if it's not working, and yet still have a much bigger profit potential when we hit our profit targets. We'll talk about all that. If you don't know me, I've been blessed to be trading stocks and options for over 33 years. I caught the trading bug while I was a student at Duke University. Upon graduating from Duke, I was an analyst and then head of research for the nation's largest options newsletter firm in the 1990s. And then in 1999 started BigTrends.com. So we're now on our 24 years, I guess, 24th year in business. It's launched in November of 1999. My thing when I launched Big Trends was that it's got to be based on data. There's got to be a trading system, quantitative edge to any trade that we make. We're not throwing stuff against the wall and hoping something sticks. It's about saying, look, we've got an edge. How do we extract that edge over a larger series of trades, which kind of also gets back to whatever you learn here today and go implement, take advantage of. It's start small and build. Trading is scalable, but you've got to prove it to yourself that it's working and it fits your own particular risk reward profile parameters too, so that you can stick with it through the ups and the downs of any trading method, right? Nothing's going to be perfect. So it's about managing losses as well as managing winners to get the most out of it. I've been blessed to serve many tens of thousands of clients all over the world over these 23 plus years of Big Trends. Why is today special? This is a fairly recent development in sharing this same week option strategy with the public, with the world, and of course our big trends community. And so we've not been talking about it for that long because this whole 0 days to expiration trend has led to some massive explosion in options volumes. And we've just tried to throttle it back a little bit to say, look, we don't have to be in and out on the same day. We're not day traders by nature. And so what I'm going to share with you is not a day trading strategy, even though we're holding it for no more than 48 hours. Okay, but it's about a next day trading strategy, pretty much. Okay, so we're going to walk you through how this works, and we're going to share with you how the 3 tactics have been doing, targeting 100% gains in these same week options. So if you can double your money, say thank you very much, book it, and move on to the next opportunity. Okay, so double your money in 48 hours or less. That's the goal. Doesn't always happen, but that's our upside target, and it happens with enough frequency that we can then manage the risk on the other trades and have a nice positive edge over a longer series of time. So let's talk about our first tactic. Some days are better than others to implement this final week strategy. And when we talk about final week, the idea is that, hey, every Friday is an expiration Friday for options that are weekly, for stocks that have weekly options, meaning every single Friday is an opportunity to set one of these trades up. We're going to talk a little more about weeklies here in a minute, but the idea is that we don't want to put these trades on at the beginning of the week where you've got, say, start on Monday morning, you basically have 5 trading days till that Friday's expiration. That's actually a little too much time to pay for in our experience, so we wait a little bit. We typically wait until Wednesday afternoon, or we could even put a trade on Thursday afternoon around 3 p.m. Eastern. That's 3 p.m. Wall Street time, about an hour before the market closes, with a trade that we've got to be out of by the next day's 4 o'clock close. So with a Thursday entry could be just 25 hours till it expires. That sounds kind of wild and crazy, but the idea is that we're taking advantage of very distinct patterns where the momentum is on your side over a large sample of trades. So, but Wednesday afternoon or Thursday afternoon are really our sweet spots for entry if we get the right setup and the right pattern. And using these weekly options is so powerful. This chart shows you, this is a prior month where you look at the Fridays, there were 5 Fridays in that month. In the old days, the 3rd Friday of the month, the weekly options, I did this strategy before weekly options even existed, in that 3rd Friday of the month ending on the 16th on this chart, because basically that was my last 5 days of opportunity for those monthly options. So it was an interesting thing to be able to then develop it so that every Friday is an expiration opportunity if the setup is right. My whole philosophy with weekly options is, why would you pay for more time than you really need? If we know we're not going to hold these trades more than 48 hours at most, why would I buy a month out? Why would you reduce your leverage that dramatically? We can customize it with every type of risk and reward profile you have. If you're conservative, you can do some different things. If you're aggressive, like in this strategy, we're just buying the option. You could create spreads and things like that, but here we're just buying a call, betting on the upside for a short window of a day or two, or we're buying a put, betting on the downside to take advantage of a downward projected move. As you pay less time, guess what that does to your leverage? It bumps up your leverage, right? And so instead of paying $2 for an option, if we could pay $1 for it, we're basically doubling our leverage by reducing our options costs. But we want to make sure that we've got something that's pretty close to the current price of the stock, give or take, so that therefore we can really get that leverage kicking in quickly as the stock makes an anticipated move in our direction. And if it doesn't, that we can get out reasonably quickly as well. So it's a technically driven, momentum driven system to take advantage of price action breakouts or breakdowns. That's really what we're after here. Now, why should you care? We call this a quick strike strategy. Try to hit in, hit out, usually in one afternoon, out the next day. And say, if you go back to our performance since the beginning of 2020, so we're talking about going back to just before the pandemic kicked in, right? And so this includes the downside that hit in the pandemic in March of 2020. It includes the snap back up into 2021, and it includes the bear market of last year. My staff is always so great. They updated this through today, so we're as current as we can be. And it shows that if you started with a $5,000 trading account and you put in no more than $1,000 into any one trade, we'll typically not have more than a trade and never more than 2 trades open at a time. but usually it's just one trade open at a time here. So you're saying, okay, look, $1,000 into a trade, you've got a cushion of $4,000 of cash starting out. And before commissions, so we don't include commissions here, but commissions have come down dramatically, so you still keep the vast majority of what you earn here. For subscription investment in our service, which we'll talk about with a very special, very low price starting offer to get you started here, taking advantage of these trades. We call it Lightning Options Trader. And the Lightning Options trades generated $16,467 in gross profit, adding up all winners and losers before commissions or subscription investment. So the beauty of this is that, okay, think about that. On a $5,000 account that goes to almost $21,500, that would be a 329% gross return. At, again, gross meaning that it's before adding up commissions or subscription investment, but the idea is that even those things are going to be relatively small comparatively, right? So that if you were buying an option quoted at, say, $100 per contract, you're putting $1,000, you get 10 contracts. And the game here is to say, look, we're looking to double these, take the money and move it back to cash once we double these options. We're going to talk about our stops as well. And you say, that was over a longer period of time. What about including the bear market? So when you factor in, if you just got started at the start of the bear market, the beginning of last year, 2022 start, till now, got a little bounce back this year, but still, it's still pretty choppy out there in the markets. A lot of worry and folks projecting big declines. We're saying you don't have to play that game anymore of worrying about what the market's going to do. When you're in and out of these trades in a day or no more than two, it's about finding those stocks. These are individual stocks here. You can see $5,000 account grew to $12,743 before commissions or subscription investment. That would be over 150% return in the last 16 months. So that's almost like averaging almost 9+% a month if you just divide that down 154 by 16. So you're saying regardless of market environment, regardless of bear market, still generating a very nice result. As we know, I've got to say this, past performance never guarantees future results. You know that future results are going to vary from the past. We're always looking to keep optimizing and getting the best out of our system signal. So, but the bottom line is that, you just got to make sure you don't overcommit your capital on any one trade. Start small. You can start with a lot less than $1,000, by the way, because a lot of these contracts are priced between $1 or $2, $100 or $200 to control 100 shares. So you could start with even a couple $100 a trade if you wanted to. So the idea is, okay, how are we getting in? This goes back to now the next tactic number 2, which is that one indicator is fine, but 2 indicators is better, right? Why not 3, 4, 5 indicators? We want to have simplicity, but still have a way to filter a lot of the noise. So when you require 2 indicators to signal at the same time, it's going to dramatically reduce your signals versus just one of those indicators, right? 2 of them having to hit together is sort of the best of the best in our experience. And so we like to use what's called oscillators. These are indicators that tend to cycle back and forth. You see the old sine wave, up, down, right? So you're looking for something that takes advantage of those quick overbought or quick overbought type of or oversold opportunities. But we do things in kind of a different way, as you're going to see here on our charts here in a minute. Getting twice the confirmation for us internally gives us twice the confidence, right? It's basically saying, look, we know we filtered out a lot of the noise. Now we're getting a fresh kind of double confirmed, both of them signaling at the same time opportunity. And now we want to fire the trade out with confidence and then use our stops and use our targets to let the edge play out over time. So let's talk about some of the success stories. We'll talk about an example of a winning trade on PNC, the bank stock on the downside. Banks have been getting creamed here lately, right? March with the Silicon Valley implosion. Now we're talking about First Republic's implosion this week. This is something where a trend in motion tends to stay in motion, right? We've been advising people not to bottom fish in the financials because there's just still too much stuff happening in a very fluid way that you've got to be able to take advantage of that. So our system was picking it up right at the start of March, a week before Silicon Valley collapsed. And what we're picking up here is that these 2 oscillators, and we look at a lot of different oscillators, right? But these 2 are 2 of our favorites to say they're both going oversold on that same bar. Now, you usually hear the word oversold and you think, should I sell it or buy it if I tell you it's oversold? Let me ask you, If I say the word oversold, what have you been trained by most textbooks and other educators to do when it's oversold? Sell or buy? Type it in the chat box. I want to see how many. I'm not going to name names. I just want to see how many people would say you should sell that versus buy that. Typical training. Yeah, most people say it's not a time to sell when it's oversold. It's a time to buy. That's what they think. But our data shows that for very short-term momentum, when something is just kicking into oversold, you do not want to buy it. Maybe you want to buy it coming out of oversold, but the idea is that just going into oversold is actually negative momentum. It's actually can get worse before, and tends to get worse before it gets better. So we're doing something that's kind of contrarian, that's kind of against the norm, but yet our data says this is where we have an edge. It's saying, guess what? Don't be too quick to buy. In fact, be ready to sell something when both of these together go oversold. And you could say, well, what about when they go overbought? Like this one went overbought back here on this one oscillator. We didn't buy it because this other one was not going overbought on its overbought threshold. So that filtered out what could have been a whipsaw signal. So both of them have to line up in the same direction, both going overbought for buy trades, for call trades, both going oversold at the same bar for bearish put trades. So when PNC gave us that signal, stock is trading just a hair above 155 here. Our rule is to buy the first strike price out of the money, typically on a Wednesday afternoon or a Thursday afternoon, betting it's going to go from slightly out of the money to even slightly in the money is where you get a huge bang for your buck. If you're an options pricing model follower, that's called gamma. And gamma, we're not going to get into the Greeks here, but gamma basically means you're picking up bang for your buck most quickly on a high gamma situation, which is basically meaning when it goes from slightly out of the money to somewhat in the money, that's where you get the best bang for your buck on your options purchases. So we're getting in at 155. The next day, you see what's happening? It traded here under 150. The banks were starting to collapse, right? Well, we sold out before that. What's our rule? We bought, think about this, when the stock's trading about 155 and a half, about a half point out of the money, we're buying the 155 puts. Remember, that's a right to sell the stock at 155. Theoretically, it's not worth anything if it stays above 155 into the expiration a couple trading days later, right? We got into this trade March 1st. The expiration of these first week options was going to be the end of the day, March 3rd. So just 49 hours later, and we get out, if we haven't hit our target or our stop, we always get out by 3 p.m. on the expiration day, an hour before those options would expire. So we guide you no matter what to target profits or stops or the time-based exit right before the expiration. We're sending real-time emails and real-time text alerts. So Ashik asks, any time of day, Wednesday or Thursday, we're focused on entries on right around 3 p.m., an hour before the Wall Street close on Wednesday and or Thursday of a given week. And we're looking across a variety of sectors, but really focusing on the blue chip stocks, trading them up and down. So PNC was a downside trade. This option got to be worth more than $5, but we sold it out when it hit its double target from $1.21 was our entry price. That means it would cost you $121 a contract. If you're putting in $1,000, that gets you 8 contracts for $968, right? You couldn't buy a ninth one, it would push you over 1,000. So, we cap it at that on our model portfolio tracking. But like I said, you could do this for as little as $121 on one contract to start. One of the great things about option commission rates is that they've come down dramatically to $1 or less a contract getting in and $1 or less getting out, but you don't pay a minimum ticket charge anymore. In the old days, when I started trading options in 1990, I remember ticket charges of between $30 and $50, even if you were trading one contract. That would eat up too much of your profits, right? So you see here now, you're not having to worry about that anymore. So we sold it out at that double target, $2.45. Where was the stock trading roughly? It would have to be trading at least down from 155 to around 153, maybe heading towards 152.5, which is 2.5 points intrinsic value, right? So there'd be a little time value still in that option too, because it wasn't expiring until the next day. We cashed out on the 2nd, but the expiration was on the 3rd. But the point is that, okay, and by the time it closed on the 3rd, it was back around 152.5, 153. So it finished about in that same level. Sometimes though, you see it reverse your profits if you hold on and hope, right? We don't want to hold and hope. We want to be proactive and take advantage of doubles, and then we're going to tie in our stop element here in just a little bit. Okay, but let's look at a couple more examples. But you see how oversold And it's generally, especially with this bottom oscillator here in black, you can see it's pretty much stayed oversold with a couple of retracement points where it stopped the entire way down there in that March look back, right? So the point is that do not buy into the conventional wisdom that oversold is a buying opportunity, and look to do some things a little bit differently. You'll be, I think, well rewarded over time. Now, there's a lot more where that came from. Here's another quick bearish pop that we had on Best Buy, BBY, the electronics retailer. So you see Best Buy, both of them signaling together here on the same bars cross under into oversold territory. You see there's other times where it looks like, okay, this one crossed below, but then this one was already below that line for the prior few bars, right? So it's got to be fresh on both of them on the same exact day. These are daily charts. These are pulled out of TradeStation, but you don't have to have any certain software platform as long as you can execute your option trades. So, and by the way, Carlos, great to see you, a longtime Big Trends client, asking about indicators, what they are. When you sign up, you get all that information. And then you as a longtime platinum client, call us 800 Big Trends if you have more information. We'll be happy to guide you through that, Carlos. But the idea is that, what we're after here is freshness. So one is not enough, and both of them being under there doesn't necessarily signal it if they didn't both cross under there on the same exact point of day. The reason we wait till 3 p.m. is not just to take advantage of getting that extra leverage for not having to pay too much for the options on a Wednesday afternoon or a Thursday afternoon. It's also knowing that at 3 p.m., we should be pretty close to what the daily end of day read is going to be in an hour, right? Unless we got just some massive reversal in the final hour of trading. And if we're seeing a reversal while we're getting it ready to send out at 3 p.m., we might wait a few minutes. So it might not come out until 3:15 or even sometimes maybe even 3:30. But 3 p.m. is kind of our target area to get these trades out, and typically get at least one trade out a week, sometimes two. But the idea is that, we're looking for the best of the best kind of fresh signals. Now you see this one did not last long. I admit it. Stocks trading just a hair above 71. We buy the 71 strike puts that are going to expire 2 days later. They're bought on August 31st last year. The expiration's coming up September 2nd, right before the Labor Day weekend. And you can see that it was just that quick window down from 71 down to about 69 that allowed us that next morning, when it opened a little lower and then traded lower that morning, to take that profit off the table at the 100%. This is why you take the bird in the hand of the 100% and don't try to hold and hope for more, because there's too many examples where by the expiration close, we were back above 71. And if you held it to expiration, you'd be talking about 100% risk, 100% wipeout. That's not acceptable to us, right? We want to make sure we can manage that risk. We're going to talk about stops. The really interesting thing, so I don't care if it keeps going down like PNC did, or if it has a big reversal later like Best Buy did here, back to the upside. You say, oh, that wasn't a great call. Well, it was for that next day, for that next morning, to book that profit. We took the 100.9% gain. We bought it at $1.07, sold it at $2.15. So you can see what your price points are in the entries on these options. They're pretty reasonably priced options. $107 a contract. So you don't have to have a ton of capital to get started. You can start small and then scale up. So Salvatore asks, is there ever risk of being assigned or obligated to either buy or sell the shares? No, you don't have that problem here, because we're talking about an option that has plenty of time value, even with a day to go or even sometimes hours to go, when it's right near the strike price. So only when it goes deep in the money do you have that exercise risk, or if you ride it all the way to the expiration close and it's in the money, then you could get assigned or exercise. We're not ever riding it to that expiration close. We'll always be out by 3 p.m. on expiration day at the absolute latest. And our team's always standing by at our 800 Big Trends line if you've got questions, if you missed an email or a text alert or something, or afraid you missed one. We've got real bodies standing by, not a lot of voicemails. It's like, no, we've got people that can help answer your questions as a paid subscriber. The interesting thing about this, you would think in 2022 we would make our money on the downside in a bear market, but actually 51% of the trades were calls, 49% of the trades were puts. It was almost an even split across all those trades last year. So it just shows you that I'm not worried about the market. I'm worried about getting on the best of the best momentum moves on individual stocks up and down. That balanced approach is frankly what makes this strategy not just exciting, but actually Salvatore mentioned he wants to be able to sleep well at night, right? I do too. I want all of you to sleep well at night. And the ways you sleep well at night are knowing you have a balanced approach like this that doesn't care about the market, just cares about individual stock momentum, and that you're not overcommitting your capital in any one trade. You're taking a very steady, balanced approach to capital allocation, and you're seeking to build your wealth over time. It's not a get-rich-quick strategy. It's a build wealth over time. Sure, we're using a quick entry and exit parameter, but you've got to take the approach that I want to be in this game for the long haul. I've been in this game for over 33 years, and I attribute a lot of that to that I care about risk management as much or more than I care about how I manage profits. The profits tend to take care of themselves, but controlling your risk is what keeps you in the game for the long haul, right? So we're going to talk about stops. We're also going to continue to reinforce that start small and have consistent capital allocated to every trade. If you say I'm going to put in $500 a trade, then do that. If it's a $1 option like Apache was here, that would get you 5 contracts. If it happened to be a $5 option, that would get you 1 contract. I wouldn't tell you to buy 5 contracts every time. That would overweight the higher dollar names. I'm saying put the same amount of capital in at risk on each trade. That'll keep you more consistent in following your system. Okay, so Apache, energy-related name, APA is the symbol. This actually came out on a Thursday afternoon, November the 3rd, and our expiration was the next afternoon, November 4th at 4 p.m. So we have basically 25 hours to go before the options expire. But you see, it has this big reversal up. Where both of our oscillators are going to the overbought territory together. Notice where it's closing here, right around 47 bucks. We're buying the 47 strike call, basically at the money in this case, and we're paying $1. And you say, man, you're paying $1 for a 47 call. That means at expiration the next afternoon, it has to have hit 48 to break even. That would steer a lot of people away from making that trade. But our system said that we had a more than expected opportunity to go past 48 to 49 or higher, right? Because if we go to 49 and you own a strike price of 47, that's a right to buy the stock at 47. What's it worth at 49? $2, right? That's your double. So you see, it didn't just go to 49 the next day. Intraday, it actually went to 50 here. We could have gone from $1 to $3, right? We don't play the woulda, coulda, shoulda game. We say 100% profits are more than sufficient to take on the whole position. We don't take partials in this strategy. We say take the double and run, because it's going to factor in against how we manage our stops. Say, how do we get there over time? Caesars, CZR, another gaming stock, right? Most people think of Wynn Resorts or Las Vegas Sands, but Caesars has been another great trader for us. Another one that caught a double. And you can see a lot of times with this strategy, we are not early. We're not going to try to buy the exact low. We're actually saying, look, we're playing the extension game of the momentum is now kicked up for Caesars into that close. Stock's trading right around 50 bucks, right? Because we're buying the 50 strike calls. And you can see here that we're buying the 50 strike calls and we're paying $1.40. Okay. Now notice again, this is a Thursday afternoon entry. That $1.40 needs to go to 280. That means the 50 call has to go to $52. Stock's got to go to 52.80, and it actually went just above 53 that next day. It's 52.80 intrinsically, it's got to be worth 280, and maybe at 52.5 or so, still had some time value. So it doesn't have to get to that total intrinsic value calculation, but you can see how these do get there in a number of cases, and then we take our double, and then we're done with the trade. So whatever happens after that, it's kind of, we don't care. Basically, it's just, there's, in every trading strategy you do, there should be a window of time that you have an opportunity. And when that window of time, your sweet spot, as I call it, is up, you should be, the window closes, the door closes, you should be out of the trade, win, lose, or draw. Don't put yourself in that position of holding and hoping. Tons of winning trade examples, but we've got a lot of other examples where, it doesn't always hit its profit target. So here's an example of Pepsi. You think Pepsi, why are you trading options on Pepsi? Why not a tech stock? Well, Pepsi, is going to have less volatility. It's going to actually, when you get in a good trend, you can actually probably get more bang on a lot of non-tech stocks. You see, I focus on a lot of names outside of tech here today, but we'll have some techs in there as well. But the idea is that, look, this is Pepsi getting in on a Thursday. We have the next day. We're trading the downside in this case. So let's look at the chart. There's our fresh cross under on not one, but both oscillators together. And again, you'll get all these with the settings and be able to follow along at home once you get signed up. But the idea is that, look, 2 oscillators better than 1. Stock trading here right around that 177.5 level. We're paying $1.88 for this option, the at the money put. So you're saying, well, gee, it's got to go down almost $2 to get me my target. Well, in this one, that means it's got to go about almost to what, $3.75 or so, which means it's got to go down to about what, 173 3/4. That doesn't happen here. It gets to maybe about 174.5 and then starts to pop back up. So our rule is that, okay, it's the next day is the expiration at 3 o'clock. We're saying the 1 hour till expiration rule has kicked in, and we're now selling this at what's $3.02, right around that 174.5 level on the stock, and saying we're taking a 60% gain. 60.6% was our gain on that trade. Some of those trades will be losses, some of them will be winners if they don't hit their profit target or their stop, right? But the idea is that we're cleaning it up always an hour before. So like Salvatore worried about expiration, do I get assigned if it's in the money? If you do nothing, you would, but we don't. We never take a passive approach. We always tell you an hour before the expiration, here's your price level to get out of that trade, take the money and run, okay? So you never have to worry about that exercise or assignment type of a risk with this strategy. Not every trade is going to be a winner. Here's an example of a trade that hit our stop level. Our stop level is minus 50%. That doesn't mean that it couldn't be a little worse, right? If it really gapped against us, it could be theoretically a total loss. You always have that possibility. It's rarely happened to us, but it's a possibility. So that's why you don't overcommit your capital. This was on semiconductor, ticker ON. Looked like a great breakout. You see, this is a fresh start to this trade here. And you see that we're getting into that trade when the stock is trading. In this case, it was slightly in the money. It was a 76-ish price level. We paid $1.50. $1.53 officially was our average entry price. We track the fill prices in the short time after we send out our alerts to say, okay, did people get a chance to get into that trade? If they don't, we wouldn't track that trade as a valid trade. But most all the time, unless it just completely runs away as we're sending it out, we're going to get filled and be able to take advantage of it. We try to give you a little bit of room too to make sure you get filled and get into that trade, because we know there's plenty of opportunity in these trades usually. But if something doesn't work, it's giving you feedback, right? We've got a 75 call. It opens a little bit lower and keeps going down. And as it crosses under 75 intraday, we didn't wait to the end of the day where it finishes at 72, right? As it's crossing from in the money to just slightly out of the money, that's where actually we're saying sayonara to that trade intraday the next morning and lose about 53%, 52.94% officially was our loss. So think about that. If we got in at $1.53, we're getting out around 75 or so cents. So you say, well, 75 cents, why not just hold it and see what happens? Well, if you do that and you're passive, you're looking at a wipeout at the end of the day when the options expire that next day. So the point is that don't be passive. It's an important lesson to say, have a plan for not just how you manage your winners, but how you manage your stops. And you think, well, 100% win, 50% loss, that seems like some pretty wide ranges. And I even have some subscribers say, I didn't get my 100% gain. I took a 30% gain or a 50% gain before it got there. And I'm like, don't do that, because that's going to mess up your risk reward, right? Some other people will say, oh, I didn't use a 50% stop, I used a 25% stop. That will get you whipsawed out of a lot of trades that turn out to be winners if you have too tight of a stop also, right? So follow the parameters, and just, if you're worried about risk, just trade less contracts, right? So if you trade one contract at $100 in, you lose 50%, you're off $50. You know, if you can't handle that, you probably shouldn't be doing this strategy. Okay, so keep that in mind as it relates to what fits your own risk and reward parameters. But you can cut contract size to help you manage dollars at risk. Okay, so tactic number 3, this favorable risk reward ratio. So like I said, 50% minus 50% on the stop, plus 100% on the target. It doesn't take that many doubles to see your gains start stacking up when you've got a reasonable stop loss plan. This strategy, you can see, had 31 profits that made 100% or more. Sometimes we get big outlier gaps in our favor, right? Looking back over the last couple of years. And in fact, let's talk about one that was probably one of our best outliers. It's not going to happen like this very often. If you get one of these a year, though, it's like, well, you know, get a big gap in your favor. That can make up for a variety of other trades, right? This is one on First Solar last year. that had one of these really massive moves the next morning. And by the way, this was not earnings. We never trade this right in front of earnings. We don't want to pay for that kind of volatility. This one, though, I believe our system was picking up something that was brewing. In this case, you see the crossover on both oscillators into the overbought territory, the top 20% of their potential readings. You see here that First Solar's trading in the neighborhood of about 77 bucks. We were buying the 77 strike calls with 2 days to go before expiration, paid just under 2.5. So if you put $2.49 was our average entry price, if you're putting $1,000 in, how many contracts that gets you? 4 contracts, right? Gets you in a total of 996 bucks on 4 contracts. And so you say, okay, look, I get into 4 contracts here for just about $1,000. A 77 call. There was news that night that in Washington D.C. they just passed a new energy bill pushing more renewable energy, and solar was a beneficiary of that. So First Solar goes from 77 the prior day's close and opens the next morning right around 90. Trades up into 90 bucks here. So it's gone up, almost 20% on the stock. And what's our option worth? A 77 call up at about 89.5 is worth 12.5 bucks. So we're cashing this out for about a 5-bagger, a 407% profit the next morning. Okay, you say, well, gee, if you'd held one more day, it could have gone up even more. And I don't care, right? 400. If you get a windfall profit like that, you should be booking the profit and then asking questions later once you're out. You should not be playing games, holding and hoping, and watching that thing get eroded. I see it happen all the time on earnings reports and other things where people think it's good news, then it has a big reversal after that gap. Sometimes they keep going, but sometimes they have big reversals, right? So we take the bird in the hand approach with this lightning options trader strategy. So that was an outlier. It's not going to happen very often, but even just once in a blue moon, that happens, and that covers you. That's like getting the equivalent of like several other doublers to go. If you're making $1,000 a trade, $1,000 a trade, and then you just turned 1,000 into 5,000. That's it's like getting 4 doublers on just one trade. So you say, okay, in this kind of a case, let's recap. What's the strategy? We only want to get in Wednesday afternoon or Thursday afternoon, because that way we're near the close. We know that we're getting that not one but both double confirmation of indicators, both going overbought for calls, both going oversold for puts. Again, if you came in late, we do overbought and oversold in a different way. I know that the Traders Corner people are recording this, so you can go back and watch the recording if you came in late. But the idea here is that then set up your risk reward so that we can win twice as big as we lose. If we're going to lose 50%, we want to be able to double when we're hitting our winners, so that way, think about it. If you put $1,000 in, you double it, you make $1,000 profit. Put a next trade, put $1,000 in, you lose 50%, you lose $500. If I could make 1,000, lose 500, make 1,000, lose 500, if that was my pattern, that's going to average about a $500 gain over 2 trades, or an average gain per trade of $250 every time I place a trade, if it's happening with that consistency. We know that the reality is going to be a little bit more variability. We can't guarantee what any streak looks like, but it's about taking advantage of the trading edge consistently over time. So, and again, if you came in late, a reminder of the 3-year performance, just over 3 years from the start of 2020 to today. A $5,000 account would have grown to almost 21,500. Gross profits adding up all gains and losses of every trade we called out, before commissions, before subscription investment. Okay, so you say, okay, that would have resulted in a more than 300% profit before those commissions and subscription investment over 3 1/3 years. Okay, so as you see, we've been able to find these signals regularly, usually an average of about a trade a week, or about 4, maybe 5 trades in a month. So we're not hyper trading, we're just picking the best of the best opportunities. You say, well, how can you start taking advantage of this? What we set up for you is a special Traders Corner package where you can actually lock in a very good starting access to Lightning Options Trader. A lot of times I'll only sell a year because it's been so popular, but I'm going to give you a chance to try it out for the next 3 months at a reduced rate versus what my typical month-to-month pricing is for this service. So what we're going to give you too when you get signed up for the next 3 months of trade alerts. And by the way, we always tell you not just when to get in, but when to get out on every trade. Win, lose, or draw. We never hide anything. We never, bury anything. It's like, look, if it's a loser, it's a loser. This is what you do. Get rid of it. Move on to the next trade. You'll get that kind of clarity from us on every trade that we call out all the way through, guiding you through, never leaving you hanging. But you also get the settings and rule sheet. I couldn't give away those settings and the indicators here for free, but I can tell you that when you get signed up at this incredible low starting price point here, you'll get that settings and rule sheet so you can follow along at home. Again, we're calling out the trades for you, so you don't have to do any work. You don't have to screen watch. It's all about just really focusing on being ready for those trade alerts at that very specific time window on a Wednesday afternoon or a Thursday afternoon. I do a weekly video update where I talk about my lightning option trades from the past week and talk about, okay, what worked, what didn't, what did we learn from that, how's our results shaping up, and what we're expecting for the markets in the week ahead. And then you get dedicated access, even with this starter price point, to me and my analyst team whenever you've got a question about your lightning options trades that have been called out. And so when you add all this up, it works out to be $891 of value for this 3-month package. That's our regular monthly price at $297 over multiplier of 3 months. You're going to get it for a lot less. You can get all of that, the 3 months with the 3 resources. Actually, you should really bump it up to even more when you add in the access to me and my analyst team. But I'm going to give it to you today for a special one-time starter price point of just $177. It works out on average to less than $60 a month, right? For that kind of that's like less than $2 a day when you add up the kind of value you're getting and the access to me and my team when you go to this very special link here. So I'll pop it in the chat box real quick here. It's members.bigtrends.com/LOT3. LOT for Lightning Options Trader, and then the 3-month special. So, but remember, it's not a www page. It's a members.bigtrends.com. We want you thinking as a member and taking advantage of this, and you get a members access where you can log in and see past alerts, past commentary, past weekly market reviews. So you'll get a lot of educational resources to go with the trade call out. So go to members.bigtrends.com/LO23. When you do that, here's what it looks like. It's really simple, right? I'm a big believer in the KISS principle. Keep it simple, right? You don't want to make, Einstein talked about, don't make things as simple as possible, but no simpler than they need to be, but basically reduce complexity wherever you can, even for a genius like Einstein, right? We want to boost your trading IQ by focusing you on how do you get started. We've already taken, there's no other promo codes to add because we've already taken it down substantially, right? From basically over $1,000 of value down to under $200, $177. It's a one-time investment. There's no future billings. It's basically try it out for the next 3 months, and in 3 months, we think you're going to come back to us wanting a lot more. You might be interested in adding our quick options boot camp. That's usually a $295 cost. I'm throwing that in, and when you want to add it to your order here, you can add it for $77. So it would take it from $177 to $254, and you get the lifetime access to the boot camp as well. But if you don't want that, you can just go and get the alerts, and then you'll still get the week-to-week updates from us as well. We take PayPal as well as the major credit cards, and so that's what it's about. So after 3 months, Salvatore, you can just contact us, and we'll certainly make it worth your while to allow you to really continue to enjoy Lightning Options Trader and the benefits that it can generate. If you forgot about the benefits, or if you came in late, just a quick reminder that yeah, we do text alerts, Peter, so you can get the text alerts from us as well as the emails. So yeah, it's typically an SMS, or I think there's a WhatsApp option for international clients as well. But bottom line is that, yeah, you can take advantage of basically instantaneous alerts. Whenever we fire something out, boom, you get it on your text as well as on your email account. So that's all included as part of that fee. Just make sure you have unlimited texting so that you're not worried about getting too many texts when we need to update a position. So we'll guide you every step of the way, though. You can see the long-term was tremendous, and then even since the bear market started in 2022, it still had a very effective equity curve. So just a last reminder here, I know I'm about out of time here. Go to that special link, get all the resources to go with the 3 months, next 90 days of trade alerts when you go to members.bigtrends.com/LOT3. And if you've got questions, make a note of that special page. When you've got questions, Remember, you can reach us at our toll-free 800 Big Trends number. That's 800-244-8736, or email us, clientcare@bigtrends.com. I want to thank Rob and Marie and all the team at Traders Corner for having us. And I know we've got a lot of great speakers to come, so I'll hand it back over and look forward to seeing a bunch of you on the Lightning Options Trader to take advantage of our next trades as early as 3 p.m. today. Thanks so much, Rob.
Thanks so much, Price. I love trading those same week options, and in this market environment, holding for 48 hours or less is a great plan, because with the volatility, it's really not equipped for swing trading as much anymore. Your technical analyst is always spot on, and we love having you on the show. Do you mind me sharing a 2 cents that reinforces your method?
I appreciate it. Thank you, Rob.
There was another presenter that talked about how when buying in an oversold market, if it was still continuing to oversell. So we talked about not doing it as well and looking for a stock that failed to get overbought or oversold and going the other way on it, which absolutely reinforces what you're doing as well. And I thought it was genius. I had never thought of that before.
Yeah, it's important to have that unconventional wisdom, that edge that maybe other people are doing things wrong, and how can you take advantage of that? So this gives you that opportunity to do things a little unconventionally, but actually have that advantage in your favor.
No, absolutely. And, I appreciate, the discount you gave out, the special offer. And realistically, if you boil it down to $63, that's less than the price of a losing trade.
Exactly. Thank you, Rob.
Ladies and gentlemen, Chase pasted a link to his website in. You can find him at www.bigtrends.com. Thanks again so much, Price. We hope to have you back on Traders Corner. Ladies and gentlemen, Mr. Price Headley of Big Trends, a certified market, Hall of Famer.
Oh, thank you, Rob. You have a good one.
Likewise. Well, we have a great show today, and we're going to keep the ball rolling and moving right along to our next presenter, who you may have seen on Fox News, Fox Business Network, RT America, Cheddar TV, and CBS News. She is an expert stock market analyst and founder and owner of an international education company where she teaches people how to successfully trade the stock market. Her trading methodology is one based on a strategy called Golden Gaps, which pinpoints institutional money in the stock market. Here to present, make fast profits trading 30 minutes a day, is Miss Melissa Armo of the stock Swoosh. Welcome back to Traders Corner, Melissa.
Good afternoon. Can you hear me?
I can hear you. You sound a little far away, though.
Let me move my mic closer. Can you hear me now?
Much, much better.
I had it too far away from my pile of papers on my desk. So
mine probably looks similar, if not worse.
Well, thanks for having me. Welcome, everyone, and good afternoon. What a lovely day here, and definitely an interesting time to trade. So, just going right into the segment from the previous guest, we was talking about doing fast trades. Really, in this type of environment where the market is in a very, very tight range, which it's been really for the last 16, 17 days, but really almost since last fall, the market's been in a range. It's just widened and closed off even more recently. The best way to make money is to get in and out of trades fast. So again, the longer you're in a trade, the more that you're at risk. At risk for what? For the possibility of a positive trade turning into a not a positive trade where you're break even, or it could even turn into a loss, or a trade that you're up in and you think is going to work then turns against you. So we're in a very, very, very interesting time where the market is hanging on by a thread based on every single solitary thing that the Fed says. So next week, the Fed is a meeting, and they're probably going to increase interest rates. Even though people think this is the wrong thing to do, they're probably going to bump up rates another quarter point in May. And so how will the market react to that? Well, it's going to be just more than them raising rates or not raising rates. It's going to be really listening to every single solitary word that Jerome Powell says. Are they going to continue raising rates? Are they going to back off towards the end of the year? So it's an interesting time to trade. For me, what I do, though, I focus on stocks that gap, and we're going to talk about some examples here today. If you have any questions, you can plop them in the room. I can see them as we go along. And because I do gaps, I'm looking to trade basically the first 30 minutes of the day into the open, in and out between 9:30 and 10 a.m. Eastern time. If you have any questions for me, you can email me at melissa@thestockswoosh.com. You can follow me on Twitter, Facebook, YouTube, Skype. And I try to always put any TV hits or showing where I'm going to be on Skype. I was just on recently on Newsmax talking about the banks that are falling apart, some of the banks that collapse. And of course, there's First Republic now is in danger of collapsing, and that stock has absolutely tanked in the last couple of days if you've been watching that as well. And sometimes it's dangerous to trade stocks like that because it was halted several times. I think it was about 2 days ago it was halted, and you've got to be careful. I'd say stay away from things that are that volatile. Well, I love to trade volatility. You want to trade something where you can make sure that you can get in and get out. And when stocks get halted, that can be very dangerous. But again, another telltale sign of showing what's really going on in this market. And you say, well, what can you really do to make money? Long-term investing, while many people are interested in it, and it's paid off, so particularly in years like 2021, where the market was extremely bullish, and really after the 2020 election, where the market rallied even after COVID. The fact is, though, that times are different now. If you're looking for retirement and long-term investing, that's not what active trading is. Active trading is you are in and out quick, you are chunking it out, and you are trying to make money as fast as you can in booking it. It could be $100 a day, it could be $500 a day, it could be $1,000 a day. It depends what type of stocks that you're trading, and it also depends on the size of your account and your risk. So I put in here so far this year, I forgot to add in last week's, but this is year to date through the 14th. Of our stats for the day trades in the live room. This is with an average risk of $2,800 per trade. And again, I run a live trading room where I call the trades, the entry, the stop, and the exit. We're on pace this year. Again, this doesn't include the last week to make quite a bit of money this year with a risk of a little bit under $3,000 per trade. Now, these are all trades on margin. Most of them are shorts. I'm mostly short, which we'll talk about today. Some of them are longs, but again, I prefer to short. So we're going to talk a lot today about shorting. And the reason I like to short over going long is because, again, I like to do the fast trades, and panic comes in fast. Stocks sell off faster than they rally, okay? So we're up 185,435 for the year so far in the day trades, and we're just moving forward, and we're going to just keep chugging along here. You know, the thing is that we're 4 months into the year. Next week is May. Actually, Monday is May 1st. And if you're not on target for the year, or if you don't even have a plan of action for what you're going to do for 2023, or if you're behind, you're actually behind on your monetary goals for the year, then you have to kind of take a step back and regroup, okay? So the best thing that you can do for yourself is say, okay, can I really make money in the market? What is my belief system? Because a lot of times people have a negative belief system and they keep trading and they keep risking money in the market, but they really don't believe that they can make it. They actually think the market's rigged, okay? The reality is that the market isn't rigged against you. There are big players in the market that have a lot of money, and they control the market and they control stocks. If you learn how to trade with them, you will be successful, because fighting them is a losing battle. So the fact is you can make real money in the market. I'm doing it. I'm teaching people to do it now for 10 years going on 11. But if your mentality, really if your mindset is such that you don't believe it, you're working against yourself. You're working against yourself, and so is everyone else in the market. Because when you go into a stock and you take a trade, you're trying to take money away from somebody else. So you already have people out to get you the second you take a trade every single day. Because if you're shorting something, somebody else is going long. And you want to make sure you're in the right direction. So assess and look at yourself in the mirror, your real belief system about making money in the market and being successful. I always believed that I could be successful doing this. Even though when I started trading in 2008, I was not successful. It took me 3 years to figure out my system, but I always believed that I would be successful. And it really didn't make any sense to me why I couldn't figure this out in 2 months, 3 months, 6 months. It took me longer than I thought, but I am so glad that I did it. And it may be taking you longer than you think, but it doesn't mean that you can't do it, okay? Because remember, if you give up, guess what? You're never going to make it. You want to guarantee in this business, you want to guarantee in life, you want to guarantee in the market or your trades or anything, I guarantee you one thing. If you quit, you definitely will not make it. So guess what? Don't quit. Keep going. You got to keep figuring out, and a positive attitude really helps. What also helps, you got to get serious about it. You got to get serious about trading. You got to get serious about what you're doing. You have to get serious about what you're risking money in. Again, a lot of times right now with this market, people are going long, going short the same stock, the same day, the same hour. That's zero conviction, 0% conviction. You have no conviction in anything whatsoever at all if you're doing that. You have to take it seriously. Take a class before you trade. Practice what you're doing. Practice small signs before you take bigger positions. You need consistency, and you also need commitment. And you just can't be all over the place if you want to be successful. So for me, I always focus on gaps. I only do my system. And I also mostly go to the short side. Okay, so my focus is mostly to the short side. But there are billions and billions and billions in the market. So the very idea, when you think about it, the philosophy, the point of it, that you can make money, the answer is yes, you can. So it's really about the system that you're using. And it's very important to use a system that is consistently profitable in any market conditions, whether it's bullish, whether it's bearish, whether it's choppy, whether it's sideways. The success or failure of whatever you do really has a lot to do with the quality of your system. And unfortunately, not a lot of people have systems that are trading. And then there's a lot of people that have systems that are just not any good. They may work in one market, but they may not work in another market condition. So you may make money for a couple of weeks or a couple of months, and then it may stop working forever and never work again. So you've got to find something consistently. For me, gaps has worked now for 15 years. So I've never done anything else, and I never will do anything else, because ultimately the reason, the crux of the philosophy of what I'm doing is I'm looking for institutional money, okay? So I'm going with the control. I'm looking at taking a position, okay? And I'm looking at getting in something that is being bought by institutional money, or that is being sold off or shorted by institutional money. There's only ever one person in charge of any stock or anything on any one given day, period. That's it. Only one. Okay, there's only one direction that anything can be at any given time, and it's the control. And it's the control of what? It's the control of the money. You have to be able to spot that, find it, see it, and then you have to go with it. Okay. So I developed a system which is called the Golden Gap, which is a 26-point rating system, is a checklist that I do every single morning before I get in any trade at all. Before the open, before I even open my trading room, I rate gaps in the morning, and I rate as many as I see, as many as I like. Again, I tend to go to the short side first. We did do Microsoft. We did calls on Microsoft. We got in them yesterday. They went today. It was a really nice call. I do options and day trades. We'll talk about a little bit of options here too. But the big play we did really in the last 2 weeks was Tesla. We did like pretty much every trade that we did in Tesla. We did puts in Tesla. We did puts in Tesla before the earnings. We did day trades in Tesla, where Tesla was the gap of the last week, and it was a short. And we will talk about that briefly today. But it's the 26 points that tells me where the money's going to go. Is it going to drop? Is it going to go up? Is it going to continue in the direction of the gap? And again, whether you do as a day trader, whether you do as an option is 100% up to you. But a lot of people do like options simply because they do not have margin accounts. Now, I do have a margin account, but if you want to do day trades and options, you can. If you want to just do options, you can. If you want to just do day trades, you can. You can trade options fast meaning 1 or 2 days. That's fast for me in an option, okay? We're doing the weekly options, but you can get in and out of an option in 30 minutes if you want. Okay, I'm in and out of the day trade sometimes 5 minutes, 10 minutes, 15 minutes. Again, trying to trade the first half an hour of the day. But as far as looking at options, I still think weekly options are short. I mean, I could be doing longer term trades, but again, you pay up the farther time that you pay out for an option. So sometimes it just doesn't make sense to do something when you're paying, and then it's got to have such a big move so far out. And again, who would have thought? Who would have thought that the year would have turned out the way that it's been so far in the last 4 months? If you bet on either side of the coin and either side, the market was going to rally or drop. You would have been wrong in both points, because the market has been in such a tight range. So again, if you did say, for example, at the end of if in December, say you did SPY leaps, whether you did calls or whether you did puts, you're probably down in both that you did right now, even if you did long-term something out for like 12 months. So this type of market particularly, I think it's important to focus on the fast moves to book money. Someone's writing something there. What is one book? I can't recommend any book at all about trading. I'm sorry. Again, you think I didn't look for books when I was learning how to trade? No, there's no one book out there that I can tell you that you're going to get what you need. And I haven't written a book, and I probably won't, because I just don't have time. But if I ever get the time to write a book, what I'd write a book about? I'd write a book about something that would have to do with people's mindset. Because after teaching people now for 11 years, I started the stock swoosh 10, going on 11 years ago. This is 11th year here. I know what people's problems are. They don't stick with one thing. If I had to criticize traders in general, this is a blanket statement, I'm just generalizing here 100%. traders don't stick with one thing. I have. It's one of the reasons I'm successful. And number two, because you never get good at one thing if you jump around. And number two, traders have terrible mindsets about money. So if I ever wrote a book, if I took the time to do it, the best thing that I could offer people of my advice and knowledge and experience of all the years that I've been on this planet alive is all the people I've come in contact with, particularly Manhattan, New York, all my experience in television and everything in trading and teaching adults, because I teach adults, I don't teach children. But the fact is that people's mindset about money is probably what I'd write a book about, and that would obviously help you with trading. The reality is that many people don't have a good attitude about money. I could say I'm lucky in the sense that I have a good attitude about money, but it doesn't mean sometimes I don't get frustrated if I have a bad day trading, but I'm very good at turning it around. I'm very good at turning around. Like I talk to myself in my mind where I know what I need to think to get what I need to do. So I keep moving ahead in my own personal life and my professional life and my financial life because I keep setting goals for myself and bars for myself to move forward. And I believe that I can. You know, 10 years ago, if someone said there's no chance in hell you're going to get on Fox News, Melissa, no one knows who you are, I would have said fat chance to that. And I did it. So the reality is that if you don't believe in yourself, no one else is going to believe in you. So you start with that. And the second you start with that, then everything that happens to you, some things that you do control and some things that you don't control, you can overcome. But I think so many people, this is a problem also. I don't want to get too off track here, but this is a problem. I have a trading room. The trading room's closed off. We can't see other people's chats. Most trading rooms are basically garbage chats where people just commiserate again amongst themselves, chatting about, oh, woe is me, we lost to this trader, this thing is that thing, whatever the other. It's just people complaining and commiserating, and that a lot of that is in Reddit too. Actually, I don't participate in Reddit. I don't go on Reddit. I don't do anything with that at all. Most people will cling to each other and just poison each other with negativity. I'd love to say it's the other way around, that people can bring people up and lift people up, but it tends not to be that way. Human beings, I don't know if this is just the human mind or how it is in general, tend to slide deep down into the mud and go into a negative attitude far easier than they do to get up to a positive attitude. You got to look out for yourself, and you have to look out for yourself in everything you're doing. Nobody cares about you but you, and you better get it together if you want to trade and you want to make money in this market. It doesn't matter how long it takes you. I hear this all the time too. I've taught people that are in their 70s and 80s. And I said, how did I, like the last webinar I did, he said, I'm too old to do this. What do you mean you're too old? He was younger than my father. He was 76, my father's 78. I said, what do you mean? 76 is fine. 76 is young. You're alive. You're not dead. I mean, it's the mentality that people have for some reason, and I don't know why, is that after a certain point of life, if you haven't made it, you're never going to make it. That's not true. That's not true. If you think like that, then basically every year that it's your birthday, you think you're one step towards death. And that's ridiculous, okay? You're here, you're alive, you're lucky that you're listening to me today. Think about how grateful you should be that you're even listening to my wisdom today for free, by the way, okay? So I just went off on a tangent there. But the fact is, I can't recommend any books. Let's get back into what we're talking about here in reference to training. You do have to have the basics, but the attitude part of it, if I ever wrote a book, is absolutely the number one thing. And you have to encourage yourself. You have to be your own best friend. You have to be your own best advocate. One of the other benefits I think people get when they come to me is the lecturing I'm talking to you about right now. You know, people get this from me in the room. They get this from me in my classes too. As a mentor, okay? Because if you think you can't do it, I'll tell you that you can do it, but you still are the one doing it. You're still the one that has to press the button. You have to press it, and you have to get in, you have to get out, okay? Now let's get back to what we're talking about here. The Golden Gap system is a system that I use, which is a rating system that follows large institutional money. Gaps are created with large institutional money. That is what makes the gap. The professional gaps that happen and play out in stocks are formed by one thing and one thing only, large institutional money. For example, Meta was a good example. Microsoft was a good example. Amazon earnings are out tonight. I have no idea what they do. They could gap up, they could gap down. I may trade Amazon tomorrow, I may not. I'll know tonight when I see it if it's a good gap or not. I will tell you that. It's out after 4 o'clock, okay? So I'm not in Amazon. I don't know what it's gonna do, okay? But I know that I'm gonna watch it, and I know it's gonna gap, and I know I'm gonna rate it, and then I'm gonna know after I rate it if I'm gonna do it and how, okay? So what's the big money going to do with Amazon, for example? What did the big money do with Tesla? They dumped it, okay? Tesla tanked, fell off a planet. Again, we're going to look at that chart here in a minute. But you've got to have a formula to rate and qualify the gap to get the confirmation and conviction that the large institutional money is on your side, and then you play it. Okay, so I'm not trading in the pre-market or the post-market. Like, I'm not going to trade Amazon tonight no matter what it does. I wait, look at that time frame, then make a determination and a prediction what I think it's going to do in the live day in the first half an hour of the day, and then I take it, and then I get in and then I get out. Okay, so gaps are an event, and they create a sense of urgency. Hurry, hurry, hurry! Just like with the banks. Remember, everybody was racing to take all their money out of the banks, and then even the banks that weren't in danger, people were scrambling to move money around if they had too much money in banks. You think everyone that lives in Manhattan only has $250,000? People don't have bank accounts at 52 banks. You know, there are people that have hundreds of millions of dollars that live right here in the building I'm living in right now. I mean, the banking system cannot collapse. There's a reason that they saved that bank, okay? But the fact is, panic is something that once it starts bleeding through the system, creates this level of fear that doesn't go away like that. It doesn't go away by the FDIC just coming in and saving one bank. I mean, you're sort of seeing this now with First Republic. Actually, I walked by, I never even saw the First Republic. I never knew what it was. I just walked by and said, oh my God, that's First Republic yesterday. The FDIC doesn't want to come in and save them. Like, they're trying to force the hand of the larger banks to come in and buy the bonds of First Republic. So we live in just this web, okay? This web where everything's interconnected. Companies are interconnected. The banking system's interconnected, okay? You're one single person, individual. You're a wheel and a cog. All you have to do is just go in every day and you'd be happy with $1,000, $2,000, even $5,000 you could take out. It's the amount of money that's in the system is so massive and so huge, and the control that these institutions have. Like, it's all, you can't even, it blows your mind when you think about it, actually. It just blows your mind. So again, go back to you being able to make it, you being able to make money, you've been able to make 20K a month or 100K a month or even whatever. That is such a small amount, considering what's in the market and what's going through these companies and corporations that control everything, okay? So again, you need to be smart and you need to take advantage of that, and you can by actively trading, okay? And again, this is not long-term investing. This is in and out, chunk it out. You take it, get out, and whether it's in 30 minutes or whether it's in 1 day for an option, you're in and out like that, okay? Anyways, gap trading is incredibly powerful. It's an event. It's an event. It's an event whether it's up or down, but again, today we're talking about shorts. Trading golden gaps is a powerful and profitable way to trade because you're trading the side of power money, and that's how you're going to make it, okay? Surround yourself with like-minded people. Surround yourself with people you want to emulate. If you want to be rich, you better start making some friends that are wealthy too. Stop spending time talking to people that have a negative attitude about money. And it's not hard to find those people right now. Why? Because we're going into a recession probably. We're probably in a recession now. Really, let's be honest. If not, we're going to be in a clear recession by the end of 2023. And everybody knows we're in inflation. So you have plenty of things to complain and whine about if you want to be negative. You're not going to change that, okay? If you have a job and you want to make extra money on the side, trading fast in and out of the morning is a perfect thing to do. Doing options on the side where you're working full-time is a perfect thing to do. You can do that while you're at your full-time job, because you may not get a raise at your job because companies are cutting back, okay? And nobody's going to tell you, well, all of a sudden there's going to be this huge discount on things. No, inflation may never go back down to where it was, but the cost of eggs and milk and cheese and steaks and everything we buy at the grocery store may never go back down to where the prices were. Now, oil fluctuates, that's true, but we may not be down to gas prices that we were back before the 2020 election, you know, before COVID, for another 5 years. So at the end of the day, okay, you can make extra money if you don't want to change your lifestyle. But if you want to change your lifestyle and live a better lifestyle, that's up to you. I'm trying to live a better lifestyle. I certainly don't want to live a less lifestyle. So, I mean, the fact is that you can make extra money on the side. And it's all about predicting events beforehand and then taking advantage of it, AKA Tesla, which we did here. And I'm going to go over this trade. So I called puts here, the stock gap down, they were up. Then we called some more in here that I gapped down. This was a day of earnings that it fell. I didn't have the chart in here from yesterday, but yesterday it really fell off a planet. Broke 160, fell all the way down, broke 155. This was really the short of the week. Someone's asking me something. Supply and demand. I don't know what you mean by zone trading. I don't know anything about what we're talking about with that. Supply and demand, what do you mean supply and demand? Like, what's your question? I don't get your question about supply and demand. detail that out for me. This was last year's results. So this was last year, but I did take 2 weeks off last year. I moved. 2022, this is an average risk of $2,800 per trade, $651,079. This is all last year. And I took 2 weeks off to move. So I'm not doing that this year. I might take a vacation. I might just do a staycation and stay in New York because I haven't had much downtime, even the weekends I've had off, to actually enjoy where I'm at. I've been going in walks in Central Park probably every day, not today because it rained, but I'd like some time to enjoy my new neighborhood. But ultimately, you know, the nice thing though about trading is you can grow and get better over time if you trade more and get better. And I think that's the problem with a lot of people. They just struggle to ever get good at one thing because they jump around too much. Getting into the market then, today we're rallying. Now, I didn't see where we are right now, but this was where we are this morning. We actually gapped up. So what's a gap? A stock closed here. This was the QQQs. And again, we do the ATFs. The market gapped up this morning. Why? Because Meta was up. Meta affects the market. Again, Amazon's out tonight. That will affect the market too. So a gap up is where at 4 o'clock, we close at one price and we close at a higher price the next day. A gap down is what? Where the market or stock or anything at all closes at 4 o'clock and then 9:30 in the morning opens at a lower price. That's a gap down. I tend to focus on gap downs. That's why we did Tesla. We also did the market here on this date too. That was the 25th. Okay. Now, a lot of people want to talk about shorts. They want to talk about short squeezes. Could we have a short squeeze in the market because there are people short? Yes, we could. So you can have a short squeeze in the market where you have too many people that are squeezed out of their short positions, so the market could all of a sudden then push higher. Yes, that could happen. That could actually happen. I don't know. I'm not predicting it's going to happen, but I'm telling you that it could. The same way we could push down to the downside and people are long, but a lot of people only want to do shorts when it is a short squeeze. We're looking for shorts every day. There aren't short squeezes every day, okay? But if the market really wants to go, there are people that are short the market that are betting to the downside already. This is a picture again of this morning at 10:40 of the QQQs. If we really want to go up, but we really want to rally, or really want to blow through the top, and if the Fed says something next week that all of a sudden makes the market excited, yeah, we could have a short squeeze in this market. And then all the shorts are squeezed out, and then you would want to be what? You want to be long. The institutional money would be taking us up, will be buying the market, okay? Let me see if there's any other questions here. Salvador, I didn't understand your question. Anyways, it's about proper alignment with big money. Big money controls the market. Big money controls the world. You can see that even in everything that we have going on right now, like I said, with multiple industries. So it is about making good choices. How do you find quality trades? You need a good system. So my system tells you how, what, and when. How do you make money in the market? You got to trade a strategy that's profitable. So for me, it's golden gaps. I'm looking for large momentum. What stocks am I trading? Anything that rates 20 points or more per my 26-point rating system. I trade the gap only in the direction of the gap. I do not do gap fills. When do I trade them? Early in the morning in the open when they set up and trigger. So again, I'm in and out quickly. I'm looking to do the same thing pretty much every single solitary day. And that's how you get good at it. That's how you can tell it. There are gaps every day in the market, like Tesla. There was a ton of stuff today, a ridiculous amount of stuff today. Today we did CAT, but we could have done 5 different things. You can do 5 different things, but I'm trying always to get the fastest trade. Sometimes we're in and out of trade in 2 minutes. Okay, so again, once you get in and out quickly, then you don't have to worry about other things that are going on. So we're gonna look at 1 week. This was the week of April. Again, I didn't have time to put the past week in, but we made 14,390. This is with a $2,800 risk. This was 410. We made money in Tesla, lost in Slow, lost in Zoom. The 11th, we made money in Amazon. 12th, we did AAL. 13th, we did Infi. And this is unusual, but I did do 2 trades on this day. C was a long and BA was a short. And we made money in both of those. That was the start of earnings season on the 14th. So this is a good week. This is an average week. We had 2 losers. People always ask, do you have losers? Yes. The trades in parentheses and the stats and the year-to-dates and the annual numbers are the losers. So we had 2 losers this week, and we still made good money. Now let's go over every single trade. Somebody's asking about something here. If you want a trial, I give trials for a week. You'd have to email me at melissa@swoosh.com. Support and resistance is fine, but that's not a strategy, Salvador. Support and resistance isn't a strategy. It's something that you can use just like anything else. It's an indicator you have on your chart, but that's not a strategy, okay? Okay, let's talk about Tesla. So Tesla was 410, take it out. Here, stock closed here, gap down. We closed green, but this is actually a tail that we shorted and made money right in here, and we got in and out. So we shorted this and we made money. Boom. And that was on 410. And then we got in and we got out. And we made 6,100. Or you did if you risked 3,000. So short was 179.60, exit was 176.55. This is a daily chart here. Someone's asking. It's a daily chart of Tesla. Then this is snow. We lost in snow on 410. And again, here is snow. Stock closed here, gap down, fell. We got stopped in it. It flipped. So I didn't make money in the snow then on that particular day. And Zoom was in the other day that we lost in the Zoom. Here was the 10th, closed here, gap down, dropped. We stopped in Zoom. So 3 trades on that day. But overall, that was the start of the week. That was the Monday. Then we did Amazon on the 11th. Let me find it here. Stock closed here, gap down. We shorted it. Boom. Again, this is a daily chart. We got in and out. 47.50 is a great amount of money. Okay. The size was here, was 5,000 shares, and we captured almost $1. Again, if you risk $1, you're looking to make $1. If you risk 50 cents, you're looking to make 50 cents. 412, we did AAL. This is a little rinky dinker. We didn't make quite 100% on this, close, but again, it went to the target, so I got out. It did keep going. 412 was AAL. Stock closed up here, gap down, fell. So if you held this, you can see it broke 13. So I got out of this really quick in the morning, but it actually would have been a massive trade if you had held it all the way down, because we entered it at 13.60 and it broke 13. I just didn't hold it all the way down there. Sometimes if I say I get out of the trade where I get out in the room, but if you want to hold it longer, you can. I mean, you can. Impy then we did on 413, closed here, gap down. This was a good one. Again, in and out quick. This kept going where I got out of it too. Again, risk was 29.70, made 27.90, close enough, close enough. I'm looking for targets. I'm looking for time of the day. I'm looking for what the market's doing. C was a long, like I said, unusual. This also kept going where I got out. I got in and out of this quick because I had made money in the other BA, 17.50. Here was the gap. This was a gap up, closed here, gapped up, rallied. Here it was. We also did calls in C. We did options in C, and this almost went to 50 on the day, and then it did go to 50. Again, I got out of this quick. I did not hold this either. Tesla, I held. Tesla, I believe, was lower. Tesla, I did a bunch of trades in C. I got out fast. It was also Friday. BA, we did here. Closed here, gap down, fell. 202.35 was the entry. Again, 200 was the target. Went there, boom, out, done. Finish. This kept going though too. Again, take your money and run to the bank. This came all the way down, dropped $2 from where I got out of it. But again, I like the fast trades and I don't have to worry about anything at all. Someone is asking, how am I calculating the risk amount, the difference between the entry and the stop? How much money do you think someone would need to trade this strategy? You need a margin account, which is a minimum of 25,000 at a retail broker. At a prop broker, you could probably open up a margin account with 5,000. You're going to get 10-to-1 margin. A retail 4-to-1 margin. If you can't open up a margin account, if you don't have 25,000 and you don't want to go prop, then you open up an options account, which the minimum at an options account at a retail broker is 2,000, and you can open up a cash account. So whether you do day trades, active day trades, or options has to do with the amount of cash that you have. That answers that question. Okay. Anyways, it was a good week. So, I mean, I could have put last week, this week, whatever. I told you today we did CAT. We didn't do any options today. But, you know, this is one of these things, again, where if your mindset is such that you believe that you can do it, you will do it, you know. And it's not about making money in every trade. You will have some losses, even with me. But it is about making money more than you don't, okay, which you will with me. So the fact is, you have to be consistent. If I didn't lose in any trades, I would essentially risk my whole account all the time, every day in every trade. I don't do that. You have to have parameters. Look at, again, what happened to the banking institutions. They had parameters. They didn't follow them. Poor management and poor risk money management took down that bank in Silicon Valley. I mean, anybody could saw last year what interest rates were doing, how they were moving against bonds for long-term bonds. And I mean, they ignored it. So, and then when people wanted to take all their money out, then they couldn't. And there was a run in the bank. So they took them down. You know, people always can say, oh, I need so much money to trade. I don't have enough money. I can't do this, don't have this much money. you'll be waiting forever, okay? You have to build it. Start slow and build it. If you're waiting for what? Waiting for you to win the lottery? Like, seriously, start with what you have now. Stop complaining that you don't have enough. Train with $2,000 and build it up. If that's what you got to do, that's what you got to do, okay? Everybody has parameters they have to work within, okay? That's what it is. All right, my niece right now, she's in New York. She's going to ballet school. I'm her aunt, so I mean, her parents are. My sister is her mom, and they were telling me she has a limit on her debit card that she can take out cash every day, and apparently she took all her money out. She was allowed to take out that one particular day, and her parents freaked out. And I was talking to her, and I said, Emily, don't you want? She said, well, it's my money. I said, Emily, you can't spend all your money in one day. If your dad wouldn't have had you cut off at a certain amount, what would you have spent all your money? You have a limitation, and she's in school. She doesn't have a job. Everyone has limitations, okay? So complaining about them isn't going to get you ahead. It isn't going to get you anywhere, okay? Again, think positive. Think that you're going to get somewhere. Think that you can get somewhere. Be willing to do what it takes to get somewhere. You know, so many people are not willing to do what it takes to get ahead, which sometimes mean sacrifice. Like my classes on a weekend. That means you're not, you know, playing around, watching sports all weekend. You will be sitting in front of the computer. But guess what? It should be fun. You're learning how to make money. That should be fun. I mean, you know, you have to make certain sacrifices. Opening up a trading account, putting money in it, paying for a class. There's a cost to everything. Sacrifice. Someone's asking me about how much do you concentrate on options versus stocks? It's the same strategy. The strategy I do for day trades and the strategy I do for options is exactly the same. It's a 26-point rating system. So I get up in the morning, I rate everything I like. And if I decide that I want to do something, I might do it as an option and a day trade. If I decide that I want to do something as a day trade, then I may not do it as an option. Why? Because I don't think it's going to have enough follow through, so I don't do it as an option. If I do something as a day trade and an option, which we did in Tesla, then guess what? I really, 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 really like it. But it's not every trade. Some trades don't make sense as day trades. They do make sense as options. And some trades don't make sense as options, or they don't even have any options, or they don't have any volume. But as far as what I do, I don't spend any more time on any one other than the other. I spend time in the morning rating the gaps, and then I make a determination if I want to do both an option and a day trade in it, or one or the other. So why is the Golden Gap 26-point rating system consistent and reliable? Because of the power money. You've got to trade on the side of power money. It's so important. Institutional money is in charge. I cannot stress this enough. And I also have to stress how you've got to win more than you lose. Accept the fact that sometimes you will lose. Nobody likes that. Be in a bad mood all day if you have a bad day, but don't blow up your account. But if you're losing, and you've been trading the same strategy, or you have no strategy, and you're losing for 2 months, 3 months, 6 months, a year, I mean, you'd have to be crazy to keep trading doing that same thing. Change it, do something different. You got to change it up. Again, sometimes something doesn't work and it's not your fault. So then just learn something else so you can make money, because the whole idea is making money. That's why you're doing this. And you want to get better over time. And if you're not even doing something that doesn't work, then how are you going to get better over time? So for me, it is my 26 points. It is the checklist. This is what I go through to make the picks every day. I'm looking for a high probability of directional bias that will last the whole day, ideally. You know, like we had that with Tesla. Then I want a big move in the day. Again, Tesla, early confirmation of the bias and the move between 9:30 and 10 a.m. We had that the other day in the market. I went right after the market on that, whatever that was day was 2 days ago. I think it was the 25th. Right? And I said, oh my God, we're going to fall. Boom. Then we did options, got it, boom, got the drop. Fell into the close. Precise entries with follow through and a good risk to reward. And then of course you want good target potential, but it's the trade selection, because so many people just aren't doing the right things and they don't know what to do, and then they're flip-flopping, and are they trading stuff that doesn't even move? I mean, we don't trade penny stocks. I'm not doing something that costs $1. You know, again, don't do stuff that's crazy or it's going to get halted. Do stuff that's normal companies. You can say, oh, I know, I've heard of Target, I've heard of Walmart. Yes, I've shopped there myself. So then you say, yeah, this has a lot of volume. Things that you know of, all right, that they'll be here today, they'll be here tomorrow, okay? But the checklist tells you what to look for in the price of the stock to read it correctly. And it really matters because that's how you're going to make money, because you won't make money going long if you're short, and vice versa. So what do you need to make trading work? Number one, a system to follow with rules. So my system has rules. If it doesn't meet the 26-point criteria of 20 points or more as a cutoff, then I'm not going to do it. Then I don't take it in the direction of the gap, then I don't take it at all, and I don't go the reverse, okay? I don't do the reverse, I follow the rules. Not all gaps are good though. So I might get up one day and there isn't any good gaps, guess what? Then I don't do anything. You also need a method and a structure to enter and exit the picks. This was Tesla. This was Tesla from Monday. We did it. It fell off a planet. Here's the short in here. This is a 1-minute chart. Again, I teach all of the entries in the class. I teach the exits in the class. I call them live in the room, okay? And then you need goals. And I think you need to be realistic with your goals. So if if you have a small account, $100 a day is $500 a week. $500 a week is $2,000 a month. If you're not making $2,000 a month trading, why are you trying to make $100,000, a year trading? So I mean, $2,000 a month, if you look at it, is 24 grand a year. And if you didn't make that last year trading, why are you trying to make like 100 grand this year? Just start with the amount of money you have. If you only have $5,000, you could open up an options account and see if you can make $500 a week. I mean, that makes sense, doesn't it? And if you can make 24 grand then by the end of the year, that $5,000 account will have almost 30 grand in it. And then boop, all of a sudden you've got a margin account, you can day trade, you can do options, instead of fighting with whatever you're working with. You can't be fighting all the time against the market, fighting over all the time against the rules, fighting the system. You're not going to win, okay? So go with the flow, all right? Anyways, number 4, I think you need a talented mentor. If you have someone there to help you, to guide you, to give you the motivation and help guide you in all of the things that I know, just not the education, the learning. We're talking today about the mentality, the mindset, what you need. I do think that helps. It helps in the good days. It helps in the bad days. It helps when you need it. And when you're trying to narrow it down to 1 or 2 things, very often I can pick it because I've been doing this a long time and I have a sixth sense for what I'm doing as well. And if we have time here, which we may not, I'll tell you what I think about Amazon. I'll pull up the chart for tonight since it's coming out, but I don't know if I'm gonna have time because I started a little bit late here from the last person, but we'll see. Anyways, the reliability in the system means sticking with one thing. For me, it's the daily. I look at it, I rate on the daily, I do use stops, I'm very deliberate in my choices. Education is important. I teach a class once a month. My April class is this weekend. I know that only gives people 1 day to make a decision or 2 days, but the class is Saturday and Sunday. If you want to sign up for April, the next class is not for another month in May. But you've got to learn how to trade, and you should be thinking about what you're doing, to make money. Now, really quickly here, this was Tesla. I just want to show, this was a trade I called, and I just want to show if you got out here on one particular day, if you held it. I called the 185 Teslas before the earnings. I did not hold it through this earnings, this 185, or the 184s, or the 185s. I called the 185s on the 18th, okay? So if you held that through the earnings, you could have made 269%. So for example, if you held it, you could have risked $1,300, made $3,500. I'm telling you, I didn't do this. So I chose to get out because the day before I was up. But the fact is that, that was my choice. So on this day, okay, I called the 185s. I called the puts. I was up on this day. I got out of the trade. I'll show you what I did in a minute. It was like 54% return on investment. It wasn't 269. I took the safe out. Okay, I was up. 50% I think is good in an option, but I want to show you how some of these calls I call are really huge. It gapped down here the next day. Here's basically where it opened then on the earnings, and it was over 200%. So this was the trade that I did. I did the 185 puts, and I took them on the 18th, and I got out of them on the 19th, and I made 54%. So I thought that was good. It was money in the bank. But I just want to show you here, this did continue, and if you held it, you would have really made bank. And one person that I know on the options letter, Muhammad, did hold it. He did. Oh, here's the day. So I called it here. I got out of it here. Muhammad, I know, held it to here, but it was a bigger trade there. Actually, you could have even been in it, you know, even a little bit to the into the last day, which is so crazy. Even the last day, which I would never hold at the last day if I'm up, you know, 50%, 100%, whatever. The last day here, you could have even got out of that with a lot. Just looking here, closed at 165. What am I saying here? Somebody's question. Do I only call puts and calls? Yes. I'm doing momentum trading. I'm buying puts and selling them, and then I'm buying calls and selling them. So if you're interested in the class, again, you can learn what I do. The options newsletter is a separate subscription. There is no prerequisites for that. There is a prerequisite for the live trading room, which you must be a student of the Golden Gap class to be in the room as a member. I often do specials to try to help people to support them to be in the room, but you can just sign up for the newsletter today and you'll get tomorrow's trades. So the Golden Gap course teaches one solid strategy to trade gaps effectively by reading the side of power in charts, and that's what I focus on. And it teaches a proficient level and advanced level to read charts. So I'm just going to skip forward here. It's very, very important, again, for people to understand that education is a big piece of learning what to do. Unless you want to teach yourself or create your own system. I did it, but it took me 3 years. So it's a lot easier for you to pay me for the class and learn it in a weekend. You will have questions after that. You absolutely will, but I'll be there for you if you do have questions. Here's some testimonials from people. And now here is the class information. It's a full 2-day course on how to strategically find, pick, and place stocks that are professional bearish gaps. The class is this weekend, April 29th and 30th, 9 to 5. Class is $69.99. Now, I am doing a special, pay half now, half later, which to try to help people. You pay half of the money and you do day 2, which is all the entries and the exits. You can start to trade. You're in the room then for 60 days trading, and then you pay for the rest of the class and you do day 1 then after the 60 days, and then you get the trading room free to the end of the year. Now, if you want to pay for the class full for $69.99 by tomorrow, you can do the class for the weekend and you get the trading room free through the end of the year with the class. And the next class is not till May 20th and 21st. And then I have a combo, which includes the trends, which is on May 2nd. I do have some people signed up for that. That's $74.99. Any questions from anyone here in the last few minutes? I think I'm good with time. Any questions from anyone in the last few minutes?
Melissa, I apologize for the interruption, but I'd like you to ask them to email you with questions. I'm not sure if you were aware, but it's a 45-minute slot.
I know it was, but I didn't get on right at noon, so I was trying to get the full 45 in, but I wasn't.
Hey, no, absolutely. If you'd like to answer a question or two, but you know, in the interest of things, I do have to be fair to the next presenter as well.
Okay, great. Thanks for having me.
Melissa, I want to thank you for the great presentation. And, you know, those numbers are impressive. You have my attention, absolutely. And I'm also a big fan of all the speakers, all that you were saying about mindset and everything. I absolutely agree with. But your topic, make fast profits trading 30 minutes a day, had me on the edge of my seat. And your Golden Gaps course looks amazing. I want to thank you for making such a generous offer to our audience today. It's always great to have you on Traders Corner. Ladies and gentlemen, Mrs. Melissa Armo of the Stock Swoosh. And if you're interested in making fast profits trading just 30 minutes a day, you can find her and take advantage of our special offer in our chat box or visit her at thestockswoosh.com. Thanks again for joining us today, Melissa. I want to wish you a great, great weekend. Ladies and gentlemen, our staff at Traders Corner sifts through hundreds of pro traders and brings you the most credible and qualified traders to participate on our shows. Our next presenter is no exception. She has a BA in mathematics from the University of South Carolina, or California, I'm sorry, and an MS in Information Resource Management from the Air Force Institute of Technology, and over 23 years of experience studying the markets. She's Vice President and Senior Technical Analyst at DecisionPoint.com, along with her father, Carl Swenlin. She launched DecisionPoint Daily Blog in 2009 along Carl. She serves as Consulting Technical Analyst and blog contributor at StockCharts.com. Erin is an active member of the CMT Association. Ladies and gentlemen, here to present simple indicators to improve your entries and exits is Erin Swenlin of DecisionPoint.com. Welcome back to Traders Corner, Erin.
Hey, thank you so much. It's my pleasure to be here. Let me make sure everybody can hear me. Yeah, it looks like you can.
Loud and clear. We got your screen up, and
Woohoo!
it's always a pleasure to have you.
Okay, so today I'm going to be discussing how you can improve your entries and exits for longs and shorts on stocks. I don't do options, so Melissa's information was very interesting to me, but not something that I do. So I'm going to switch gears a little bit here, and we'll look at stock selection. So here are just a few pieces of information. We've already talked about me, so we can flip through this. I don't need to talk about myself anymore. Okay, so I'm going to talk to you a little bit about what I call a life cycle of a decision point trade. So this is pretty much how we run things when we choose our stocks. So first of all, we always start off with big picture analysis, meaning we need to know what's going on in the market. Our DP alert is just fantastic to give you that kind of information. We study the SPY, we look at all of the indicators for it, but we also study Bitcoin and yields and bonds and gold miners. All of that is included in our DP alert. So we feel that's the cornerstone. You have to know what's going on in the market because you need to ride that tide. We do sector and industry group analysis next. So once I've looked at what's going on in the market, I pick out some sectors that look interesting to me, and then I go in and look at the industry groups within those sectors to see which ones really are showing the most strength and momentum. Then I run my scans. I have a number of scans. We're actually in the process of putting together a scan alert system where you would get all of my scan results unfiltered in a service, which should launch hopefully soon. And, you know, a lot of those scans come up with some real winners. And that's really what I want to do, is find those stocks that will ride the tide, as I was saying earlier. Once you get all those results, like I said, the scan service will be for the do-it-yourselfer. You can sift through the scans, or you can become a DecisionPoint Diamond subscriber, and I do all of the sifting for you, and I give you 10 stock picks per week. So you make your pick, and then you have to time that entry and exit. And I think that is important because you can get yourself an extra 1 or 2% if you just happen to time it right on the right day. Determine your target and your stop. So once I'm in a stock, I find it to be really a necessity to come up with a target and a stop. Just getting in and just sort of riding around and just trying to figure out, well, I like it, it's going up, and not paying enough attention to it. You know, you don't have to pay strict attention with most brokerages. You can set those targets and stops, go on your summer vacation. And if you're not on summer vacation, at least you know that if you're distracted, if something happens, you're going to be set. You're going to get out when you need to get out, and you will get out when you should get out as far as the upside as well. So which charts do you follow? I look at long-term investing as monthly charts to weekly charts to daily charts. So you have to start with a much bigger picture when you're long-term investing. Intermediate term investing, I'm looking at weekly charts to daily charts. And short-term trading, I call it, are daily charts to minute charts. And then of course there's the day traders. I don't do day trading, but you can use the minute charts. You can use this technique to do day trading as well. It's just not something that I do. And that's because you time your entries using those minute charts. I use a 5-minute bar chart myself, candlestick, I'm sorry. The important indicators, the indicators you're going to see on all of my charts are all available through, I know stockcharts.com has all of these indicators. I believe our price momentum oscillator is now on Thinkorswim. I think it's on most major charting platforms at this point. The price momentum oscillator is very much like the MACD and the PPO in particular. If you were to map them on a chart, they would look almost the same, which is fine by us because What it really is good for are divergences, and catching those negative and positive divergences tends to not be quite as twitchy. I really trust my PMO and can't recommend it enough. Relative strength index, of course, the RSI. I need to know whether the price is overbought or oversold. Price. On balance volume, that gives me my volume piece. It's an easy indicator to understand. I don't think you have to get complicated with your charts. I just don't believe that you need more than what I'm going to show you on your chart. And of course, everybody has their favorite indicators, and these are mine. Stochastics, this is my condition indicator. It tells me the condition of that stock. Is it in a bullish condition? Is stochastics rising? Are they above 80? So you know internal strength is there. Really, it's just a great indicator for internal strength and internal weakness. Relative strength analysis. So relative strength index is not the same as relative strength analysis. The relative strength analysis is comparing the industry group to the S&P, comparing the stock to the S&P, and then my important piece is comparing the stock to its industry group, so that not only have you picked a strong sector and industry group, you want to find the strongest stocks within that group. And one of the ways you can do that is by measuring relative strength of the stock against its industry group. So all of those things are on my chart. I'm going through this because as soon as I'm done with this, I'm going to be ready. I want to take your symbol requests. We'll look at it and apply all of this that I'm going to show you right now in a trading room. All right, so here you go. There's RSI at the top. Like I said, it tells me whether price is overbought or oversold based on where it's located. If it's above 70, that means that it is overbought, and you need to be careful because price has risen too much too fast usually. Or you're looking at a winner that might keep on winning. That's why you keep looking down the chart. Here we had a double bottom, so I always look at price, of course. I'm always looking for chart patterns. I don't know, over time, I've just loved chart patterns so much. I feel like I look at a chart and I can immediately see the patterns that are developing within it. You do this long enough and that's exactly what'll happen. There's my PMO. You can see that this measures the momentum. The signal line is red. Right here, we had a PMO buy signal come in. The stochastic, there's your OBV. You can see that when the tops are falling, that's confirming a downtrend. When they're rising, that confirms an uptrend. Now, if per chance, like what back here, what you had was an OBV bottom here and then an OBV bottom here. Notice these were rising bottoms and these were declining bottoms. So that actually was a positive OBV divergence that actually should have led into a more extended rally. You did get a little rally out of it, but not as much as I would have expected. But that's why you have all the indicators on the chart. Stochastics, as I said, what I'm looking for are rising stochastics, but in particular, I want my stochastics to be above 80. And a lot of people are like, well, that's kind of overbought. Well, I don't look at stochastics as overbought and oversold. I look at stochastics as a measure of internal strength. And you want stochastics to be high. You want them to be at least over 50 in positive territory. So we're looking for internal strength, and stochastics is a great measure of that. The other reason I like to add stochastics is that they tend to be more sensitive in regards to different than my PMO. My PMO obviously doesn't twitch like stochastics, but the nice thing about stochastics measuring that internal strength is you get that additional information. So you want stochastics over 80. That means you have a lot of internal strength. If they're below 20 or falling, that generally means something bad is about to happen or is going on. Here's the relative strength that I was talking about. Here's the relative strength of the industry group to the S&P, and you can see that's rising. So that's a check mark. The relative strength of the stock to the SPY is rising, so that's a check mark. And then, like I said, this is what I really want to look at. relative strength of the stock to the industry group. Notice that the relative strength line is rising. That means that this particular stock is relatively more strong than the rest of those within the group. So that's why we're looking at relative strength of the stock to the industry group. Like I said, I don't like to get too complicated. I don't think it needs to get too complicated. I'm a pretty successful trader, and I use the same indicators. They're very simple. I have the same thresholds for my entries and exits when we look at a 5-minute candlestick chart. So it's the same indicators. We have a PMO and the RSI on it, as well as the OBV. So it's the same indicators on that 5-minute chart. I use minute charts only for entries and exits. I do not look at a minute chart to decide if I want the stock or not. That's just way too small, short a time frame. Now, of course, if you are a day trader, maybe you want to look at minute charts, but I would say that you need to look at least an hour chart, 2-hour chart, something to give you some basis and foundation for your analysis before you get to this 5-minute chart. You want to use that for your entries and exits only. The entries are, like I said, 5-minute candlesticks, and exits are also on a 5-minute candlestick. So what are the rules for entries and exits? When you use the 5-minute candle, the conservative entries are when the PMO has, the 5-minute PMO has a positive crossover and the RSI is positive. Pretty simple. It works pretty well. Sell points. Anytime the PMO turns down, that 5-minute PMO is a sell point. I don't need a positive, negative RSI. I just want to get out. And so what I'm looking for is the minute that momentum turns down. That is usually a good time to get out because you're going to see some follow through to the downside. So you're going to sell at a better point. Aggressive entries are based on price patterns, the PMO and RSI reactions, meaning if you want to get aggressive with it, you can look and say, hey, there's a double bottom on this 5-minute candle, Maybe that would be a good entry. The PMO is rising or just started to rise. It hasn't had the crossover. Maybe the RSI has been positive all day. There's gray area once you leave that conservative entries. And really the aggressive entries, the more you do it, you'll have a better idea as to whether it's a good idea or not to get aggressive on a stock. I would say that if your daily chart looks really good, getting aggressive on your entries and exits might not be a bad idea because you're really counting on that stock to do more just past a day. Here is that same stock that I was showing you the daily chart for. Here's kind of a double bottom on the chart. You can see that the entry would have occurred back here, the conservative entry, crossover, positive RSI. And that would have gotten you in right around here. When you wanted to exit, that is when the PMO turns over. You could have also exited back here where the PMO turned over, and that would have gotten you out up in this area. So as I said, you could certainly use this system for day trading. It's going to get you some extra percentages during the day, but it's excellent even if you're a longer term trader to use this just to give yourself a head start and make sure you're kind of getting yourself on the right path. So now that we've talked all about this, it's time to go look at your symbol requests. So go ahead and throw some in there. If I don't see any, I'll just sort of pick what I can and we'll go from there. Let me get to my charts here. There we go. Looks like you can see them. I can make them big. That's about as big as I can get, so hopefully that will work. Here is Amazon. Since I don't have any, I don't see any in the question box yet for symbol requests, but feel free, just throw in any one of them you want. I look at, like I said, I pick 10 stocks and ETFs per week. I have ETF day on Wednesday, so if you're not a stock trader and you prefer to trade ETFs, DecisionPoint diamonds will fit the bill because you will get 3 ETF selections per week. And I do the work for you. So what can I say? And you'll see at the end, my price points are really low. Sometimes I come on these things and I'm a little embarrassed by how low my price points are, but really my main thing is to get you in, to get you learning what to do. I don't want to just give you the magic bullet. There is none. And, I want you to learn as you go along. And, I am a trader, but I feel that mostly I am a teacher, and that's what I want to do, is teach my subscribers to be better traders. And so I want you to be able to have that subscription and really get some use out of it. So here's Amazon. I still don't see any requests. My goodness, you guys are so quiet out there. Okay.
Hey, Erin.
So, yes.
I just want to point out, if you're looking in the control box, make sure you're in questions, not chat. That's where they'll roll into.
Okay. Yep, I don't see any yet. I think they're still from the prior ones. So I'll keep an eye out over there. And if you could too, that would be great.
Hey, scroll down. You got a bunch of them coming in. Alibaba, Comcast, IWM.
Woo, okay, now we're talking.
There you go.
GDXJ. Okay, that one caught my eye. I'm going to show you GDX because I have what we call under the hood indicators. I do various presentations and we have some really powerful indicators. One that is called the Silver Cross Index. This indicator is just, I can't even tell you how fantastic it is. We actually had a company approach us. They want to use it in their algorithms. We said, okay, and they're finding that it has improved their models by leaps and bounds. So the Silver Cross Index is turning out to be an amazing indicator. I'll tell you about it shortly. But here is, let's go down to GDX, because I actually have under the hood indicators for not only the major indexes here, but also all of the sectors and select industry groups, gold miners being one of them. So I think this will be really informative for GDXJ. I think they're very similar and it'll give you a good feel. So the first thing I know is everybody's looking for the rebound. We've got the pullback to support and now it's everybody's salivating. I know I've been salivating. I want to get in on this one, but it is not the time to get in on this one. I think it is still a hold because we are holding support here, but I think it's not the time to get in. And why do I think that? RSI is positive, right? That should be okay. Well, my price momentum oscillator is on a sell signal and it is falling. But here's what really bothers me the most is the under the hood indicators. So I'm going to direct you to these three right here. These are probably the easiest to understand. So we measure how many stocks are above their 20-day EMA within gold miners in this case. So in gold miners, we have 43% with price over their 20. Now, personally, I don't like to buy stocks that are below their 20. I really like to find those where they're above the 20, they're bouncing off the 20, which is kind of what GDX is trying to do here. Then we have the stocks above their 50 and the stocks above their 200-day EMAs. This is excellent information, and it can tell you that participation is dropping off for gold miners. We are losing the internal strength. We need to have strength under the surface in order for us to get a rebound. And what's happening? We're actually seeing participation bleeding off. Stochastics, they are in below 20, which is the worst place they could be, but they are trying to turn up and they are our early warning indicator, if you will. They give us some great attention flags, but it's not even turned up yet. And relative strength obviously is petering off for gold miners. But here's the big one, the Silver Cross Index. So I'm going to start with the Golden Cross Index. Everybody is very familiar with what a Golden Cross is. That's when your 50-day EMA crosses above your 200-day EMA. So what we decided is when the 50 is above the 200, that means a stock is in a bull market configuration for that stock. So we wanted to measure how many stocks within that index sector industry group, how many of them have a 50-day over their 200? How many are actually configured bullishly? That's what the Golden Cross Index tells you. The Silver Cross Index is very similar, only we consider a Silver Cross a 20-50-day EMA crossover. And that tells you that either the stock is in a bull, not just necessarily a bull market configuration. It tells you that when the 20 gets above the 50, that in the intermediate and shorter terms, you have a nice bullish bias. So how many stocks have a bullish bias is what we want to know on the Silver Cross Index. How many stocks actually have a 20 above their 50? And that's what the Silver Cross Index measures. It's such a simple indicator. We are actually amazed that that this was something nobody else came up with. And like I said, we're finding it to be extraordinarily useful. So when the Silver Cross turns down, that's usually a sign that we're going to get a longer term decline or intermediate term decline. What we mark here are cardinal bottoms with green verticals and cardinal tops with red verticals. Cardinal meaning major direction changes. There's a bottom and there's a top. Notice that on these tops, the Silver Cross Index was pretty much right on. The negative crossover there pretty much gave us the signal that things were not as good as they may have looked up here. And so then we started to see things peter off. That's what's going on here on my Silver Cross Index. It does look like it paused a little bit. We'll have to see what happens after the close today. Maybe it'll turn up again, but ultimately it's on a negative crossover. And so I can't get in there and say gold miners are looking good. That was a long symbol request. I apologize. I will have time for far more. I'm just kind of looking through because I know I have some good charts here. IWM, let's look at IJR. That's the S&P 600. So it's pretty similar. I think I'm not going too far off the reservation here. IWM is great. It measures all the cats and dogs, as we like to call them. But the S&P 600 is a moderated list. We can actually do the Silver Cross, Golden Cross for it. So that's why I tend to concentrate more on the S&P 600 than I do on IWM. But you can see the same situations going on here. And in the case of IJR, the Silver Cross just yesterday had a negative crossover its signal line. And we call that a bear shift. It's a shift in direction, a shift in character for that particular stock, and in this case, this ETF. So that is a problem for me. There are a lot of problems going on. I will tell you straight up, I'm a big bear right now. If you follow me on Twitter, you'll know that I called this decline about 5-6 trading days ago. Our indicators were pretty much right on. The Silver Cross had topped, and you know, it put us in a good situation knowing that the market would probably have a downturn. It would give us some information on maybe getting into an inverse ETF, which I did end up recommending yesterday to my diamond subscribers. Let's see, I gave them I gave them the real estate inverse for the real estate sector, which was REK. I told them they should short JETS, the airline ETF. And I also put in SDOW, which is an ultra short of the Dow. The Dow looks absolutely terrible right now, and I thought that would be a pretty good inverse. We'll see how it turns out. I also knew today would be a bounce, and I knew that because of our climactic indicators. We had a downside exhaustion climax, so I was looking for a bounce today or a pause, and that's what we're getting. But I have to tell you guys, I don't think this one, excuse me, I don't think this one's going to catch hold. I would say we're going to see more downside. I hope we don't test October lows, but I would not be at all surprised if we do. So that's how bearish I am right now. All right, so more about IJR. So this really just tells me right here that that's a problem. IWM, I'm sure, has a similar problem if we could calculate it. So certainly not a good place to be. All right, let's see what else is out there. Tesla seems to be a popular one. And TLT, I'll definitely look at that. So let's look at Tesla, because we need to do a little bit of trading here, don't we? I have to show you some 5-minute charts. All right. So Tesla is, you've got a big double top here. It's now confirmed that. Let me get my inspect tool out here so it'll be easier. So this was the confirmation line for that double top. It has confirmed that the minimum downside target, and I emphasize minimum, is the height of the pattern subtracted from the confirmation line. So we are not at the minimum downside target. And again, it's a minimum downside target. It doesn't mean that it'll stop there. But the height of this pattern tells me that we're going to probably see a decline that would test these tops, possibly these lows back from January. I'm not at all bullish here on Tesla. But let's go ahead and look at a 5-minute chart. Actually, let me make this a little wider. I think I can. There we go. All right. So the 5-minute here for Tesla, let's just do a few things here. So if you own that position and you felt bearish like I do, you'd want to know, well, when the heck should I sell it? That's when the 5-minute PMO turns over. So here's a sell point down here at about 155.25. We had another sell point come in here, and that came in at about 157.77. Currently, we're trading at 158.54, and the PMO is trying to turn up. So I would not be a seller at this point in time. What I would be watching for is the next PMO top. Now, you know that this price point is very similar to the price point of when we would have gotten out over here. So you could obviously make the choice that, well, I'm okay with, let's see, what's the difference here? I'm okay with a 0.3% decline here. So that would be a sell point right now. If you just wanted to go back to where the last sell point was, absolutely could do it. But let's say we were buyers back here. So here's where the PMO went positive. That would have been an aggressive entry. The conservative entry, we were on a buy signal, buy signal, buy signal. There's the RSI going positive. That would have been our buy point on a conservative basis. Our sell point, like I said, would have come in probably about the same place. So that particular buy signal probably didn't buy you a whole lot on the conservative side. But if you had got in on the crossover on the aggressive side, it still would have gotten you almost a percentage point. Not bad on an option trade. So those are some of the entries and exits. Here would have been the next entry would have been right here, PMO crossover, positive RSI. So that entry would have gotten you in at about 155.16. You could have sold it at this point, 55.16. And if you were a seller right now, you'd make 2% on the day. So not a bad system here. I find it's not perfect. If everything were perfect, I don't think we'd all be sitting here discussing this. So there are gray areas, but that's kind of the basics of getting in and getting out. But let's go to another symbol request, TLT. I'm going to show you this chart because it's already marked up. Like I said, in our DP alert, we cover all of these charts, not all at once, but these are the main things that we do cover. And TLT is absolutely one of them. So with TLT, we had actually been pretty bearish here on TLT. We've been expecting interest rates to continue rising, which means that would put downside pressure on TLT. That's what's happening currently. But if this decline that I think is coming up takes hold, bonds are going to see some action. Bonds and gold will likely see action because they're well-known safe havens. That's where people go when things get sticky and ugly, when the defensive sectors aren't even working for you. This tends to be where people will go. So at this point, because I am so bearish on the market, and I believe we will see bonds rise because of that. So at this point, when I look at the chart, though, I have to say we've got a bit of a problem here because that PMO is turning down beneath its signal line. The RSI has moved negative. Stochastics haven't completely topped, but they're getting ready to top. So if I didn't think what I do about the market, I would look at this and say, absolutely, this is going to test support, which I think it will do no matter what. Kind of head and shoulder-ish. So there's a good chance we're going to get that decline if the market doesn't do what I think it's going to do. If the market does what I think it's going to do, I don't think that we're going to have to worry about a big decline in bonds. For now, I would look for more consolidation until the market does what I expect it to do, which is move lower. So that is my look at TLT. Let's see, Apple, that's a famous one. I think most people want to see that. Similar situation. All right. So Apple, if I were to draw this in, and I'm going to just because I'm curious, rising bottoms. There we go. So at this point, Apple is actually in a nice rising trend channel. Yeah, it kind of went above that. So maybe in the shorter term, you could see it as a rising wedge, which is bearish. I would favor this. We're talking short-term trading. I would favor this over the other, which would mean a decline eventually, a breakdown of this rising bottoms trend line. This chart itself isn't looking that ugly, but it doesn't look like it's ready for a burst of speed to the upside, in my opinion. I think we'll probably test the top of this rising wedge, and that'll be about the time the market turns over, and then we're going to get that breakdown. And I would be looking for a breakdown to the 50 or 200-day EMAs. Stochastics are still unsure, so there might still be a little bit of internal strength left, which is why I would be looking for it to move up a little bit more and then follow the market or lead the market lower. But it is a good sign that Apple looks fairly healthy right now. That's good for the market because Apple tends to mega cap wise lead the indexes lower or higher. Right now, when we look at relative strength, the group is doing well in computer hardware. It's in a nice rising trend. So certainly looking better than the semiconductors right now. Apple has been doing great against the SPY, so it's definitely been holding leadership. And you can see that it is obviously a leader within its group, which doesn't surprise me. Like I said, it leads everything, being such a big mega cap. So my concern here is that we will see a breakdown. Now, if you're talking really short term, this does look bright enough to expect a move to the upside. Like I said, a tiny one, but I think we're going to ultimately see a breakdown here. If we were to look at that 5-minute chart, it's unfortunate I'm so bearish because I really want to help you buy stuff. And it's really hard for me to get in here and say buy. So you've got the last buy signal came in here, crossover, positive RSI. So you would have gotten in on this last bar right here. And if you had been even more aggressive and just gone on that PMO crossover, you'd have gotten in right about here. And when would the sell signal have occurred? Right back here. So up there, not a bad way to get out of that. Even in a day trade, that would have made you, even on the conservative side, probably would have gotten you about 1.3%, somewhere in there. So that would have been a pretty good move. All right, let's look at MGNX. All right, biotechs. Biotechs have been falling off the map relatively as far as relative strength. So I'm familiar with this because I held IBB and it was time to get rid of it. I believe my stop hit yesterday or today very, very quickly. So I know I'm not a fan of biotechs right now. So that's going to put some downside pressure on this stock just straight out the gate. But it isn't causing it a problem at this point. It's still showing relative strength against the S&P, and thankfully it's showing a lot of relative strength against the group. So it's not one that I would say no, no, no. The stochastics have just moved into positive territory above net neutral. RSI is already positive, and the PMO is now turning up. So this one looks very interesting to me. We have rising bottoms, kind of a flat top, and that is a ascending triangle. So what we would be looking for in this case would be an upside breakout. And it looks like we're on our way to that. If you go to the closing prices, it's actually having the breakout currently. So I'd have to say this stock looks pretty good. You're going to have a little issue when it gets to overhead resistance, which is about here, 9.5%. So that would still be a pretty good investment. I would be looking at a stop of about, well, that says 8.8%. That's where I'd really want to put it, is under the 200-day EMA. But that is a pretty hefty stop. That's really up to you. So I would probably be raising it closer to 7.5 toward these intraday lows. So that would be my stop level on this one. Now, let's see when would we want to get in on this one? Right about now. So right now you can see the 5-minute PMO is turning up. The RSI is positive. It's not a conservative entry yet, but this looks like a pretty good entry to me with the PMO, the 5-minute PMO turning up like it is on a positive RSI. You can also see the RSI has been positive all day, so that gives you also some confidence in a signal that would be just the turn on the PMO rather than the crossover. So I would say the buy point is occurring right about now. We'll see how that turns out more by the end of the day or even over the next day or two on trading, but that looks like your buy point right now. Okay, let us look at USO. Let's look at oil. This is also something we cover in our DP alert. So you're looking at the charts that our subscribers see. One of the things we do in the DP alert is we look at the same charts every day. And it sounds boring, but honestly, it's the best way to understand our indicators by seeing them and the changes they make every day. It gets you really good at understanding and reading our indicators because you see them every day. It makes us really good at reading our indicators because we see them every day. But seeing those small moves on those indicators every day really makes a difference and gets you a really good feeling about what's going on in the market in general. So that's why we look at the same USO charts. At the end of the week on Fridays, we do what we call a weekly wrap. So we look at not only the daily charts, but we also look at the weekly charts. And at the end of the month, we have a monthly wrap. We look at the monthly, the weekly, and daily charts in the same format as we do every day in the DP alert. So it's like a newspaper. It gives you all you need to know. If you don't have time to read about all those indicators, you can read our bias analysis, which is a paragraph. You can read our conclusion, which is a small paragraph. You read those, you've got all the news you really need, but you can go back and learn more by looking at the indicators and what we have to say about all of those. Now, back to USO, and I'm going to take a small sip of coffee here. Hold on. I could talk forever, so give me a mic and it's all over with. So we filled the gap on USO. You fill the gap typically means you're going to see follow through to the downside. I don't like what's going on with oil at all right now. I would say that $62 for USO is absolutely, I mean, I can't say absolutely going to happen, but really when you look at this chart, it tells me that more than likely that's what's going to happen. Now, if we get the turn before we have to tap the bottom of this trading range, that would be especially bullish and would tell me that we're going to get a rally. You can see that's what happened over here. It bottomed before it tapped the bottom of the trading range, and we did get a nice little rally out of it. That's kind of what I would be waiting for here. If it actually goes down and hits this level, I think we're really vulnerable to it to go all the way down to the 58 range. So I'm bearish on oil. I'm bearish on energy in general. If you're interested in an inverse ETF of energy, I found one called ERI, like the first part of my name. And that's a good way to play the inverse of energy, which I think right now is looking pretty good based on that PMO sell signal, stochastics falling. Really, nothing here is telling me we're going to get the rebound just yet. And currently it looks like we have a filled black candlestick, which is a bearish formation, a bearish candle. If we look here, like I said, let's say you own it and you want to get rid of it, you're going to want to hold it. It's not the time to get rid of it. Why? Because the 5-minute PMO is rising. It is getting on the overbought side, so I'd have my finger on the trigger. I would imagine if I could see it get up to this level, I'd be happy enough to get rid of it there. But I would want to watch and make sure that PMO is starting to turn over or pausing. If, at this point, if it pauses and I really wanted to get out and that PMO just sort of flattened out and I knew that price was right around here, that would be my sell point. Like I said, there is a little bit of gray area, but ultimately just using the timing of these buy signals with the sell signals is usually going to get you some sort of return. All right. Tesla. She was looking at Tesla. Let me see if I didn't totally pay attention to Melissa's presentation on Tesla. But let's look at Tesla. So you can see the big gap down here. You can see that price is moving lower. We actually looked at Tesla. I apologize. We already did that one. Let's look. Well, you wanted to look at energy. Let's look at energy. I have under the hood for energy. There we go. Sorry, again, I know there's a lot of white space, but we have to, in order to be able to put these in our blogs, we have to have them a certain size, so I apologize. Rounded top. I was already not liking energy when we got this PMO top. It was already telling me there are some problems. Looked like we were getting what I call a PMO surge, where you get a bottom above the signal line right here. So I was feeling more bullish, but if you look down, the silver cross has now started to top. We don't have the crossover yet to the downside. I would imagine we'll see that today, especially if we do have a down day for energy. Golden Cross Index has a drop below the signal line, but this is the key. Participation is just fully dropped off the map here. You need some kind of participation in order to reverse a downtrend like this, and we don't have it. And stochastics are also below 20, so it's very internally weak. We can tell that right here. And like I said, this was the big one. The silver cross is topped and is getting ready for a negative crossover. That generally spells trouble. All right, let's see, 9:45. I've got to be coming now to the end, and I do not want to get into anybody else's presentation. So I'm going to quickly go over to back to my PowerPoint slides here. There we go. So to find me and to follow my trading, I do have a free trading room on Mondays. I know, something free. So here is a free trading room that I do on Mondays. It's actually produced by Stock Charts TV. So if you can't attend it live at noon Eastern, you can certainly go and see the prior episodes on the Stock Charts TV YouTube channel. So you can find all of my past trading rooms. If you want to go in there, test me, see how I did, whatever you want to do, just get a more of a feel for what we do on Mondays. You'll find that on the DecisionPoint channel on Stock Charts TV. All right. If you like what I was doing, if you like what I do on Mondays, those who subscribe to my DecisionPoint Diamonds, where I do give you those stock picks, we have a subscriber only Friday trading room. It is very small. So I get to all of the questions, I get to every symbol request, and I show you how to do those entries and exits. Like I said, I want to teach you to do this for yourself and maybe one day not need me. So that's kind of what I'm trying to do. So Fridays is a paid trading room for subscribers of the DecisionPoint Diamonds. So if you want to try us out, I haven't said the price point yet. I will show you my website in just 2 seconds. So if you want to save 50% off your first month, just go to checkout any of our subscriptions, whatever you want, and use the coupon code SAVE50. That'll get you 50% off your first month if you're ready to just dive right in. If you want to just test us out, you can do a 2-week trial for free. DP trial 2 at checkout for that one. But as I said, I need to show you my website, or my person's going to be mad at me, my marketing person, who's in the back of my head because I am the marketing person. Okay, here is my website, homepage. Sign up for my free newsletter right here. That way you can get on the list. You'll hear about the trading room. You'll hear when I do these presentations like I'm doing today. And if you want to subscribe, here we go. And as I said, my price points, I think at this point, are embarrassingly low. But again, I want you to learn. I want you to get, I want people to learn what I do, because I want them to do it for themselves. And so that's why our price points are so low. So if you want just the DP alert, it's $50 a month, $80 a month for diamonds, 10 picks from my scans. And then if you want to try both of them, which we think you really need both, as I said, big picture analysis, drilling down, it's $119 per month. But as I said, if you look back here and we look at the coupon codes, there you go. Save 50 for 50% off your first month, and a 2-week trial if you want to use that instead. DP trial 2 will get you free 2 of mine. So now I'm done. I know I went a little over.
Hey, you know what? In a live event, I'm sure everybody understands, and we can run further and further behind. Somebody finishes a few minutes quicker. But
Yeah.
Erin, I want to say thank you for being here, the great information. I love the simple indicators you showed today, and I can definitely see how they improve entries and exits. Thank you for making so generous of an offer to our audience. Your insight of the market is incredible, truly gifted. And I just want to thank you so much for sharing everything you did today.
Oh, no problem. Thank you. I'm happy to come back.
Ladies and gentlemen, that's Miss Erin Swenlin, and you can find her at DecisionPoint.com. I put her website and the coupon codes in the chat box. Thank you so much for being with us today, Erin. We hope you come back and see us, and have a great weekend.
Thank you. You too.
Well, ladies and gentlemen, that'll bring us to our next presenter. And did I mention at the top of the show that we had a great lineup for you today? And if you trade options, then you'll want to listen very carefully to our next presenter, who is a professional trader, registered investment advisor, and commodity trading advisor. He's an active trader of his own account. He also manages option-oriented accounts. He speaks on option strategies at many seminars around the world. He's perhaps best known as the author of Options as a Strategic Investment, the best-selling work on stock and index option strategies, which has sold over 300,000 copies. He's regularly quoted in publications such as the Wall Street Journal, Barron's, Technical Analysis of Stock and Commodities, Data Broadcasting Exchange Magazine, Futures Magazine, TheStreet.com, and Active Trader Magazine. Ladies and gentlemen, here to present McMillan's Market Outlook, what option indicators are saying now. It's always an honor to introduce Mr. Lawrence McMillan of McMillan Analysis Group. Welcome back to Traders Corner, Larry.
Thanks, Bob. Can you hear me okay?
Loud and clear.
All right, great. All right, so we're starting out a little bit late, but we'll see if maybe we finish it early.
Hey, feel free to run a few over because the previous presenter that did. Sometimes I ask if you mind splitting the difference. If you finish early, so much the better. I'll send you a polite 5-ish minute reminder in the chat box.
No problem.
All right.
So we're going to discuss the current status of our indicators. It's interesting that we've just had a few new signals, but I would say overall the signals are still somewhat mixed. For those of you who are not familiar with our company, I started this company as a derivatives research firm in 1990. And originally we were doing publications, data research, that sort of thing. But then we had some success, or quite a bit of success, around the 2008 financial crisis. So we moved into money management at the request of some of our clients. at that time. And we've always had some option education abilities. We have a mentoring program, and then we do seminars like this. So I will come back to this later, but we are offering a special and the ability to download the PDFs of this webinar if you go to that website, optionstrategist.com/MCM-web. So the four main indicators we're going to look at are these, although we have a couple of other ones I want to throw in there as well. First and foremost, the chart of the S&P 500. I mean, if you're predicting the market, you have to, be able to be in agreement with that chart. If your indicators are all bullish and the S&P is going down, then the S&P is really the right indicator. We'll also look at put-call ratios, a very interesting and important area of option analysis. We'll look at market breadth, where we have an option twist on that, and then of course the volatility indices, including the newest one-day VIX index. So I have an important rule that oversold does not mean buy. So we are, for example, have an oversold condition and some overbought conditions too, for that matter. But just because it's oversold, the market can still go down. So you need to get a confirmed buy signal. And the companion to that, of course, is overbought does not mean sell. So the market, when it's roaring to the upside, gets overbought, but that's not necessarily a sell signal either. So here's a longer term chart, a 2-year chart of the S&P. The main thing I think to take away from this chart is that we're in a bear market from January of 2022 right here. And the question is, are we still in a bear market here? Well, we've certainly run up against resistance here in this 4,200 level. You can see it there, then again there, and not even quite getting to it there. We've fallen back from there some. So there is an uptrend line here that's working, but to me, this is still a neutral to bearish chart because of that resistance at 4,200. If we take a little bit closer look, a 1-year chart, you can see also that there's some pretty strong resistance up here at 4,300. This entire area inside this circle is what we call an island reversal. We gapped up into it, gapped back down out of it, and have not been able to fill those gaps ever since. So that's a major bearish signal when it occurs, and of course it led to this decline. But it's still hovering over the market there too. So even if we were to break out over 4,200, we still have to deal with this resistance here at 4,300. On the downside, we found support in December right around the 3760 level. That was the lowest level, but this entire area in here, 3850 down to 3760, that's a support area. If that were to give way, then we'd have some very negative outcomes after that. You can see that really starting in October, we've kind of just bounced around in this trading range between roughly 3,800 and 4,200, and we're still in that range. So we're getting mixed signals as we move around in that range, but eventually we will break out one side or the other, and that was when we will take a core position. So right now, we're looking at a close above 4,200 would be quite bullish, and a close below 3950 would be bearish. Longer term, it brings in that 4,300 level I just showed you and the 3760 level. But in between, you do have these strong oversold rallies in bear markets. So even though we're in a trading range right now, we're still getting some pretty violent movement. And as a result, we're not holding a core position at this time. We held a core bearish position for most of last year, but right now we're not holding that core. We're trading just the individual indicators as they occur. So in addition to just looking at the chart, we also do something with what we call the modified Bollinger Bands. And the reason they're modified is we use a slightly different definition of volatility. When John Bollinger invented Bollinger Bands, he defined volatility as the standard deviation of closing prices. Most of the mathematical guys, including Black and Scholes and who invented the Black-Scholes model, use a slightly different definition, which is standard deviation of daily percentage price changes. So we use that definition here because our work really needs to be in line with Black-Scholes. Otherwise, the implied volatilities of the Black-Scholes model wouldn't line up with the realized volatilities that we're talking about. So in doing that, we noticed that these bands can be drawn around the S&P chart, and they produce some pretty decent buy and sell signals. So here's the current chart of this, and this top band here is using that modified definition of volatility. That's +4 standard deviations, and then the next one is +3. The downside is -4, -3. So when we move outside of the 4 standard deviation and then back inside, we get a signal. So here we moved outside and then back inside. That was a sell signal in early February. It was a good signal, came down, and when we touch the bottom band here, that completes the signal. It was followed almost immediately by a buy signal, which we're still operating under right now because we have not quite reached the +4 standard deviation band. However, we have positions that we took there, we've rolled them up, made some adjustments and that sort of thing. So we've taken some partial profits. But right now, the 4 standard deviation band is there and the -4 is here. They've kind of tightened up some because realized volatility has declined in this market as we've moved sideways through this most recent trading range here through most of April. And we just now broken down on that on the downside, although today we're coming right back up into it. So in any case, these have been strong signals, and so we're still acting on that buy signal from March, even though it's a little bit aged at this point. And the we've had a long track record with this indicator in our daily strategist and option strategist newsletters. So we also offer this as a service, a separate service, where we look at these bands on any charts, stocks, futures, ETFs, that sort of thing. And we run that through tradingview.com. This is a picture of what it would look like. So this is the S&P 500. There's that buy signal that we're operating under now. There's the previous sell signal, and et cetera, et cetera. So you can see that it puts these little green and red arrows on the chart. This one here was a clunker. That was the blue B I had on the other chart, but the others have all been successful. And of course, not every indicator works every time, but you can see this is a sort of intermediate term indicator. It gives you a signal and then probably holds on to it for at least a couple of months or so. So the next thing we look at is put-call ratios, and put-call ratios were defined as an indicator by Marty Zweig way back in the 1950s when he was looking at put and call dealer volume in Barron's ads back then. Today, we use the equity-only put-call ratio as our predictor of the stock market, and equity only means that we're just looking at all equity options that trade, not futures or index options in this particular indicator. So Marty's theory was a contrary one. He noticed that if everyone was loading up on puts, the market tended to go higher. And if everyone was loading up on calls, the market tended to go lower. And it's still the case today. The trick is to define what's too much put buying, too much call buying. So just as a simple example, suppose we look at IBM at the end of the day, we sum up the volume of all the puts that traded. Separately, we sum up the volume of all the calls that traded, divide the two, that's the put-call ratio. So since our puts are in the numerator of this fraction, a heavy put buying will make the ratio go higher. But when are you likely to have heavy put buying? Well, that's when the stock is going lower, right? So the crowd, follows the stock path. Same thing with call buying. Since that's in the denominator of the fraction, heavy call buying will force the ratio to go lower as the denominator increases. But when are you likely to have heavy call buying? Well, that's when the stock is going higher. So the basic thing here is that the put call ratio moves opposite to the stock price. We keep a moving average, generally 21-day moving average in this indicator. So typically, in theory, anyways, this is what we'd like to see. We publish about 1,650 put call ratio charts on our website every day in an area called the strategy zone. And what you would want to look for in any of those charts is we publish the stock price along with the ratio, and you want to see them have this inverse relationship. In other words, suppose the stock is declining. And as that's happening, people are buying puts, forcing the put call ratio higher. Eventually, the put call ratio forms a local maximum, tops out. And that is a buy signal for the stock. Then after that, the stock starts to increase and value. Move over to the left here, so stock is increasing. When that's happening, people are buying calls, forcing the put call ratio lower. Eventually, you get to a local minimum on the put call ratio chart, and that's a sell signal for the stock. So that's the theory. If you're looking at a chart and it doesn't adhere to that, then perhaps some other sort of thing is going on there, including arbitrage or other distortions that take place. And so I always check out both the put call ratios and the stock chart, hoping not only to see this inverse relationship, but to see that the signals have been working. So this is a chart, not a current one, but on the top is the S&P 500, and on the bottom is this equity-only put-call ratio that I talked about. You can see most of the time this inverse symmetry exists quite visibly, and so that's why we use the equity-only put-call ratio to predict the broad stock market. So here's the current equity-only put-call ratio going back for about a year, and you can see that there have been a number of local maximums here on this chart. Those have all been pretty decent buy signals. And as as we pointed out before, this market's been in the trading range. But then we come down off of those and we form local minimums. We get sell signals. So what just happened is we just got a brand new sell signal, really confirmed as of yesterday. So this will be in effect now until the ratio turns back over at some point and makes a local maximum again. So this sell signal is in effect. I don't know if we're going to come all the way back up to here, which we've done the last 3 times, but it seems like that's certainly possible. Now, as computers came along, we were able to calculate another put call ratio, this one using option prices and not just option volume. So we calculate for each particular option. At the end of the day, we multiply the option's price times the volume traded that day, and that gives us the dollar volume. Now you could do that on a tick by tick basis, but we are just using on a closing basis. It turns out, at least with our analysis, to be very similar. So we make this calculation, let's say at the end of the day for each IBM option, we sum up all the those dollar volumes for all the puts, and then separately we sum them up for all the calls, divide the two, and now what you've got is the weighted put call ratio or dollar weighted put call ratio. In a sense, essentially you're measuring the dollars being spent on bearish opinion versus the dollars being spent on bullish opinion. And that turns out to be, gives you signals at about the same time, but they can be more extreme. So you see, for example, that we had some really extreme selling, generating a lot of put buying and creating these high ratios back here in last October and again in January. So those 2 rallies were very strong. Now we did get a local maximum here again in mid-March, but it was much lower on the chart. And typically that leads to a less strong rally, but it certainly was not a bad rally. And now we've just again come down and made a new local minimum, and you can see this local minimum is down here at the very bottom of the chart, meaning there's been some heavy optimism forcing, the call buying has forced the ratios to very low levels, and those are typically the better signals. So we just got a new sell signal here on this chart as well. So very little else to say there, except that historically these are very strong signals, and we have a long and profitable track record in the Option Strategist newsletter, which you can look at the results of our trades there on our website. So what do we buy when we have a signal, you know, a put-call ratio signal or the MVB signal or any of these things? So primarily we want to buy an option that's going to respond with the underlying movement, the underlying in this case being the S&P 500 or SPY. We're usually trading SPY options. And so the delta of a call option ranges between 0 and 1, indicating its percentage movement along with the stock. So if it's 0, the stock goes up and the option isn't even moving. Those are typically very far out of the money options or ones that are about to expire out of the money. On the other hand, a deeply in the money option will have a delta of 1. In other words, it tracks right with the stock. So we want to buy an option that has a fairly high delta. You don't necessarily need 1, but we want to, I don't want to be wrong on the option and right on the stock, on the underlying. If I'm predicting the underlying, which is what I'm attempting to do with these put call ratios, then I want to make sure that the option I choose is going to move along with it. So we buy an in the money option, typically with a delta of about 0.70 or higher. That's 1 or 2 strikes in the money, usually a month or so out. If we're using a little longer term thing, say a longer term put call ratio, then I might buy an at the money option. But even an at the money option has a delta that's greater than 0.5. And so that's going to move along with the stock quite well also. So you see on TV a lot of times with the option shows or whatever, they're using spreads all the time. By a spread, I mean you buy, if you're bullish on the stock, you buy a call at a low strike, and then you also sell a call at a higher strike. What that produces is this profit picture. In other words, you have limited risk because you can't lose more than what you spent. And then in between the 2 strikes, you make money. But as soon as you get to the higher strike, that caps off your profit. Well, that's a pretty devastating thing to do to yourself, to cap off the profit like that. In fact, statistically, it only makes sense to do that if implied volatility is very high. If it's average or low, and we publish a lot of implied volatility statistics on our website, including a comprehensive free volatility file every Saturday. But paying customers can see that information every day. So what we're really looking at is a comparison between this red line, which is the call purchase, and the black line, which is the bear spread. So why would you want to cut off your profit potential? Well, typically, the proponents of using this spread will say, well, you're risking less. But that's a fallacy. You're risking 100% of what your broker requires you to put up to buy these positions. So if you buy a call, you have to pay for it in cash. You're risking that all, or you're risking all of that. So if you buy a bull spread, again, cash, the difference between what you paid for the call on the low side and what you receive for the call on the higher strike. So if you lose, you lose 100%. So if you're trying to balance dollars, well, then just instead of buying, let's say 5 bull spreads, buy 4 calls or something like that. But the risk is also always 100%. And of course, your profits are much greater if you don't cut off your upside. Now, if you do use a spread, there are some things you can do to help mitigate the problems. One is to spread the 2 strikes farther apart. And we do that with our SPY positions. In calls, we typically spread the strikes 15 to 20 points apart. With puts, since puts are more expensive than calls on a relative basis for SPY options, we spread the strikes farther apart. So I said, well, we just had a new sell signal, so we were spreading this. We did a June spread, a little more than a month out. And we spread the strikes 30 points apart. In addition, you can mitigate further the problems of the spread if you used one, if you roll when the short strike is hit. So let's take this example. Suppose SPY was 397 and you put on a SPY call spread 397, 412. Oop, I see that that says Feb. It should say May as it does on the next chart. On the next chart was the May spread we bought, and now the SPY rallies to 412. So now you've reached your upper strike. From here on, you're not going to make much more money on the upside. So you sell that spread and you buy a new one, assuming that you still want to be in a spread, And again, you keep the expiration the same, you keep your striking price distance the same, but now you've moved higher. So you took a profit on the first one, and now you're in the second one. And again, you can continue to do that over and over, and as long as the upper strike keeps getting hit. Anyways, let's look at a couple of individual put call ratio charts. These are we do recommendations on stocks, indices, futures, etc. These are just a couple of recent ones. This was Honeywell, and Honeywell is well, any of these stocks are individual put call ratio charts. We only use the more extreme signals. So this one in the middle here, we didn't really use that. This one in the middle, we don't really use that. Even this one, we're looking for the extremes. The extremes we define on a percentage basis. But in this case, we had a buy signal here, which was modestly successful. This one was a little better. This one was even better. And now we've got a new one just here recently, a couple of weeks ago. On the downside, the extreme signals were this sell signal here, which was did pretty well, and then this sell signal here, which also did pretty well over a longer period of time. But right now, we're in a buy signal in Honeywell. Similarly, NASDAQ, the NASDAQ company, NDAQ, had a recent buy signal here as well, just around the 1st of April. And what we do on many of these cases is we look for a breakout over a technical level, which we got there as well. And we can do the similar thing with futures options. In this particular case, the put call ratio chart down here is drawn using corn options that are traded on the Chicago Board of Trade. And so that gives us our local maximum, local minimum, etc. We just recently had a local maximum there, so that was a buy signal. And this chart here is the continuous chart of corn futures. But if you don't have a futures account, or even if you do, in many cases, there's an ETF that trades that has that tracks the price of the future. In this case, there's an ETF, CORN, which is corn, of course, and it tracks the price of corn. So we're long options on corn, the ETF, and not long options on corn futures on the Board of Trade. Obviously, you can trade either one, but a lot more people have regular stock accounts, so you can trade the corn option, CORN, rather than the futures options. The next indicator we look at is market breadth, and this is simply the advances minus declines on any day. There's a couple of things you can do with that. One is you can keep a cumulative total, which is modestly useful, but typically really only comes into play after a long bull markets. Or you can keep an oscillator, which is much more useful on a day-to-day basis. So the oscillator we define is defined this way. Our oscillator value today is 90% of yesterday's oscillator value plus 10% of today's advances minus declines. Now, the problem becomes a little bit more complex when we consider the fact that, New York Stock Exchange advance decline data is the typical mainstream advances minus decline. The problem is that there's things that are on the New York Stock Exchange contributing to the number of advances and declines, which are not stocks. So we want to also look at what we call the stocks only data. And we realized a number of years ago, more than 20 years ago actually, that we had a great data set here right under our noses, and that is all stocks that have listed options. Nowadays there's almost 6,000 of those. It might even be more than 6,000 now. So that's a pretty strong data set, and it includes, of course, large caps, small caps, over-the-counter, New York stocks, everything, and they're all stocks. So this is the oscillator value going back to 2013, so 10 years actually. What we define here is if the oscillator falls below minus 400, it's oversold, and if it rises above plus 200, it's overbought. Well, for 9 years of those 10, we were in a pretty much a big, long bull market, so we didn't get oversold too often. We did here, this was 2018, right around Christmas time. Of course, this was the pandemic in March of 2020. But then last year we entered the bear market, and so we started to get oversold much more often. Now, as I said at the beginning, oversold does not mean buy. We wait for it to stop being oversold, say here, before we buy. So we had a sell signal here in April as we came out of an overbought condition, and now we're oversold. I haven't really looked at breadth too closely today, but if it pulls it back up above the minus 400, that would give us a buy signal on the breadth oscillator. So this is one oversold indicator that we have right now. It has not confirmed a buy signal yet, but it eventually will. It can't just hang around down here forever. So when it moves back above minus 400, that will give us a buy signal from this indicator. So this just sort of summarizes that, pretty much everything I just said. We have that sell signal there, we operated on that, and now we're oversold and we're looking to get a buy signal somewhere in the near future, perhaps even today. Another thing we'll look at is new highs versus new lows. This doesn't really have much to do with options, except for the fact that we do over 3 data sets. So we look at New York Stock Exchange data, which is the first 3 columns. We also look at stocks only data, that's our optional stocks. And then since it's published in the news, in the newspaper, well, not the newspaper, but online in the data sets, NASDAQ data. So you can see here that just the last couple of days on New York data, we started to see more new lows than new highs, and by enough of a margin that there are more than 100 new lows than new highs. So that is a sell signal. You can see, though, that these other data sets have been much more negative for a while now. So even though the market itself was up around the highs of this trading range recently, mid-April, new highs, new lows were not sharing in that, that optimism. We're seeing a lot more stocks making new lows than you might expect, with the market making a new, well, essentially relative, new to the relative high for the year. Finally, we look at VIX and the VIX tradable securities around VIX, and we have several indicators built into that as well. These, I will tell you right now, are mostly positive and have been for a while. But the first indicator that we look at is the trend of VIX. So whichever way the VIX is trending, most of the time the stock market will trend in the opposite direction. So that's an important indicator. Number 2, we look for spike peaks in VIX where it comes up, spikes up and back down again. Those are typically buy signals for the stock market as well. And occasionally we get the situations where VIX is quite low. It's debatable here recently when VIX got to 17, is that low or not? We'll talk a little bit more about that in a minute. But back in, like, say, 2020, or even 2019 more likely, VIX was all the way down to 14, even sometimes 12. And so that is an overbought condition. But as we've always said all the way along here, overbought conditions are not sell signals. You have to wait for VIX to rise before you actually get a sell signal. So here's the current chart of VIX going back about a year. And all these B's on here are spike peak buy signals. So the red letters are successful ones. We had a nice one here in mid-March where we caught the lows pretty well. And these signals last for a month. So that signal has terminated and has ended profitably. The previous one to that was last October, and that ended well too. However, right before that, we had a few false signals. So the false signals are marked here with blue letters. So overall, I can tell you, going back over a long period of time, these spike peak signals are quite successful in the aggregate. And we have not had one here yet, even though that looks like it might be a spike by the definition that we use for this system. That is not yet a buy signal. Then we have, so I said also, so that's one signal. The other is the trend of VIX. And the trend of VIX is defined by where the 20-day moving average is, and VIX, those are VIX bars, with respect to the 200-day moving average. If both VIX and the 20-day moving average are below the 200-day, that's a trend of VIX buy signal. So we got a buy signal right there. In March, when VIX moved up here, that terminated that buy signal, but then it became back into existence right there, and we're still on that trend of VIX buy signal, and we will be on that until VIX closes above the 200-day, which is up here at 23. That's probably, that might happen, but to get the 20-day all the way up there, that's going to be a chore. So this is a bullish indicator back right now. So people have been saying, well, what, VIX is 17, is that too low? But you have to understand, realized volatility has dropped a lot in this market. So we look at the 20-day historical volatility of SPX, which we call HV20. HV20 got all the way down, well, less than 10, and VIX was 17. That's a big difference. And VIX can't really go much lower with realized volatility being all the way down there. So VIX can't go much higher with realized volatility being all the way down there. So this has begun to increase. We'll see if this increases as well. Another thing that's important, you can't trade VIX, but you can trade VIX futures, of course, and VIX options, which are based on the futures. So in this particular market, we're in a bullish situation. In other words, if we look at the term structure of the VIX futures, when they slope upwards as we go out in time like this, that's bullish for the stock market. In a bearish market, like we most certainly had in March of 2020, the term structure of the VIX future slopes downwards, and that's bearish. So I said right now we're in a bullish state. This is actually prices I took for right about noon today, and at that time VIX was 1736. The closest term future was the May futures, 1925. So 1925 minus 1736 is $1.89. So they were trading at a premium, and you can see if we look out the futures here, they're going up, sloping upwards out to about here, and it kind of flattens out after that. So the term structure slopes upwards in the front end, and that's modestly bullish, and all the futures are trading at a big fat premium to VIX, because that's, as I said before, realized volatility is much lower than historic, and so than VIX. And so we have a upward sloping term structure with positive premium on the VIX futures, and that's all bullish for stocks. The CBOE publishes now 6 volatility indices, used to be 5, but now they've added a new one, the one-day volatility index. The symbol is VIX 1D, 1 day. And you can see how these stand. So typically, a one-day volatility is going to be lower than anything else, even though it seems like market's crazy over one-day periods, and people have been all excited about the 0-day to expiration or 1-day to expiration options. But you can see here the term structure pretty much slopes upwards, except for this. The 9-day volatility index is higher than the 30-day, which is VIX. Why is that? Well, we have the FOMC meeting next week, and also unemployment figures coming out on the first Friday of the month, which is next week. So that's all within the 9 trading day look forward period. And so some volatility is built into those options because of that volatility. Those events could be volatile, but again, mostly bullish, mostly sloping upwards. And so the term structure and all these VIX indices right now are pretty much staying bullish for stocks. If volatility were to begin to increase here, then we would start to get sell signals. That doesn't seem too likely from this set of indicators right now. But the number one thing we watch for in that regard is we watch the front month futures versus the second month. And the front month is now May, as you saw in the previous chart, trading at 1925. Second month is June, trading at a big whopping premium over May. If May were to rise above June, that would be a dangerous sign. But right now, no danger at all from this what we call term structure or volatility construct. So in many years when we had flash crashes or pandemic 1 month crashes or anything, we would get these term structure inversion sell signals. That did not really happen during the bear market of 2022 to 2023. And as a result, some people are saying, well, the market's not working right, but it is. It's just that a slow grinding bear market doesn't really have the volatility of a crash. So here's a summary of the indicators. You can see on the plus side, we've got that McMillan volatility band that we talked about earlier, and then the volatility VIX indices. On the negative side, well, the chart of SPX isn't really so bearish, it's just neutral with that trading range, but we have sell signals from the breadth oscillator that might reverse soon. And then we do have a new sell signal from new highs versus new lows, and a new sell signal here. So bottom line, the signals are mixed, and we trade them individually as they occur. We are not trading a core position at this time. I'm going to really need to see this market break out over 4,200 or probably below 3760 before I take on a core position, which means you take an aggressive position in that direction and then trade other signals around it. Just one quick thing here. There has been a realized volatility sell signal. As I said, the historical volatility of SPX fell low and now it's risen back up a bit. The crucial level is 10. We haven't had a signal from this indicator since late 2021. We had one there was stopped out, we had another one stopped out, but then we had the very important one there in December of that's 2021, which preceded the entire bear market that unfolded. Now we just got another one. The historical volatility dropped here and went back above. That's a sell signal unless it falls back down here again. So we'll see, but this is a sell signal for historical volatility. Implied volatility, meaning VIX has not joined in with that yet. I mentioned we are offering this special offer here. It's pretty simple. You can go to this URL and download the PDFs of today's webinar. And what you'll get in that, the special is a 6-month subscription to the Option Strategist, which comes out every week. You'll get the 14-part intensive home study course. Each of those is about an hour and a half in length. They were all recorded within the last year or two. And then you get a copy of the Bible Options as a Strategic Investment, and also a consultation regarding money management. So we do have other newsletters. We have a YouTube channel. If you're interested, visit our website, take a look at those things, or search for us on YouTube. And just one final chart. This is the 73-74 bear market, which I think the current bear market resembles. We started out from an all-time high. We came down for a while. We had a pretty good rally. Then we went back down, and it messed around for a while in a trading range. Eventually it broke down when Nixon resigned, and we had a very bad drop during the fall into an October low, and that ended that bear market. So where are we on this chart? I think we're about right there. We're somewhere in that trading range area. You know, what could force us out on the downside? I'm not 100% sure, you never really know, but it could certainly have something to do with the debt ceiling, further tightening of interest rates, etc. Anyway, that's our information there. If you're interested in our money management, that's a URL to go to for that as well. So let me turn it back to you. I'm just a couple minutes over.
Hey, thanks so much, Larry. As always, that was incredibly valuable information. Ladies and gentlemen, that was Mr. Lawrence McMillan of McMillan Analysis Group. And as William pointed out, we refer to Larry as the E.F. Hutton of options traders here on Traders Corner, because when he is speaking options, it is a real good idea to listen. I guarantee that you will learn something. Keep up the great work, Larry. I was waiting all day to listen to your perspective on the current environment. And let me tell you, I've been agreeing and profiting from the fall the last few days.
Okay, thank you.
Hey, please come back and see us again. You can find Larry at optionstrategist.com. I did put his link in the chat. I see he did as well. Have a great weekend, Larry.
All right.
Ladies and gentlemen, this is Traders Corner Stocks and Options Special Event. And up next is an extremely well-known pioneer of online investing and trading. Back in the day in 1994, he began the first fax letter to educate investors and traders on how to be active and self-directed in the markets, as well as delivering his trading recommendations. He's authored best-selling books, Trading Tools and Tactics, Reading the Mind of the Markets, Intraday Trading Tactics and Tools, and Tactics for the Master Day Trader through his site, mastertrader.com. He continues to teach investors and traders to be master traders. Ladies and gentlemen, here to present Master the Art of Technical Trading, it is my distinct pleasure and honor to introduce Mr. Greg Capra of Master Trader. Welcome back to Traders Corner, Greg.
Thank you, Rob.
Very welcome.
All right. Rob, how much time we got? Just
it's a 45-minute slot. I know it's a few over. You know, if you want to take the full extra 4, if you could split the difference, you know, whatever works. Okay. And everybody understands this is a live thing.
Got it. I do my best. All right. Thank you for inviting me again, and welcome everybody. So let's get right to it. So as it says, my focus is remove the mystery from technical analysis, and I'll tell you exactly how we do that. A little bit about myself. As Rob said, I started back in the late 1980s, knew absolutely nothing. Probably many of you in the room know a heck of a lot more than I did when I started out. So it was a long journey. A lot of it was trial and error, was quite difficult. There was no internet, phone modems, 286 computers. It was archaic compared to what it is today. I said what was a fax letter at one time, hotlines, 800 numbers. I mean, things have just come light years from when I first started out. Chat room without being able to talk. Can you believe that? We had to type, my goodness. Eventually opened up offices, did seminars around the country, different countries, sold all of that stuff. It says way back in 2015. I used to do the trader expos and trading challenges and stuff. It was lots of fun. They eventually became pretty much a display for brokers and software. So haven't been there in quite a while. Taught so many in this industry, some of them which I thought were gods, hedge fund managers and market makers and specialists. You know, when you're starting out, of course you think, well, they must know everything. You've come to find out they really don't know very much about technical analysis, mostly all order flow. So they got a bit of a heads up. But, you know, eventually as technology improved, we began kicking their butts back in the day, called SOS bandits. And it was through what was called the small order execution system. And things evolved tremendously over the years. And this is, I've taught prop traders, retailers. A lot of my students run education companies today, or maybe they work for one. It's a testament to the good job that I've done over the years. You can go read some of the companies and students on my website. You can go check that out, read a little bit about myself. I did several books, a lot of information. Back in the day, Traders Expos, this was the first one, 1999. That was me in the middle, the booth, training, trading, and technology. We called the 3 T's, T3, and that was what we call the pristine day trader. And that's where we started out, was a fax service that sent out a fax, not regular paper. It was back in the day with the thermal paper that used to come out of those machines making funny noises, and had a couple of picks and a little bit about the markets, and at right time, you know, and things kind of just took off from there as the internet imploded to the upside at the end of 1994 and the beginning of 1995. At one time, Master Trader was a brokerage firm, and but you know, all the big brokerage firms, the Fidelities, the Schwabs, the so-ons, that were telling everybody, stay away from those day traders. You're going to lose all your money. Well, they realized we weren't going away, and they came in and bought up the industry. And I eventually sold the accounts, and gave up my licenses. That was a handcuffs kind of thing off, you know, having a license and being in the business of education. Everything you have to say and do has to be approved. So my approach to education and trading is what I called thought building lessons, rather than using say, indicators to tell me what to think, I use technical analysis. And the way I see it, technical analysis is broken up into different segments. Candlestick language, as I call it. Candlesticks communicate to me as to you. They create pictures. By themselves, they don't mean much, but as you start putting it together in relation to support, resistance, if you choose to use a moving average, or to volume retracements, bar by bar analysis. Many people know, what is bar by bar analysis? Well, as I began to learn about trading and the markets and patterns, there came a time where I was basically scared to death. It's like, okay, there's a red bar, that's bad. Well, was it really bad? And you'd sell, right away. It's like, oh, something's bad's gonna happen here. So it became a way of keeping my emotions in check and saying, okay, does this bar really mean anything? And maybe it did, maybe it didn't. And so putting that in the context of what preceded it, since, support, resistance, and so on, it became much more than what I originally thought it to be. It became a very powerful concept. Now, market internals, intermarket analysis, as time went on, I came to realize that price patterns by themselves were limiting. Well, why? Why does one pattern act one way and another pattern, which my perception was the same, act very differently? And it was based on what's happening in the broader markets, in a particular sector, relative strength and weakness, multiple time frames. That was a huge one. And failed patterns, study of failed patterns became a very big part of the method. Now, the money management part and trader psychology, these two things are joined at the hip. You cannot have proper trading psychology without proper trading management. It's not possible. So this is a key part of your success, and we all focus very little on that proper money management, I would say, until we start experiencing some nasty losses. And, we stop swinging for the fences. I mean, I did it at the beginning. It was all about, I'm going to make all of this money. I had little to no fear, which was dangerous. I was dangerous to my own well-being. But you come to learn, you don't make it in this business without proper position in money management, which is tied into your psychology, which you might think you need a therapist. What you need is money management. We'll get into that. We get a little humorous about that, but the truth is money management is a key. It will free your mind from so much if it's done properly. You got to prepare. And this is all part of, a course that I teach, a swing trading course or the full MTM course, and then we review everything. So let us continue. One thing about this platform, Rob, that I would say different from Zoom, if you so entertain it, is for me to change slides, I got to go away from that little red dot, which with the Zoom you don't have to. But
I'm not sure what you mean. I'd try to offer you help if I could, but I'm never the presenter.
Yeah, well, that little red dot is helpful for those viewing. And when I got to switch back and forth, it's an extra second. But anyway, little thing. So we got to build a mindset, and proper trading is proper thinking. And how do I do that? Well, I have to build a method. So that one concept that I showed you, it's not a trading strategy. You might hear, oh, here's a dark cloud covering. You learn about candlesticks or a piercing pattern. That's not a strategy. You have to determine, is the trend up, down, or sideways? And that's easy to do. Without all of the trend lines, fib lines, VWAPs, and so on and so forth, Elliott wave, all of that is what I call brain damage. It's just not necessary. I'm not telling you I didn't take the path of utilizing some of it, but I found that it just didn't lead to the riches that I thought it would. And the Holy Grail concept revolves around a sure thing. And that type of analysis is, okay, if I get all this down, I'm going to have a sure thing. And so know where support is, where it doesn't mean I'm going to do anything. recognizing support and resistance is one part of the trading plan. So as we combine that, and we create a trading plan, now we know when we can act. We never act on one concept by itself. You don't. All right. Let's continue. So tradable patterns can form in endless ways. So when I hear about, say, a head and shoulders pattern or a flag or whatever the pattern is, because human nature wants to be secure, we want to see the same thing happen over and over again. And the world of trading doesn't operate that way. So we need to add some flexibility to the trading plan, which kind of defines if this, then that, which you do need. But the world doesn't operate that way in a box that it's just going to be that way every time. So we need to understand this in a more flexible way. So technical concepts and strategies here, they're going to put the odds in your favor. You're going to think, what is your objective? Some of you here might be thinking, oh, I want to, for my retirement account, or you're going to be a swing trader. Some of you are going to be day traders, and you can do multiple things, but you got to do it properly and keep them in their own world, so to speak. The main difference is the time frame that you're using. And so if I'm going to be a swing trader and I use weekly and daily charts, that is my world, so to speak. If I'm going to be a day trader, I have to pick a time frame that I'm going to operate in and use, in my point of view, another time frame to get my bias from. Now, what you trade is up to you. There's no best instrument to trade. And what is best at one point, a few months later, can be, you just don't want to go there. It's just too erratic. There's no certainty in that particular market. So there's a lot of focus on Forex, and a lot of traders focus on that because they can trade these micro contracts, or it trades 24 hours, and those are advantages. But Forex isn't always the best market to trade. Sometimes it's stocks and futures, and some of you maybe don't trade stocks because the day trader, pattern trader rule, I get all of that, but you can trade futures. You don't need to take a test, but they have their own idiosyncrasies. So there is no best trading vehicle. Let's get that out of our minds that, hey, this is the best thing, and if I can trade that, I'm going to make money. One thing, as I said, could be the best. A few months later, you're just going to bang your head against the wall. All right. Building that mindset. We've all heard confidence, patience, discipline. And you hear that being said. Please tell me how to do that. Don't just give me the words. Well, how did I do it? I had to get rid of, reduce, eliminate what was subjective. To me, that was indicators. I had to get the indicators off the charts. I even had to take the horizontal lines that connected whole and half numbers off the charts, because that got in the way of my thinking. Oh, it'll stop at that line. Oh, it's going to stop at that line. Before I knew it, I was terrified to press the button. And analysis paralysis. So you have to eliminate a lot of information and accept you can't know everything. It's impossible. There are, giant institutions that hire 14 analysts to tell them which way the market's going, up or down or sideways, which is kind of ridiculous in itself. But we need to reduce it and operate in a world that we can operate in with not knowing everything that could possibly need to know. So we need that systematic approach. We build a thought process, and that builds confidence, where you get that experience in a market where the environments change. Sometimes as a day trader, from morning to afternoon, or from Monday to Thursday, or sometimes from 1 month to another. Let's simplify candlesticks. Let's just forget about the names and just think about momentum increases and it decreases. Is it a big bar, right? A wide range bar? You might say, well, how big, Greg? Well, relative to what you're looking at. If you're trading a $2 stock, a big bar could be $1. If you're trading Amazon, it could be $6, $8. So it's relative. It's visual. You'll see it. It's big. That's power. It's a power bar. Power up, power down. Bottoming tails and topping tail bars. They come in different varieties. Smaller ones, narrow ones, or big ones. I'm primarily interested in the big ones because big ones mean that prices traveled a long way. Most likely institutions, big money moved it. So the little ones are slowing momentum, narrow ranges. They don't mean a whole heck of a lot unless they came after a big one. And this is how momentum begins to slow down after a few big bars, or they might consolidate. So we just want to understand the simplicity of candlesticks in that this is power up, this is power down. This was a reversal. It says sellers took control, buyers took control. Where did it happen? Was this at support? Was this at resistance? Was this after it retraced up to resistance, or this retraced down to support? Did you get a bottoming tail bar that broke below a base? If I was to drag this and put it over here and it was in an uptrend, maybe you're starting to get where we're going with this. It really comes down to common sense. So here are four what I call foundational patterns. You have retracement patterns. Prices pull back. Is it in an uptrend? Did this drop sharply maybe? Where I don't use terms oversold and overbought because to me they are misleading. Oversold gets more oversold and vice versa. But if prices get extended, which meaning they just traveled really far on a relatively short period of time, they could bounce. That's logical. Now, maybe this bottoming tail bar goes over here. You're starting to understand bar by bar analysis, putting that together and what this means and the location, retracement up to resistance, retracement to support. Retest and failure patterns. Well, if it made one reversal and it retests that area, that means that there's been more time of consolidation. There's been more individuals or institutions that are partaking in the accumulation of what's happening here on a retest. So bigger patterns have bigger implications. Simple. What is a flag pattern or continuation patterns? Well, sometimes prices don't pull back, even in an uptrend. And sometimes prices will then pull back to an area of support. But when they stay up there, that means that demand is strong. And while we would be looking, hey, if this pulls back where it's now cheap or cheaper, and I perceive that to be a good entry point, someone else thinks, you know what, this is too darn good and I'm buying it. So flag patterns are bullish patterns that create support and bearish flags create resistance. And then there's bottoming bases or topping bases where we buy breakouts and breakdowns. These are four foundational patterns that we see all the time. Now they come in different variations. The way I drew them can happen different, but if you apply this bar by bar analysis, you're going to figure it out what it is. You don't have to know any names. I don't have to tell you, hey, this is a master trader flag, or whoever else makes up their own name for something. You apply what I'm telling you and you'll figure it out. So support and resistance and trends. What's an uptrend? We all know that. Higher highs, higher lows. What's a downtrend? Lower highs, lower lows, and then there's sideways trends. Well, how wide is it? Is it swinging high and low? Is it creating support and resistance so that I clearly can see that an area has been created and then a retest and a retest. So this is becoming stronger. This is what the market is doing right now in a big, wide trading range. You've got trading ranges within trading ranges, which is a massive amount of indecision. It's schizophrenic, this market right now. It goes from, I'm terrified and sell everything to, hey, You know, things are great again. It's 1999. Buy it all over again. And so that sometimes flips from one day to the next. But in an uptrend, we define areas that we call minor support and major support. Well, what's major support? That's the low prior to the higher high. Now, as we start talking about retracements, Dan and I, my partner, we did a whole thing on retracements yesterday. We do a Wednesday event every Wednesday at 12 o'clock, and we talked about retracements. If you're interested, email me and I'll send you the link to it, or I could possibly drop it in here now. Anyway, as we talk about retracements, common sense tells me that if this is strong, it's going to make a higher low. And the deeper it retraces, the weaker it's getting, but there's going to be buyers down here because that's where they were before. So again, we're building that thought process. Let's clean that up. I don't want to go over my time, so bear with the speed that I'm going here. So we have to create biases. Right? Let's call what we call a macro time frame. That's just, where am I going to get my bias? Well, what kind of trader are you? Are you a swing trader? I would suggest you use the weekly time frame. And this blue line, this is your weekly time frame, and it's sloped up and going higher. I assume it's going to continue to go higher. Now my lower time frame, micro time frame, would be my daily chart. And if I want to zero in, if I want to look at intraday charts, I don't have to, but I could go down to a 60-minute chart and see what's happening there. The idea is this ebb and flow, call it waves or whatever you want. It's just going up and it pulls back. Well, when it gets up here, traders think, oh, it's too high, or let me take some of my money. And now it pulls back. We're building our thought process. Pull back to where, Greg? Well, minor support. That would be a good spot. If it pulls back to major support, the retracement is pretty deep. And while it's likely to go up, it becomes unlikely it'll take out the high. That's a thought because it shouldn't have went down there. Uptrends make higher lows and higher highs. And as prices begin to accelerate, sometimes momentum begins to slow down. I don't need indicators to measure slowing momentum. I just look at the distance between the highs. When momentum is strong, the distance grows. There's power. When the power is beginning to wane, the highs get closer together and the retracements become deeper. This is all common sense, but someone has to show you the common sense before you realize it, because you've been inundated with the indicator-based methodology, which has really screwed your head. It did mine. So we want to be buyers at these areas of support. If I'm a day trader, I'm going to use the 60 and or 30-minute chart for my macro time frame, and my micro time frame of choice is a 5-minute chart. Okay. Let's continue building. So here's an example of what I'm talking about. Prices, we're in a downtrend. They begin to move up. And look at that bar right there on volume. I imagine everyone would be thinking, most everyone would be thinking that looks at a candlestick chart, that's going to go down. That's a big, nasty red bar. Well, it didn't. Why didn't it? I don't know. Maybe the higher time frame, I don't know based on this chart, but obviously things were turning around here, and that's a very powerful message, where a big wide power bar on volume didn't follow through. And then it took out resistance. Okay, build a thought process. What was resistance, right? That was resistance, should become support. As it begins to pull back to that area, it doesn't have to be an exact point. Apply candlestick analysis. Call them what you want. I see a red bar and a green bar and a red bar and a green bar, and it's at this minor support. That tells me that buyers are stepping up. I would have loved to have a bottoming tail bar there that broke the lows and sprung up, but it doesn't always set up the way I want. But my thought is that in this area that buyers are going to step up again. And we continue with that process. So if it's in this area, I believe it's going to go up here and take out the high. That's a belief. We're going to see what's going to happen. I don't know how it's going to act when it gets there. Look at that bar. Oh, that's going to go down. It didn't go down. Demand must still be strong. And we continue with the thought process. Now it pulls back to major support. Oh, that's not good, based on our discussion. But here it gaps down. You see here's the red bar with the close, and then this one gaps down, and you get a big range expansion bar, a wide range bar. Buyer stepped up relatively aggressively. Not big volume. I found many times you don't need big volume to move prices. So this candle in this area tells me that there's strong demand. And we just continue the process. All right. Another example. Here we have a rounding type of a bottom on the left side here. Right? Look at, I've got a couple of moving averages. That's how I set up my daily chart, 20, 50, and 200. You might say, well, why? First of all, they're simple. That's what the S is for. 50 is equal to the 10 on the weekly. So that's the green line. If the 20 is going up and the 50 is going up, that means the daily and the
Hey, Greg, did you accidentally mute yourself? Greg, can you hear us? I've lost you, and everybody seems to not be getting the audio through. Sorry for the interruption again, but Greg, would you double check that your microphone or headset or whatever it is you're using for audio didn't become unplugged or not functional? Pardon the interruption. But are you guys able to hear me, or is it just that Greg's gone? All right. Greg, I got a couple responses they can hear me. Would you please double check things?
Anything?
I heard that.
Okay, this is, hold on. I don't know how well it's gonna work. Let's see if it works. It's going through the webcam now. If it works, it
Hey,
works.
sorry, everybody. You know, tech difficulty. Greg seems like he's got himself back up, though. Greg, I apologize.
I don't know that it's you or me, but let's continue. Let's get it, keep going here.
No,
All right.
I feel terrible because I'm on the edge of my seat. Your tenure in the industry alone commands respect.
Right. So let's move it along. I'm sorry, everybody, but let's move it along. All right. So what I was saying here is I'm going to repeat the basics. The basics is what works. What was resistance becomes support. Apply candlesticks. I don't care what you call them. I call it bar by bar analysis. You put together the candles. And when I see a bottoming tail candle that dips down and it comes back up again, it reinforces my bias. And my bias here is that it's going to go up. But I was explaining before, I don't know if I got cut off, the three moving averages are simple. The 50 is equal to the 10 on the weekly. The 200 is equal to the 10 on the monthly. I got multiple time frames that are trending together in unison. This should keep going higher. Now, about entry points, where do I enter? I enter longs near support, or in this case, maybe it created some new support, but I buy pullbacks. I can buy breakouts with the proper candles that should form in those areas. And another example, as we look at what's happening here, this is creating a trading range. This is where the stars are. It was at the top of the range and it gaps down to the bottom of the range. I know there are buyers down here, the bottoming tail bar. I don't know that it can recover like that, but when it does recover, I've gotten a great piece of information. If you're a card player, you can call it a tell. It's like they showed their hand. The institutions saw that and they were all over it and they drove it all the way back up. Now, here's a breakout and it comes back in again. We've all been in one of those, right? We're scared to death. Oh, they sold the breakout. Why? You know, it was going sideways. It had a nice bullish kind of a pattern there. And this big red bar. Well, here's where the discipline comes in. Not easy. And money management. So if you share size this properly, right? If you put a stop below here, which would be okay, for me, I'd be like, okay, I'm going to cut half if I went all in on the breakout. The rest of my stop is going to be down here. You say, so far away, Greg? Yeah, that far away. That's what the pattern tells me I need to do, which means I have to reduce my share sizing accordingly to keep my calculated risk the same. So as we apply these patterns, what's the trend? Is it up, down, or sideways? Do we get gap reversals? Do we get bottoming tail bars? Do we get red bars ignored? We put together a plan that's coming together that says, hey, here was another gap down and reversal. So at this point in time, my thought of, I'm going to get stopped out on this thing, I'm just hanging in there to see what happens, to, hey, this thing's working. We're breathing again. Momentum slows down and you just continue to apply, trailing your stops, and it moves along. Why does it stop going up at some point? Well, the market tops out, it reaches its resistance area, what I'll call a destination. So here are some examples of what we use and have applied for our trades and to our subscribers. And we do option trades, we do futures, we do swing trades, we do day trades in the chat room. But here was an example where prices were extended. Right? Was it overbought here? Yeah. Here? Yeah. Here? Yeah. It's just getting more and more extended. It's crazy, but this is what happens sometimes. So it gaps down and we bought a put for $4.10. I think it's going to keep going lower. It's what we call a climactic sell setup. And this is the management. And this is taken right out of a tracking sheet that's in the member area. We also send text messages. So if you're not with us in the chat room, the green room, we send text messages as real time as it could be to your phone. You can have it on your desktop. If you log into the member area, when we update, your web page updates instantaneously. And we manage. We say, okay, take some profits. Right? There was a gain in 2 hours. Take some profits. We get targets. Why? Oh, the 50 MA is there. That's the green line. Close a third. So we do a step-by-step, not only analysis, but management to tell you what's going on, why we're doing it. We provide a chart with it because we want to teach you how to do it yourself. I mean, that's what we're all focused on. We want to make money and we want to learn how to be self-directed traders. Another example here, big rounding top. And look at how it gaps up into this resistance area. These dots here, probably your platform has it. I think all platforms have it. We just define a swing low as a bar that has 3 higher lows to the left and right, and a swing high as having 3 lower highs to the left and right. And that's how we look at resistance being created or support or being violated. Like the S&Ps broke down the prior swing low yesterday, a couple of bars down, and it broke that support. Today it's up. We'll see what it does tomorrow. But as it comes up here and we see this gap up and reversal, in this example, we sold a credit spread. You might say, what's a credit spread? It's the simplest strategy in the world. So I'm going to go and sell something more expensive, and I'm going to go buy another option that's less expensive, and the spread is the difference that I get to put in my account, or the brokerage puts it in my account. So we tell you why, and the topping pattern, what was happening there, the gap down, and same way, we manage it. And that credit spread could expire in 2 days, 5 days, 10 days, 30 days. It depends on the pattern and how we see what is formed, where the credits are, and you know what's happening in the broader markets, and we explain all of that. So we scan for the patterns, we provide the trades and the recommendations, and you're learning along the way. All right, another example. So we've got one letter that just focuses on short-term weekly options, credit spreads, and the other one, swing trades, buy calls, buy puts, debit spreads, credit spreads, market analysis. If I have time, I'll show you. You can check it out on the website though. So in this example, now we had, look at the gap reversals. I can point out a few things on the charts to drive home the point of, you don't have to know the names of these things, you just have to understand any bar's meaning. So that gap down under the support and it came right back up again. And it consolidates and it starts moving up. What was resistance becomes support. These moving averages can become self-fulfilling prophecies of support. 20 and 50 MA institutions, you know, they use the simple 50 moving average and the 200, and I think a lot of them use the 20. So as this pulls back into the support area, Your job is, oh, what kind of candle forms? Oh, a bottoming tail candle. That means buyer stepped up on the dip down here and pushed it back up again. I should be a buyer. Got to turn around, I got to pull back, I should be a buyer. So you got to set up on support in the 20 MA. Here's another setup. Buying calls on a breakout after 180 reversal. This is a 180 reversal. I'm looking for a big red bar, relatively big, and it flips right back up again. And you might think, oh, how could that big red candle be ignored? The message of a red candle that took out a high means it's supposed to go down. Well, obviously it doesn't. If it's in an uptrend and it's at support, institutions don't care that it came down a big red candle. They just said, hey, it was more expensive here and now it's cheap. I don't know it's going to do this. I know after the fact. If I'm a day trader, I might find something here on an intraday chart, but that's another conversation. On this chart, the turnaround here communicates to me that buyers are in control and this is going to go higher. And the recommendation was to buy calls for $1.03. Right? When they're earnings, we tell you when that is, we manage it, we tell you the rate of return, and so on. And by the way, right, do we have any losses? Yes, but we manage them. Everything's a calculated risk. All right. Sometimes we don't go all in. Right? Different market environments. For some reason, we have some uncertainty, but again, we're applying patterns here. This gotcha, gap and reversal. Look at the size of that red bar. If you ask me, what does that mean, Greg? I'll tell you that thing's going lower. And you may say, what did Greg know? Look at what happened the next day. But now I do know what happened here. This bullish 180 reversal at the 20 and the 50 simple moving average. So this is a bottoming pattern. If you've been with me for a while, you know, if you're in the green room or my pre-market thing, I talk about bottoming patterns. I use the word they're treacherous because there's a lot of uncertainty with bottoming patterns. But once you get this kind of reversal, the cat's out of the bag. And we love these range expansion reversals. They're powerful. And here's our pullback to minor support, nice consolidation at resistance. So this is what we look for breakouts. And notice the topping tail bar that doesn't follow through. Okay. All right, let's move along here. Where am I at? Okay, we're doing good. I don't know where I am time-wise, but another example. So these failure type patterns, look at the breakout. It was a big bar. Imagine what that looked like before completion. It was a big green bar up into resistance and it becomes a topping tail bar. Buyers are caught. That's what this gotcha is about. Buyers are being caught. And this came after a breakdown and a retracement into resistance. And here was the trade. $62 puts for a limit of $1.60 a share. What's the setup? Right, bearish wide range bar, reversal at the 2050. Here, sell half into weakless. There's the management. When to move your stop. Right. We update everything as real time as possible through text messaging and the updates. So you can read about our messages here and at the website about the different letters. With all of our subscribers, we provide scanning. If you use this platform, TC2000, I created all of these scans. You'll never be short for finding opportunities. I supply these at no charge. And here's the offer. If you know nothing about what I'm talking about here, this course comes with the offer, top-down approach, viewing the markets, 9 months of weekly lessons. You'll get a lesson every week on a different topic. 3 months of the advisory swing and options trader, 3 months of the weekly options trader, lifetime live coaching, the scans, today $197. And if you sign up today, I'll send you my coaching session that I did recently. I think it was last Tuesday. I'll send that to you and get you up to speed fast. Sorry for the technical difficulties. Hope you enjoyed this. If you have any questions, email me, greg@mastertrader. Thank you, Rob.
Hey, thank you, Greg. And I apologize twice for the tech difficulties, but man, are you the tech analysis guru. Great information. It's always an honor to have you on the show. You and Dan continue to provide the community with incredibly valuable services and education. The technical analysis and trading plans you've developed over at Master Trader are second to none. Thank you so much for being here. Have a great weekend, man. We hope you come back and see us again.
Just drop in the link again, Rob. Thank you.
Hey, absolutely.
Bye-bye.
Be well. There we go. Ladies and gentlemen, that was Mr. Greg Capra of MasterTrader.com. Greg has a proven strategy for day or swing trading by leveraging momentum as a key component to his entries. You can learn more at MasterTrader.com. Greg Capra is a true legend and pioneer in the investing and trading world, and he's proven that his methodology works. And I have to admit that I'm going to use his bit on making the lower higher high to show that it's kind of exhausting the trend. But we're going to keep the ball rolling. Ladies and gentlemen, we're going to make sure you're listening. Our next presenter, who was born and raised in New York, where he fell in love with trading while visiting his then girlfriend and now wife, Lisa, at her job on the NYMEX floor in the fall of 1982. In 2008, he moved from New York to Las Vegas and established Omni Trading Academy, where he teaches select students the Omni triangulation and trading. He's filled with vast knowledge of trading, analysis, and trend formation. By simply following trend lines and identifying formations in the chart will tell you all you need to know. And he's said many times before, the chart is just a graphical representation of the day's news. Ladies and gentlemen, here to present, according to the charts, not the word on Wall Street, the bottom is in, is Mr. Oscar Carboni of LiveWithOscar.com. Welcome back to Traders Corner. Oscar, check your mute button for us. Oscar, I'm having trouble hearing you too. Would you double check your mute button, Oscar? Here, let me click it for you. You're self-muted, Oscar.
How about now?
Ah, much better.
I know why you have trouble. You have to go find that mute button. It's not right in your eyes. Unmuted, muted, you have to literally go find it. So I found where it was.
They hit it on purpose because everybody loves the sound of my voice.
Anyway, a round of applause for Ken. Thank you so much, Ken, for putting this together. Ken, Rob, we love you guys at Traders Corner. We appreciate this. And of course, thank you to all the presenters before us. Fantastic stuff. I promise I'm not going to sell you or offer you anything at all. What I'm going to do today is show you why the charts have absolutely told us the bottom is in. We knew that when the bottom came in. And of course, I did a webinar for Ken back in February when we called the bottom. So you can go back and take a look at that. But it's got nothing to do with me personally. I've got 41 years experience in this business. And what it tells me is that I don't know anything. The charts know everything. And if I can keep my personality out of this and my crazy opinions based on everything that we read out there, the chart will tell me what's going to happen. So with that in mind, I've got a couple of questions for you. And of course, a little bit of a statement, and then we'll move right into the charts. The reason why the market stopped cold on January 4th, 2022, the highest day the S&P ever traded, was two simple factors. One, the Fed started raising rates. That was it. Started to knock us down. Two, inflation spiked to all-time highs, forcing the Fed to elevate borrowing costs. Now, I promise you this, because I just use technical analysis, I know the fundamentals. I'm a very well-versed fundamentalist. But when it comes to making calls, I let the chart include all the fundamentals. And what I will tell you is this. On the absolute highest day the market ever traded, Jan 4th, 2022, I did a video. Basically, the top is in. You can copy this little URL and take a look. If I record this, I'll put the links to these videos underneath. But the chart told me to tell my Omniacs, my followers, the top would be in on January 4th, and that's when it came in. Now, since then, I've done another video on February 7th, 2023, a year and a month later, and I wrote, "This is how bottoms are born." And I told everyone, that's it. Now we're going back up. And I will show you why that is, how we're going up, and that no matter what you hear, the fundamentals out there are so scary. Every fund manager I speak to, I've had people call me to say, "Oscar, you're calling the upside. You're going to ruin your reputation." And I tell them, the reason why people follow me is because I wouldn't take a call from someone like you. Click. The charts speak for themselves. So watch. In terms of both, where are we now technically? We had interest rates go up and inflation spiked, right? So where are we now technically? That's all I care about. According to the charts, inflation in many industrial retail commodities have abated or pulled back. Now, if the top of inflation is in, the bottom of the stock market is in. That's how it works. I'll show you on charts. There's only one caveat that can take place here. The Fed, the FOMC, is at a very interesting juncture right now. We are just about at 5% interest rates. They're about to raise rates again next week. If they raise any further, they will cause an avalanche in the stock market. And the Fed knows this, and the Fed will go into a pause mode right after they raise. Do you know why? Because anyone with enough money, if you are running a sovereign fund, let's call it, and you're running a sovereign fund from some country in Africa, and you can get 5% guaranteed return, government guaranteed risk-free return, 5% on your money, or you can risk getting between 7 to 10% at the S&P with great risk to that money. What would you do? It's a no-brainer if rates go past 5% that you just take the money and throw it in bonds, because there's no need to risk a possible 7.9 to 10.5%. Maybe I can get, but I've got to risk the whole entire balance. I've got to risk my whole account, or I can get 5% guaranteed without any risk at all. If you're a billionaire, you don't need your money to go up. You need it to not go down at the end of the year. It can stay where it is. You move it into bonds. The Fed knows this. We are at that pinnacle. If the Fed raises past this next raise, we're going to have a serious problem in the stock market. Now that's different. That's a fundamental. Now we're going to go look at the technicals. Forget the fundamentals. I just wanted to throw it in there. Fed really has to stop here, because then it just makes sense to not put money in the stock market anymore. So all I'm going to do is invite you to my live trading room. You could just come to livewithoscar.com. It is absolutely free to you. If you like what you see in this video in the next 30 minutes, 40 minutes, you come down to livewithoscar.com. Oh boy, I just went into HD mode, kids, sorry. It'll be back in a moment. You go to livewithoscar.com, and you can then, after that, you can literally just log in and come see me in this live trading room I'm about to show you. You can sit with me in a live trading room where I'm on camera and microphone 24 hours a day practically, and it'll cost you nothing. I just have people hang out with me while I go through these rough and tumble markets. Now, if we can get out of this HD mode, I can show you exactly what you need to see. Check this out. So what you have here is a situation where Apple is the leader of our markets right now. Apple absolutely positively has been the leader of the markets. And kids, I just have to make one little switch right here. I'm just going to change my screen so you can see everything that's on it. Sorry about that. But if I don't do this, you won't be able to see what's on the screen. So let me just show you everything on the screen right now. I've got some pretty charts for you to see. All right, so I will tell you this, and I have shown this, and I have shown this to you in many of my presentations. Apple is a huge component to the stock market and is the current leader of U.S. indices. Just remember the risk behind trading, kids. It's a very risky game here. You know, you can lose so much money in this game if you don't know what you're doing. So never trade without stops. But watch this. Apple is the current leader right now. Apple put in this thing that I like to call an inverted head and shoulders, an upside down head and shoulders, if you will. Left shoulder, head, right shoulder, which led into a massive rally. Now, how do you know when a market is bullish as opposed to bearish? Like the whole street keeps calling it, and I'm in shock. How do you know? Because it puts in a low and then a high. Then it puts in a higher high and then a higher low. And then it puts in a higher high and then a higher low. And then it puts in an even higher high and a higher low, and it's about to put in another higher high. So the pundits out there that are telling you that we're in a bear market, I don't know what they're looking at. I honestly don't know where their heads are at. Anyway, that's one, right? Check this out. Here's another one. Look at Facebook. It's the foundation. It is the future of the metaverse, which is the future of where we're going on this planet. I promise you. NFTs, crypto, using blockchain, that is where the world is going. Now, Facebook, way back when it was $90, I did a webinar, and I think it may have been one of Ken Calhoun's, if not, maybe it was Metastock, live webinar. And I said, look, Facebook, Meta is putting in its legs. It is a huge component to the stock market. It is putting in a bottom. If that bottom is real, it's going to explode and take the market with it. Now, that literally came from me when we were down here. All right, and here we are, it's doing its job. So if Facebook, Meta, is a huge component to the stock market, and as we know, Apple is a huge component to the stock market, and they are both bulling their way up, that tells you that there's probably more proof that the market does want to go up, not down. So what else is out there to prove it? Let's take a look. The NASDAQ, everybody knows and loves the NASDAQ, right? And everyone's talking about the downside, and it's going down, and it's the end of the world. And I kid you not, I don't get this. And you will be in my side, on my corner, in the bull corner at the end of this presentation. Here's a bull flag, very simple formation in the NASDAQ. What does it do? It bounces off the bottom of the bull flag, back to the top, bottom of the bull flag, back to the top, and it is about to break out of this bull flag and put in new highs. A market that is bearish doesn't look like this, kids. A bear market, I promise you, doesn't have lines that go up this way, right? You don't get a bear market when you start at the bottom left of your screen and go up to the top right. That's not a bear market. This was a perfect hold in what's been a bull market. But there's a lot of proof here. Watch this. Now you look at the YM. Okay, now everyone's saying this is distribution. This is the top of the market. It's the end of the world. I'm hearing it from every fund manager that I know, to the point that I can't listen to it anymore, right? All right, so at first glance, you say, okay, this is a big resistance line. The market created the line, hit it, failed. Hit it again, failed, created a bear flag. Oh my God, this is the most bearish thing in the world. All right, but then look at it on a weekly. Does this look like a scary market on the weekly chart to you? Does that look like a bear market to you? It's a weekly chart. All right, so back here, that looked like a bear market. Boom, 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 right? This doesn't look like a bear market to me. It looks like a market that doesn't go straight up, because nothing goes straight up. So it put in a high, and then it put in a low, and it's going to try to put in another higher high now. We'll see where it's going to go, but it doesn't look like it's just falling apart to me. All right, so let's go to the daily. And we saw the YM on the daily. Let's do this. How about the Dow? Look at the Dow itself. This is the market, right? When you first look at the chart, you say, well, look, it is coming down, but not really. It's more consolidating than coming down. It doesn't look like a bear market. And look at it on the weekly. Does this look scary to you? I mean, does that look like a broken market that's falling apart like you hear on TV every day? I don't see it that way, kids, but I started calling the bottom because of the charts in February of this year. People are now still calling for downside. Only a few people have caught up to what's happening here, but you will know at the end of this presentation. So that is the weekly, right? We're looking at the Dow Jones weekly. So we've just talked about the market. Is it really falling apart? I don't see it that way. Let's go now talk about the other side, the other question, inflation. All right, let's go see that. So when inflation was at its peak, soybeans was $17.84. Soybeans are used in everything from food to plastics and tires on your car. I promise you, soybeans are used in everything. Soybeans were $17.84. Soybeans are now in the 1400s. That's deflation, not inflation. All right, so that's one thing. Let's keep looking. Wheat. By the way, if you like what you see, you go to my YouTube and subscribe. I'll show you guys how to do that later. I do videos like this all the time. Check out the wheat. Peak inflation, wheat, I don't know, 1,400, 1,500. You know what wheat is now? 614. 614. This is not inflation. We had inflation. The Fed had to raise rates. They have stemmed inflation. It just doesn't land on the shelf yet. When you start seeing commodities go down, the price on the shelf doesn't go down yet, because if you take a boulder and drop it into a quiet, pristine lake, you drop it in the middle of the lake and it creates wakes or waves. Those waves don't hit the shore for quite some time. So we've got the deflation already happening. It will hit the products on the stores eventually. So this is your wheat. Remember, the whole world was going nuts. Oh my God, there's not going to be any wheat left. The price of wheat, well, it's been going down since the Fed started raising rates. So let's go to the daily on wheat. Look at this thing. This is inflation at its crest. All right, well, this is what we have to pay for the stuff now. This is deflation we're starting to see. Another tabletop staple getting cheaper, wheat. All right, what else is out there? Corn. Feed for animals. If feed for animals is cheaper, feed for humans gets cheaper, right? Food for humans will get cheaper. This is inflation tapering. Look at the price of corn just falling apart. All right, now, if this is in our products, if this is what we're paying for on the shelves, if the price is getting cheaper, I assure you, companies will have to start lowering their prices on the shelves. The top of inflation seems to be in. Now let's go look at something like this. Here's another, not yet you. Let's show them a different one. Let's look at Mr. Lumbero. So the price of lumber. Look at the price of lumber. If we could just drag this chart out a little bit for you, you'll see it. The price of lumber, interesting on this one, because during the peak inflation, it got to 1,700. It's one of the biggest expenses in materials, right? Well, let's just make this a little bigger. Look at the price now. 373, that was yesterday. It's 352 now. It's even cheaper. All right, so this is a huge component that creates inflation. Something else that creates inflation. Check this guy out. And we'll take this to a weekly. Check this out. Here's copper. Dr. Copper, used in everything, cars, you name it, right? If it's in the building at all, if it's in your watch, it's everywhere. It's in your phone, it's everywhere. So copper was 501 during the peak of inflation. Copper is in the 300s right now. Building materials getting cheaper. Commodities getting cheaper. Supplies are getting cheaper. The market's getting stronger. I am telling you, this all points to that the bottom is in. Let's see what else there is out there. You know what? Here's another industrial. Should be July, right? Let me take a look. Take a look at this guy. Cotton. Inflation is taming. Look at cotton on the weekly, just falling apart. Cotton's in everything. You name it. If you wear it, it's got cotton in it somewhere. Was 155. It's now trading at 76. Even the daily. Look at the daily on cotton. Just has fallen apart since inflation started, right? Inflation was back here. Well, this is what's happened since the Fed started raising rates. Now it's 78, no longer 106. These are all, what else is there? Cotton, what else can we look at? There's so many other things. Oh yeah, let's go look at what else is proving that the bottom is in. Bitcoin. Bitcoin has been doing the same thing this year. The bottom has been in, and it has been riding this fantastic channel. It had one breach of the channel, hits the 200 bar moving average, right back into the bullish channel. So my thesis that the bottom is in is real. Now watch this one. This is the absolute. The three stock charts, or I should say the two stock charts and this chart here, are really the main gig. Let me show you that again. Check this out. If Apple, a huge component of the stock market, is bulling up like this, and Meta is bulling up like this, what's that on 7? Nope, 7, maybe 4 is Meta. We will find that 12 is Meta. If Meta is looking like this, right? Huge component to the stock market. Apple looks like that. Well, check this out. I'm going to take you on a little ride, which I've shown to others in the past, and analysts seem to get this. Fundamentalists just don't understand what I'm showing them, but it's simple. Check this out. This is the NASDAQ weekly bar chart, okay? This line right here is the 200 bar moving average, which every algorithm on the street has programmed in. Now I'm going to take you on a little journey. You see what just happened recently? We came near the 200 bar moving average, and my contention is that we will now go higher for quite some time. The lows are in. That's not the only reason, many others, but the lows are in. So take a little journey with me. Are you ready? Check this out. During COVID, you couldn't break the 200 bar moving average on the NASDAQ. Everything else broke. Dow, transportation, the YM, even the S&P, all 200 bar moving average was pierced by the chart during COVID. During COVID, the NASDAQ weekly held the 200 bar moving average. Now watch this. It's never broken it except for once. 2019 got near it, but what happens after you get near it? A big rally ensues, right? Hold on a moment. Wait a minute. What do you got going on here, Oscar? What happened after you hit it here? Oh, a big rally ensued. Isn't that interesting? Well, let's go back a little bit. This is simple stuff, kids. What happened when you got close to it here in 2016? A major rally ensues. All right. Let's go back further. What happens when you hit it here? A major rally ensues. Major. I mean, this is a weekly. We're talking about hitting it in the 1700s and going to 2300. Major rally ensues. What happens when you hit it before that? You hit it again, still a big rally. This rally goes from, I don't know, 1708 all the way up to 2057. The only time you were able to breach this was here. Look at this. This is the only breach that ever took place in the last 20 years. 2008, 2009. We expect that, right? From then forward, every time you hit this average, you had a major rally every single time, every time. So we go to modern day. We hit it. We have a major rally of COVID. And we just finally came back and hit it again. What should happen next, kids? Straight up. Nothing goes straight up. Sorry about that. Following this is what will happen next. It is absolute. It is in the charts. I'm not guessing. I'm just showing you what's going on out there. The bottom is in. If inflation continues to drop the way it's dropping, which it looks like it is, and unless the Fed continues raising rates, if they go into a pause especially, we're done, kids. The bottom is in. Now, if you look at what I wrote back here, you can literally go see the video with me claiming the bottom is in, and I explain how the bottom was made. Technically, you could watch every chart, and it will show you the bottom being formed. Well, now that the bottom's actually has taken place and we're moving higher, the credibility, once again, of the Omni is starting to shine through. Now, anyone that's been following Omni long enough will be able to tell you that every year for 15 years, I've put out a long-term projection, meaning January is here. Where will the S&P end in December of the year? And the Omni has nailed it every single year. Every year without trouble, except for 2012 when we had a flat year. The market opened, came back down, messed around, settled flat. Nobody was right. Barring that year, the Omni has nailed the year-end projection every single year. I am telling you now, this is correct. I don't care what the other people say out there. I am the best in the world at this. I promise you. Just come see what I do. This is real. Everything else is conjecture. This is what will happen. If the Fed goes into pause mode, even better. So the charts tell you the truth. What people say, and the people who call me and tell me I'm wrong, that's opinion. I don't have an opinion. I read charts. That's my presentation to you. I hope this helps. I am basically done with what I wanted to show you. If you've got questions, Ken, I'll take a few questions. Barring that, I got to hop on a plane and get out of here.
Oscar, you're killing us. You got another 15 minutes to go.
All right, I can do more. All right, let me show you something else cool. Check this out. Here's another one that's working really well. Check out gold. Now, gold, it's got a lot of interest in it lately, and simplicity I'm using here. By the way, this is my technical analysis 101, what I would do laying in bed, laying on a cot in pre-kindergarten, drinking milk and cookies. That's what I'm presenting to you. I mean, I'm much more intricate than this, but that's not what this is for. This is to just show you the big picture. But when I'm doing my analysis to figure out where I'm getting in and out of the markets, it's much more complicated than what I'm showing you here. Just want to show you the simplicity behind what's happening. So in gold, this is what I call an Oscarism, known as an F flag. Anyone following me for the last 20, 30 years totally gets what an F flag is. The problem with an F flag is, bullish as it will remain while you're in it, if you break the F flag, it usually gets ugly in the opposite direction of the flag. In other words, a bullish regular flag, a regular traditional bull flag, you break out to the upside almost always if it's a bull flag. The F flag is something that will look bullish for quite some time, and then when it breaks out on the downside. So I want you to take a pause in buying gold for the next few days, because we're starting to test that too many times in a row. You may fall through that. Now, there are other factors as well, like the Omni waved me off from buying gold today, so we didn't buy anything. But just wanted to show that to you. Let's see what else is really interesting out there. If any of you would like to call a stock that you want to look at, we can pull some stocks while I've got an extra few moments and just analyze them live here on the go. But I promise you, what I just showed you, don't listen to anyone else, just listen to the charts. What I showed you is correct. Everything else is conjecture. You know, people come up with ideas. They heard this from a friend. They read a statistic. Who cares? The charts don't have any of that. The charts read everything that's ever come out and just know. Here's what the charts have. No BMW payments, no alimony payments. It's got no reputation. It's got no bills. No one cares what the chart thinks, and it knows that. It shows you exactly what's going on, I promise. So there's another reason why your metals have moved higher, and it's been this dollar. This dollar lately is forcing the other metals, or is forcing markets higher, the metals anyway. Grains don't care. But the dollar lately has been in this tailspin, bounced off the double bottom, started to look slightly promising, but you see what's starting to happen again. As the dollar pushes lower, it will push gold higher. You've got a situation right here. Just wait a couple of days if you're a gold trader, and it'll work itself out. So that's something I've been kind of looking at the last few days. I backed off buying gold this morning, although I will admit today, for day trading, let's see what we did here. For day trading today, I was wrong. I actually was short this market, not long, but it was because, of course, I had a sell signal left over from last night. I just stayed with it. Market went up, took out our stop. Now Omni obviously is probably reversed to back higher, but we had a really good week before we had a losing trade today. No worries, we're day traders. For longer term, though, I'm telling you, this is really starting to look nice. All these markets look good. Let's extend this a little bit. And if I started throwing averages around, you'd also see that we're holding some key averages all over the place. So get ready for more upside. NVIDIA. Let's just look at something like that. Being that no one's calling out anything, look at NVIDIA. Look at how long NVIDIA has just been. Let's move some of this stuff out of the way. It's old fashioned. Look at how long it was in this channel. All right, so nothing goes straight up, but instead of falling apart when it came out of the channel, look what it does instead. It doesn't fall apart. Instead, it just puts in some sort of a plateau, meaning it's probably taking a little time here before it jets up even higher. This is another huge component to the stock market, right? I'm telling you, we are not in a bear market anymore. Only the naysayers are in a bear market. The markets themselves, the stock market, is not in a bear market. So we have been pretty good with making these bottom top calls every time we've had a disaster. 2008, we called the top. 2009, we called the bottom. You know, along then, we've had some disasters. COVID, we called the bottom. And luckily, it's not because I think I know what I'm doing, because I'm a stupid human like the rest of us. You know what I mean? God forbid I started thinking I knew what I was doing. But I can read the charts really well, and I promise if you do the same and stop thinking, you can be much better at what you do. The charts will tell you where it's going to go, not some crazy idea, not some notion that someone has, not Larry Kudlow from the news. Nobody knows for sure except for the chart, and I'm a master at proving that to people. What else has been? Well, let's go look at something like Amazon. We'll call them random charts. I don't know what we're going to see here.
Oscar,
Yes.
you
What do you
got a
got?
couple requests, stuff like Intel, Tesla, Beyond, BP, ZB.
Got it. Let's look at Tesla first. Everybody knows Tesla. So we looked at Tesla in our last webinar, to be honest, and we left these trend lines laying around, simple trend lines. But what we were talking about was we were at some sort of quagmire right here. And if you couldn't get above, we would start to drop. That was basically our last opinion in Tesla. And dropping, it is starting to do. And let's just take a look. I mean, is the street watching any crazy averages on Tesla? Tesla's probably got a really short average here, like something weird, like 18. I don't know. We'll see what the street's looking at. I'm not sure what they look at on Tesla. I mean, I'll find out in 30 seconds. Yeah, they're looking at the 18, aren't they? I knew it would be something silly and short like that. It's 18, 21. They're playing off like an 18 or 21 bar algorithm on their averages, if you ask me. But you see what happened when it reached that pinnacle spot. It did fall apart right from there. And this thing is, you would call this a bear flag, right? I would anyway. And so some kind of bear flag took place here. And then the market dumped further. We'll get rid of that. The market dumps further. And, right now, I don't know what you'd call that, but you are in some kind of little channel pointing towards the downside. So do you love it now? Absolutely not, right? You couldn't like Tesla right now. You got to get above that red line first before you start liking it again. You mentioned a couple of others. Just call them out and I'll be more than happy.
Intel was one.
Intel. See if it'll just come up. Integral, where are you, Intel? Intel. Yeah, I guess I've been working on this guy lately too, huh? All right, so moving some of this stuff out of the way. Let's get this out of the way. For Intel, and let's move away that crazy average that nobody else is going to watch except for on Tesla. All right, so simple on Intel is the 200 ball moving average, which, the street really pays attention to that because as you can see, when you get near it, something dramatic will happen if you can't get above it, right? Here, boom, drop. Once you finally get above it, something dramatic happens. So your test is going to be here, which comes in at about 29.90. If you fail again there, more downside coming your way. It was building a flat. As you can see, that's what we were working on right here. There was a flat building last time I looked at this, but it's gotten through that flat, a little bit above, tested the 200. I would say you have to just sit tight. If it gets above the 200, jump all over it. I mean, Intel is a good company. Doesn't really matter to me what the company makes as long as the chart is pointing up. So right now you're in a flat, you're underneath the flat. I wouldn't be buying Intel if you wanted to ask me what to do with it. I'd wait.
The other two that have multiple quests are, I think it's Beyond Meat, BYND, and there's a couple that asked about crude oil.
Crude, no problem with crude. Yuck. All right, so here's what I'll say about Beyond Meat. I wouldn't spend a moment analyzing it or wasting my time on it because what exactly are we going to get out of this? Look at the daily range. What could you possibly get out of a market that moves $0.50 a day? Why even bother with it? So what I'll tell you is don't waste your time on it, not unless you're going to hold it forever and pray that one day it takes off. It's a waste of time. It's a wasted chart. I don't like anything about it. In other words, for me, I look for markets at a chart that moves $10 minimum average on a daily basis. Minimum fluctuation, $10. That's something we could sink our teeth into. This guy's moved between 13 and 15 for the last few months. Nothing I would want to do with it. And then there's
SPY,
sure.
Russell, Amazon.
Oh yeah, absolutely. So ES, let's see what chart I'm at. ES, SPY, it's all the same. Let's just clean that up. All right, so we're looking at the E-mini S&P here. And again, there's all kinds of good stuff on here. So we'll go over it slowly. Once again, let me just remind you, if we go anything past 5% risk, 5% interest rates, I am not risking my money to maybe make 10, maybe make 7 if I could get guaranteed 5+, right? Fed has to be careful that they don't destroy our market on us. So what we're looking at in the E-mini S&P chart right here is basically resistance being tested many times. In fact, I'll go back a little just to show you the first time it was hit. This line goes all the way back and hits resistance. Then the market gets back to it, hits it again, gets into a nice little bullish channel, and then into an Oscarism known as an F flag, falls out of that. So we remove the F flag. It is gone now, right? It doesn't matter anymore. New formations are coming along. So you've got the resistance here and here. You failed miserably at that resistance, came down and literally got under this channel. Right? I mean, now we're under the channel. So that looked pretty ugly. But then you had your NASDAQ turn around today and explode. Everything else exploded. And basically what it is doing is what I would expect. It's a buyer of dips type market. So you had this little dip and of course the buyers came right back in. So I think you can see what's most important now. You see this red line, this black line, right? This is what's most important to us now, is getting above when we hit it again. This time, you got to get above. So let's get rid of this. Here's where we're at. We hit it, dumped all the way to here, got near it, dumped, hit it, dumped, hit it, only broke down a little bit this time, right? Big difference. Now, if you go through again, you take off. So that's what you got to expect and look for in your E-mini S&P, and that is what I expect to get through that level. And then there was crude, right? And here's crude oil. So for crude, we're going to look at it two ways. One, you filled the gap finally and just continued on. So there was a gap right here. I don't know if you guys remember it, but you had this gap right here. All right, let's move some things out of the way. You had a gap right here. Well, it went down and finally filled that gap, but it doesn't look good overall, right? Crude does not look good here overall. So opposite of what I'm telling you about the S&P, the crude did the opposite. Look, big trend line here. Check this out, big trend line there. Sorry about that, kids. And once again here. So you keep failing at this, right? Let's extend that forward into the future. So we keep failing at that line, and now we're running away from it. Filled the gap, didn't really rally back up yet. And if you ask me, this is more of a trajectory now going in this direction, right? Aren't we now in that direction? So it's starting to traject itself lower. And the likelihood of us trading about 70 in the next week or so is probably pretty good. Nothing, especially crude, doesn't go straight down, but it is starting to put in, you know, a channel working its way lower. And I think crude will absolutely end up at the bottom of this channel, just like it does every time. But you got to wait, right? You got to wait. So crude's on its way down now. I don't see why, unless OPEC comes out with something crazy and fundamentally flips it, why it won't continue to rally up a little and then drop further and rally up a little and drop further, as you can see it's doing here. And it is also in a channel. So we are now in this channel, and we'll see if this is going to hold. All right, let's just make this channel a little prettier. So now you're in a channel, and if this continues, it will stay inside this channel and work its way lower.
All right, curiosity's got the best of me on this. Sal's asking me to ask you to mention the Melissa Francis call you made on CNBC on crude oil.
Well, it's old news now, but I can mention it. So I got invited to be on television, and you know, to get on TV, you think it's, so I'll give you a quick story. I got invited to be on TV. Oscar, would you like to be on television? I want you to speak about crude. And I wrote, well, I think crude's going down. And they write back, no interview for you. Well, I get another email 2 days later. Oscar, would you like to be on TV? Sure, what's the topic? They write back, topic's crude. I write back, well, I think it's going down. No interview for me. That's 2 days in a row. That same week on a Friday, I get an email. Oscar, would you like to be on TV to talk about crude? And I write, Sure, what do you think? And they write, what do you think? And I write, I don't know. What do you think? Enter. And they write back, well, we think it's going up. And I write, well, what do you know? So do I. Enter, lying through my teeth. And they call me on TV. Now, I literally did a YouTube video the night before to show my Omniacs that were going down in crude, but I lied to get on TV. But when I get on TV that day, I'm not going to lie again. I'm going to tell the truth. So this is what happens. They invite me on. Melissa Francis says, Oscar, the president of blah, 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 blah. What do you think about crude? I go, well, Melissa, you know, at first you would think crude's going up, but I've got unequivocal proof technically that crude's going to break from $104 a barrel to $40 a barrel. And she went, that's it. He's a nut. Cut. They went into commercial and she threw me off the set, literally. And as she was throwing me off, I said, Melissa, let me ask the question. How long have you been analyzing crude? And she said, a good 5 years now, Oscar. And I said, well, I've been analyzing crude since the day Mayor Dinkins came in and cut the ribbon for the commencement of crude trading. I was on the floor that day. I've been trading crude every day since. At least I know crude every day since. I am telling you, I gave you a projection, not a prediction. And she throws me off television. Well, crude literally breaks down to $40 a barrel, and I get a call back, many calls. Oscar, how did you know? I said, well, invite me on TV and apologize, and then I'll explain it, which they did do. So that's what happened. But in order to get on TV, you have to agree with their narrative. If you don't agree with their narrative, you don't get chosen for the day. So I pretended it was going up until I got on TV, and then I spoke the truth, and they immediately vaudevilled me out of there. No truth allowed, Oscar. What's wrong with you? Well, that's what happened.
Oh, that's hilarious. Oscar, do you want to put up your advertisement? Or, I mean, I'd like to come in your chat room just because I have an appreciation for your personality. You've got me over here cracking up, and I feel like we'd mesh.
Well, you know what? I kind of do this every day of my life. I am here in this chat room, so I'll just put it up for you if I can find it. I keep clicking too many windows here. So I am here in this chat room every day and night of my life. And what this is, to be honest, I trained on the trading floor since I'm an 18-year-old kid until they threw me out in my 40s, right? They gave us all computers and said, go home. So when you're on the trading floor, you hang out, and this is what happens. You're busy as can be when it's busy, but when it gets slow, right, you stand around, you play liar's poker, you put $100, you put a string, like a fishing string on a $100 bill, throw it on the floor, wait for someone to pick it up, you yank it from them, stupid stuff, right? Talk, have some fun, make some jokes. Then it gets busy and we jump in the ring and we're as busy as a heart attack, as serious as a heart attack. Well, once I left the trading floor, I'm saying, what do I do with myself during the day? I need people to hang out with all day when we're not trading, so that he can take up my time. And then when we are trading, we're serious. So what happens in this room? This is Live with Oscar. It's not Live with Oscar. It's basically, I live here 24 hours a day. I'm a professional trader analyst, and you can live here with me, and it costs you nothing. Just hang out with me. So go to livewithoscar.com to do that. Literally, let's just take this piece off here. It'll look like this. You go to livewithoscar.com, and if you're not already a member, just register. It takes zero information. Username, password, wait for your email. It might go to spam. When you get your email back, come join me in my live trading room. And that's it. It won't cost you a credit card. It won't cost you a dime. And you get to hang out with me all the time. And then from there, whatever happens will happen.
Oscar,
So,
you want to crack up?
What you got?
I still inspect every bill I get and have a collection for Liar's Poker that have 5 and 6 of the same number on it.
I love it. You got a nice collection of them? I used to love zeros. When I would get all the zeros, I'd be like, yes, no one's going to guess this one.
Oscar, I want to thank you so much for being here. You were some much needed comic relief and absolutely incredible and great information, analysis, everything. It's a pleasure to hear you on and to have you here on Traders Corner.
Anytime.
Cool.
Thank you for having me. Much appreciated.
By the way, Oscar, I love your YouTube videos too. Just because.
So we do a YouTube video every night, by the way. I don't know if some of you guys don't know about this, but every night I do a YouTube video. And basically it's a video that looks kind of like this. There's probably some volume on here somewhere. I think I've got it muted. But it's me talking for a little while, and then I go into a chart segment, which is really important. I show you exactly what should happen tomorrow and why, right? So it's really very good information. And then I act out the trade that I gave you that night before in this video, I acted out the next day in my live trading room, and we do that 6 days a week, 24 hours a day. So if I tell you in my video tonight I'm going to do something tomorrow, rest assured that's what we will do tomorrow. And you
Oscar.
can find them on YouTube.
Oh, I'm sorry, go ahead.
You can find those videos on YouTube. I think it's literally called youtube.com/Chart Whisperer. I think that's what it's called. Yeah, at Chart Whisperer. So if you just look for at Chart Whisperer, you can find all my videos.
Oscar, thanks again for being here. I wish you a great weekend, and I think I'm going to be in your room one of these days just to laugh with you.
Come hang out with us, man. We have a blast. When it's busy, we're serious. When it's not, we're human.
Understood. Enjoy your weekend, sir.
Thank you. Appreciate it.
No problem. Ladies and gentlemen, that'll bring us to our anchor presenter. He's been a professional options trader for the past 13 years. He has a Reddit verified live performance and has been mentoring students for close to a decade. He's been able to maintain an incredible 90+% win rate trading his own live account. He also has an options live trading room and alert service that has garnered his members consistent profits. All the good news is he's going to tell us exactly how he does it. Here to present SPY Super System Revealed is Mr. David Wyse of Right Line Trading. Welcome back to Trader's Corner, David.
Thank you very much, and hopefully you can hear me and see my screen.
Loud and clear and bright and shiny.
Thank you very much, and I'm entering this webinar with a smile on my face after listening to Oscar. It was very, very entertaining. And,
I thought you were going to tell me it's because you bought calls today.
Actually, I did buy some calls on SPY today, and I had a bunch of Microsoft calls from overnight, so pretty good day.
Hey, I'm kind of hungry. You want to do dinner?
Everybody's a comedian now. Listen, thank you very much for the intro, and I appreciate everybody being here at the webinar. I'm going to talk a little bit about my option service that I have, about the Compass Room and the Compass and Dominator software that I use to do trades. I have a trading room and an alert service, and I'm going to introduce that to you. I'm also going to talk about what we call a SPY Super System, which is a methodology we have to trade the SPY, which is typically wins about 90% of the time on these trades. So we'll go into that. And again, my name is Dave, and I'm with Right Line. We call this the Compass Options Alert Service, and we'll talk about this service and how we find these particular trades for anybody who is interested in day trading or short-term swing trading. That's what this is for. So first I need to do the normal disclaimer that all the signals and trading opportunities we provide here for educational and demonstration purposes only. Trading is very risky, if you didn't know that, and you should never trade with more money than you can afford to lose. And neither myself or Right Line Trading are licensed financial advisors, so we won't be giving financial advice. All right, so again, before I get into the actual service and the software, I kind of want to talk a little bit about the market and what moves the market, what doesn't move the market. And it's very important to understand that these little marbles here, which actually should be even a lot tinier, these are retail traders such as myself, and I'm sure many folks here are retail traders, and we're in there trying to scratch out money, make money each day, but we don't have any impact on the direction of the market. Nothing retail traders do is going to create a trend or reverse a trend. We're in there to take advantage of the trends that are already in place and ride them up and down. This is the institutions, and it's made up of a lot of different institutions. You have Goldman Sachs here, Morgan Stanley, HSBC, the big banks. You have Vanguard funds, T. Rowe Price mutual funds, a lot of 401k portfolios are also trading. And now these people are trading, they're trading billions of dollars. And when the institutions decide they want to move a market or a stock in a particular direction, that's the direction it's going to go. We as retail traders have no impact on that. So it's very important, if you're going to have an edge in the market, that you need to be trading in the direction that the institutions are moving the market. If you're not, you're just going to see a lot of chop and a lot of chaos, and you're going to get chopped up in as far as your account is concerned. So what the whole reason behind the alert service and the my options trading room is finding what the institutions are doing and following them. Basically, we're just following the breadcrumbs that the institutions are creating by their trades. And we have a way to do that, and I'm going to show you how we do that. And that's where my my alert service trades come from. So again, just keep in mind, we don't have any impact on the market. Our job as retail traders is to beat the other retail traders, because we're not going to beat the institutions. We're going to take our money from other retail traders, and if we've got the right tools and we've got a better edge than they do, we're going to beat them. And that's how this works. So that's a little bit of a recap of how the market has actually moved. And these, by the way, also include a lot of the algos that you hear about. Algos have gotten fairly sophisticated. Yeah, I don't know if you're a trader and you maybe put in some hard stops, and you've ever noticed that the stock will go down to your hard stop, take it out by 2 cents, and then reverse immediately. The algos that these institutions have that trade these markets, they can see all that information. All that information from the ECNs is available to them. They can see all the hard stops that are in place, which is one reason I never use a hard stop. But the algos can also look at trading patterns that a lot of retail traders use, MACD crossovers, using RSI, so many of these different levels that they use. The algos can write software to actually break the back of the retail traders. They can create what looks like a MACD crossover and then reverse it hard. So that, just be aware that that's all what the institutions are doing. That's part of their trading technique. All right, so let's talk a little bit about the alert service first. The alert service, the Compass alert service that I have, it's designed basically for day traders and short-term swing traders. I don't really do any long-term swings in this. Most of these trades are going to be intraday, or they're going to be overnight, and some of them may last a couple of weeks, but that'd be about as far as they go, unless I'm doing like a put credit spread, and those could be 4 to 6 weeks. But typically, these trades are going to be overnight or a few days. And again, it's designed for traders who can't watch the market all day. A lot of people work, but they'd like to be able to participate in the market and maybe supplement their income a little bit. And that's what this service is for. And we only send out real-time alerts on the highest probability trade setups, which I'm going to get into here. One of the things I want to do here is be transparent about the alert service. There's a lot of alert services, but what I'm going to do here is show you exactly how I'm finding the trades that you get. So if you're a member of the alert service and you're going to trade, you're going to know the criteria that we use to find that highest probability trade setup. We're not just throwing darts at a board here. We have very specific criteria that we need to find these trades to be able to send them out, which means we're only going to be trading the highest probability trade setups, which is why we have such a high win rate. And how we find is there's two things. We find the highest probability trades by identifying institutional involvement. So when we find a stock that's being pushed, or an ETF that's being pushed up or down by the institutions, then that becomes a prospect for us. And then we look at market internals and technical analysis. Market internals is another piece of software I'm going to show you. It shows us what the overall market is doing across all 5 of the major indexes at any point in time during the day. And then we use technical analysis once we've identified the highest probability trade setups and the market internals working in our favor. Then we're going to look at technical analysis and make a determination technically if this is a good trade to take. In other words, if it's going long, do we have enough room to the next resistance level? If we're going short, is there enough room to the next support level? Are we on a support level or a resistance level now? All of those things go into the high probability trades that we take. So you'll know that when you get a trade like that, it's been vetted very, very thoroughly. And you'll be able to see when you get the trades, you'll be able to look at the chart. You'll be able to see that. Okay, so the trades are would be alerted by SMS text message. They come to your phone. And our motto is to trade the best and skip the rest. This is the only thing we're doing is trying to find the highest probability trade setups. So it's not, you're not getting lots and lots of trades. You know, you get, I think we probably had this week, we probably had about six or seven. But we've in the room so far this last couple of weeks, we've had 18 winners in a row, which is pretty good, but we get losers just like everybody else does. But we've had 18 winners in a row. And what we say is that our objective as traders, and this is important, our objective to traders as traders should not be to make trades. Our objective should be to make money. Now, we make money by making trades, but a lot of traders will be sitting in front of their screen and they feel like, I'm a trader, I need to be making some trades. And that's not what you want. You want to be looking for reasons not to make a trade until you find the one that's gives you the highest probability, and then you're just going to go in and take that. And you know, kind of a little aside is today was a very, very bullish day in the market. And, you know, we had some SPY calls and we had Microsoft overnight, but we also took a put debit spread on PXD. So we were short on PXD because we could see that the institutions were selling it, and we knew that it had relative weakness to the market. Every time the market went up, it was going down. So we made 25% on a PXD put debit spread today. And so you can make money with the reverse of the market, but we prefer to be trading with the market most of the time. So what you're going to get on the alert, every alert will come to you. You're going to get the stock symbol, of course. You're going to get the stock, the option strike price that we're getting in at. You're going to have the expiration date of the option and the price to pay for the option. And sometimes that's going to be within a range, like $1 to $1.05, because you know they move around. But so you're going to get all of these things on that one alert. It'll just come to your phone. It'll tell you what stock to take, what's the strike price you should take, so you know exactly how to put that trade in. The exit price may come with the original alert, but probably not. Most of the time, I'll put the exit alert price in later because I want to kind of evaluate the trade a little bit before we put a profit target in there. And anytime you put your exit price in, when you put the order in to sell, you want to put it in as good till canceled, GTC, so that the trade will be closed as soon as that happens. And the reason it needs to be GTC is a good till canceled. So when the market opens 9:30 the next day, if you're still in the trade, you want to have that trade working so that if you get a nice pop first thing in the morning, you on a long or a nice drop on a short, you'll be able to take profits in that. All right, so that's what the alert service is. Inside, just put some recent alerted trades in here. We've had a lot, but these are just some of the recent ones. And what I'm using here is a $2,000 investment as a standard for all this trades, just so I have some baseline. But basically on BNTX, we entered for 81 cents. We get out for $1.21 in the morning. This was just an overnight trade. It's $2,000 invested in that, produced a $1,000 profit, 50% profit. Run, this is a solar stock. We got it in at 33, out at 43 cents the next morning. Again, 2,000 invested, $600 profit, 30% profit. So I won't run through every one of these, but here's Alta, in at 266, out at 366. These were calls, and 2,000 invested produced a $700 profit, 38% profit. So again, we've got others here, ACN, 43% profit, produced $855. Delta Airlines, this was a nice one. This was a calendar spread or a timed. We take what we call it a time spread over earnings to capture the implied volatility crush. You can be able to, if you join the service, you'll learn all about those as videos on exactly how those trades are set up and how we make money on those. But that was a nice 45% profit. So we go along here. This Baba was a 13% profit, and Twillo was a 25% profit. We just had another one on Roblox yesterday, which was another beautiful trade. I didn't list them all here. So that just kind of shows you some of the winners. And of course, we do have losers, but I just wanted to highlight the recent ones. And like I said, we've had 18 in a row so far. This is kind of a review, and I'm just doing this for transparency. I just want to show you some of the trades that I've taken and what our win losses have been so far. These are just recent April trades. I don't want to list everything here, but we had SPCE for 46% and URI for 21%. So you can see most of our trades run anywhere from 10 or 15% up to 40 or 50% on the ones that we take. We did have a loss in SE of 17%. but this is a pretty good representation of the trades we take and the profits we take on them, because the profits you take on a trade are very highly correlated to the market. A trending market, you can take much bigger profits than you can in choppy markets, and we've had very, very choppy markets recently. So just kind of a recap, in March we had 34 wins, 7 losses, 83% win rate, which is pretty low. It's one of our lowest win rates in a while. April so far, 31 wins, 4 losses. It's actually higher than that now. It's gone to 33 and 4, but that's 89% win rate. This is more in line with what to expect under most circumstances. Okay, so that's some of the stats on it. I'm going to show you some other stats. You know, I want to explain what I'm showing you. I told you that what we look for is we look for institutional buying or selling, and we look for market internals. We want to know what the overall market internals are. And we do that by using 2 systems. One is the Compass system. This is Compass Trades here, and the other is the Dominator system. Now, the Compass system has been around for quite a few years. The Dominator system was just added in October. The Dominator system is the system that shows us what the market internals are. And that tells us what stocks are moving up, how number of stocks moving up on up volume and up ticks versus the number of stocks moving down on down volume and down ticks. So we can see what the market direction is, how much of a disparity is there on buying and selling. So this is just a quick little recap of what we did from October 1st, which is when the Dominator system came out, to end of December. That's the last quarter of the year, from 10/1 to 12/28. Now we did using just the Compass system. This was trades that had institutional involvement. We knew that the institutions were either buying or selling, but the Dominator system was telling us the market internals were neutral. There was no bias one way or the other as far as market internals were concerned. When we did that from 10/1 to 12/28, we did 129 wins and 12 losses just using the Compass system telling us are the institutions in there. And we had a 90.2% win rate over those trades. That's a pretty high win rate on the Compass system. And this is what I was up until October, this is what I exclusively used. Now, when we added the Dominator trades, Compass Dominator, these are trades where the institutions were either buying or selling, and the Dominator was telling us that the market internals were also lined up in the same direction. So if we found a stock that was green on the day and had institutions buying it, and the Dominator was telling us also that the market internals tell us that there's a lot more stocks going up on up volume and upticks than going down on down volume and down ticks, then we took those trades. So you can imagine there'd be fewer trades because you don't get this alignment as often as you just do with institutions. But from 10/1 to 12/28, we did 113 wins and 2 losses. And I mean, this is 97.4% win rate. I was kind of staggered by this. This is a pretty stunning win rate. Unlikely to actually maintain that higher win rate over these, but we do have extremely high win rates when these both line up. And some days they do and some days they don't. It lined up today very nicely. The Compass system and the Dominator system lined up on the SPY today at about 11:30 and stayed bullish the entire day after that. So you could have taken those trades and rode it all the way up. So that just kind of gives you an overview of how I use the Compass system and the Compass Dominator combination to find the trades. And this is where the alert trades are coming from. They're coming from this kind of information that we're gathering. Okay, so again, how do we achieve these stunning results? Well, we've pretty well talked about it. We're able to identify when the institutions are driving a trade and when the market internals are heavily bullish or bearish. We can see that off of our software. So what we do is we try to only take trades when both of these are in our favor, allowing us to align our trades with the institutions in the market. Those are the highest probability trades that you can get. You add that, you take that and you go ahead and add the institutional trading and the Compass system as far as the institutions are concerned, and then you look at your technical analysis and decides which one of those stocks has the highest likelihood of returning the highest profit potential. Those are the ones that we're going to alert out. Now, a lot of times the Dominator system will tell us the market internals are neutral. So then we lean on the Compass system only, and we'd send out alerts that tell us the institutions are driving this trade. Those have very high win rates and 90% win rates, but not quite as high as if the market internals are also aligned, but the market internals aren't aligned all the time. So I hope that that's kind of clear how we use this. Okay, so these are the two systems. Okay. Oops. These are the two systems that we're using. We're using the Compass system and the Dominator systems. The Compass system is identifies stocks that are being moved by institutional buying or selling. It also identifies stocks that do not have any institutional buying or selling moving them, so that they can be avoided. Skipping trades that aren't going to work is just as important as finding trades that do work, and that's what this will do for you. The Dominator system, the second one, and I'm going to show you exactly what these systems look like, what the charts look like on them, so you can see clearly how these things work. But what you see here is the Dominator system displays market internals and produces buy or sell signals when the difference in the number of stocks moving up on up volume and upticks is much higher than the stocks moving down on down volume and down ticks. So there has to be a large disparity. For example, let's say you've got 700 stocks moving up volume and upticks, and you've got 200 stocks moving down on down volume and down ticks, then you're going to get a buy signal on the Dominator system. So these are the two pieces of software that we use that you can actually buy and use yourself to find these high probability trade setups. And then I use my my technical analysis to find what I feel technically are the best of those. Okay, so again, the Dominator market internals. This is the new Dominator system that finds market internals. What it's looking at is it's looking at the market internals for 5 indexes. So it's looking across the Dow, New York Stock Exchange, Triple Qs, the SPY, and the Russell 2000, the IWM. So it's looking at all 5 of those indexes, and it analyzes the number of stocks moving up on up volume and up ticks versus the number of stocks moving down on down volume and down ticks in each one of these indexes. And when there's a large disparity, like I said, 600 to 200 or 500 to 100, then it's going to generate buy or sell signals, because it's determined that the number of stocks that are moving up is swamping the number of stocks moving down. It becomes a buy signal on the Dominator system. And again, we use it in conjunction with the Compass system to identify even higher probability trade setups. So this is what the Dominator system is, and we're going to go in and look at exactly what we see. All right, so again, when the trade comes up or meets these high probability setups, you're going to be alerted to the trade, and it can come anytime during the day. You know, it can come in the morning, it can come in the afternoon. Typically, I don't start to take trades till after 10:15, so that I have a good feel for what the market is likely to do that day. If it's just chopping around, then we focus on the highest probability trades on the Compass system. So again, you're going to get the stock symbol, the strike price, the option expiration date, and the price to pay. So everything you need to make the trade will be alerted to. Okay, so I'm going to show you some of the charts of the recent trades, and I'm going to show you these examples of high probability trade setups, because I want you to see what the alert service, when it sends an alert to you on a stock, I want you to see what it looks like on the charts, what we're finding, because this is what we look at all day long. My trading room is open every day from about 9:15 to 4, and we're in there all day long, looking for trades, posting trades, answering questions for folks. Okay, so here's some examples. And here we go. All right, so this was a Netflix, and this is the Compass system. This is on Thinkorswim. This is the Thinkorswim platform, and the Compass system is installed on the Thinkorswim platform. And it's if you buy it, if you purchase it, it's all installed by Sergio the tech at Rightline. You take over your machine, put it in there, and it'll look exactly like mine. So this is what the Compass system looks like, and this is a sample of Netflix. Now I'll kind of go over what these indicators are briefly. If you decide you want to use a system, you get a lot of detail as far as each of these indexes and how we use them. But it's going to be fairly easy to see. The two main indicators that I use for intraday trades and short-term swing trades is this line right here. This is called it's the little gear multi-time frame momentum. And this one here, the next one down, this is the current time frame. current time frame momentum. So these are Laguerre indexes with the divergences stripped out. So they're only showing you momentum, which is all we really want. We really want to know momentum. So this is on this chart. This is my mouse go here. Here it is. This is a 5-minute chart on Netflix. Okay, so this right here is the momentum on the current 5-minute time frame. So this is showing you what the momentum is on the current 5-minute time frame. This line right here is the multi-time frame momentum. So this is showing what's happening across the 5, the 15, and the 45. This is showing 3 different time frames at the same time, so you can see if there's selling going on across all of those time frames or not. Now, when the current time frame and the multi-time frame align, when these two have the same colors, and colors would be red and yellow is bearish, and blue and green is bullish. You can see that you've got a real agreement here as far as the colors. And just briefly talk about this one. This is called the quant line. This quant line tells you what the other stocks that normally trade with Netflix 70% of the time or more, if they're also trading in the same direction as Netflix. So now we know that Netflix is being sold on multi-time frame, it's being sold in the current time frame, and other stocks that trade with Netflix in the same direction are also going down. So when you see red like this across the board, you've got a very, very bullish setup. And the compass system makes it really easy to see because it's red colors. I mean, this makes it very, very simple to see. So you can see here on Netflix, the stock was moving sideways. You can see this compression. We get what's called, the compass system puts in what's called a pop out of the box signal. This is a sell signal. In other words, it's breaking out of compression to the downside. And it continues on down here. This was our entry right here because we had compression, break to the downside, and this pink line right here is called the volume weighted average price. Very important to trade short only when the stock's below the volume weighted average price. So we get in here and we wrote it down here and we get out for a 20% profit right here as the stock kind of flattened out. And you can see that it stayed red the whole way. And if you notice, the compass system was telling you here, you notice we had some blue and then it went to yellow. That's bearish. Here is where the institutions aligned on selling right here on this candlestick, which is why you get in. So that was Netflix. And I don't want to beat to death the indicators because there's some really nice ones in here. But again, if you get the compass system, you'll be able to learn about those and use those. But for the alerts, I want you to see the kind of information we're using to find these. All right, so I'm going to run through some charts here. This is the dominator system. Again, this was the compass system on TOS. This is the dominator system on Ninja. The dominator system runs on Ninja 8 platform. And what I look at here is a couple of things. The background here, dark pink, tells me it's bearish, and this is the SPY. Bearish on the dominator system, so it tells me that it's bearish. Now you can see here the background goes dark pink right here, which means it's now bearish. It has gone from neutral, which is black, to bearish, which is dark red. And we get a sell signal. See the sell signals on the SPY right here. And these are the actual indexes. You don't really need to worry too much about this. If you're just using it, you can just go by these arrows. But this is where we entered the trade right here. As everything went red, we get a sell signal on it. The background is dark pink. We ride it down and we get out right here as it starts to flatten and made 3 points on the SPY trade. That's $250 profit. So this is the dominator system. This is the compass system that's got the TOS on it, and this is the Ninja platform. So there's 2 platforms I use. I have both of these up and running, and that's where my trades come from. Now I'm just going to run through some of these, and I just kind of want you to get familiar with the indicators, how we're finding these, and you can see how easy it is to spot them, because this is Tesla. This is Tesla on a 5-minute chart. You can see this long compression, and you notice you've got variations in colors here. You don't really have any consistency. But right here, when we're getting this pop out of the box signal, breaking below the VWAP again, with this pink arrow, this is a pop out of the box signal telling us we're breaking compression. We have yellow and red across the board. This is where you want to get in, because now we know that the institutions are selling here, and this drives the price down. And again, we get out right down here at the end of the day. This was the end of the day. We just wrote it straight down. You notice it stays yellow or red all the way. So we've got confirmation that the institutions are selling. No reason to go out 30% profit. Okay, and this was Tesla. This was an overnight trade. Now this would have been an overnight trade you would get. Again, we had a pop out of the box signal on the 5-minute. Everything is red or yellow, and we took this as an overnight trade. And Tesla gapped down the next day from 120 to 112. Everything is still red, and so we stayed in it, and we wrote it all the way down to here. Again, we were compressing, but everything was staying red, so there was no reason for us to get out of this trade. And this is where we took profits in Tesla. And these puts exploded, even you can imagine. Stock gapped down $8. The options went up about $6.50 a contract. But again, you can see how easy it is to see this on the compass system right here. Okay, and this is Zillow. Okay, this is Zillow on the 5-minute. And the reason I keep showing these over and over is I want you to see how easy it is to see this on the compass platform. How easy it is to see these actual trades. Here's a pop out of the box signal, nice big red candle, nice place to get in because everything is red, coming out of compression, write it down, and then we get little tiny candles here, so we're losing some of the downward momentum, get out right here, but again, a nice trade on Zillow. This is Oxy, and again, I want to show you how you can use this for 5-minute. This is a daily chart. Okay, this is a daily chart on Oxy. And you can see that we have the compass system produces this shaded area, this long shaded area in here. That's called the dynamic compression zone. It's very, very important. It shows you exactly when you're coming out of a dynamic compression zone, because to trade, your best trades are taken when you're breaking out of a compression, either up to the down, upside or downside. You'll have a lot more likelihood of a good move. So we can see we're getting a big pop. We get a big pop on the daily on Oxy. So, and you notice everything is green. It's bullish. Compass system tells us the institutions are in there buying on Oxy. So here's Oxy on the 5-minute. Right here it is on the daily. We see this. Here it is on the 5-minute. So I look at the daily chart, then I look at the 5-minute chart, and here's a big long compression in Oxy till about 12:45. And then we get a pop out of the box signal right here, and everything is blue or green. So the institutions are in there buying, and we take this and we ride it higher right up here. We just take this for about 45 minutes or an hour to get up to here. And again, you notice everything stayed green the whole way. So that is what we look for. And you can see how easy it is to find these trades with the compass system to tell you that the institutions are in there. Remember, the institutions being in there is very important. We want to only trade with the institutions. This was a Tesla trade. Same thing. Again, you see the same kind of setup repeated over and over again. This was Tesla right here where we get in. You get a pop out of the box signal after this compression. We get a lot of green here. We can see the institutions are definitely in here buying, and we want to ride this up, which we did. Now these candlesticks, by the way, are what's called Heikin-Achi candlesticks that I use to find reversals. Heikin-Achi is a particular type of candlestick, if you're not familiar with. It basically uses 2 candles to create 1 candle, so it smooths out the movement. You don't see a lot of herky-jerky action, and you see as long as the candlesticks don't have any tails on the bottom, it's a bullish trend. And this is what we were using here. We get in right here and wrote it right up to here. And again, all green. Compass system telling us institutions are buying here. No reason not to be buying this. This was a SPY. And this is a SPY trade. This is bearish. And again, you can see the SPY compressing right here along the pink line. That's the volume weighted average price. Here's a pop out of the box signal. We go from blue to yellow, which is telling us the buying is going away. The institutions are in here selling now. So we want to jump in right here, and everything stays red or yellow all the way down, and we just write it down, and then it starts to compress. And SPY trades can be fairly quick because it tends to move around a lot. Although today it was actually a pretty steady grind up all day long. But it pulled down here, and then we took profits right here. But again, the compass system is telling you institutions are selling the SPY here. You want to be selling the SPY too. Okay, and again, this is a meta trade. This is a daily chart. Dynamic compression zone in the compass system right here, telling me, aha, Here comes, his med is breaking out of this dynamic compression zone to the downside. I've got yellow and red across the board. Time to take a trade. Take it overnight, and we wrote it down. I think we just took this for one night overnight. We might have taken it to the second day, but we had a nice profit on this thing overnight on Meta. And again, easy to see, easy to see. This is a crowd, another daily chart. Again, it works on daily, it works on 5 minutes, it works on whatever time frame you want to use. I typically use daily for my swing type trades, and also to align my intraday trades, and then 5 minute for the intraday trades. But here's a nice breakdown out of dynamic compression again. You can see the dynamic compression, the shaded area, big red candle moving down. This goes from green to yellow. Everything else is red. This is a sell. Institutions are in here selling crowd, and they sure did. And you would just buy that and take some puts on it and ride it on down. This IBM, this was a daily chart in IBM. You can see the dynamic compression zone right here, right? The shaded area. See the breakout right here? As IBM breaks out of that, it's breaking above all of the compression here. Everything goes blue or green. This was an overnight trade for us on here in IBM. Another nice trading. You can see that institutions, you know the institutions are buying here. I mean, you can see that they're all in here buying. The quants are green, the multi-time frame of gear is green, the current time frame momentum is green. They're all green. There's buying going on. I'm going to show you QSR. This was a daily chart in QSR right here. Okay, now here's a dynamic compression zone right here. Here's it goes from yellow to blue. Here it breaks out of the dynamic compression here and here to the upside. All right, so we know that when we look at the daily chart that we're getting a break to the upside, and the institutions are buying across the daily. When we go to the 5 minute on QSR, we have this compression right here. So we're looking to take a trade in this. We're not going to take a long trade when we get red and yellow, but as soon as it gets to blue and we get it pop out of the box signal right here, this is where you would want to take it. And you went back to yellow again here, and then it went to green. And this break right here was where you would want to get in. And here's another pop out of the box signal. This is where I got long, and you just ride this up until you start to lose momentum. And you can see your momentum is telling you all the way through here to stay long, and then it says, okay, some of the institutional buying now is starting to wane, time to get out of the trade. So that's how we know that. Now, I want you to see this in conjunction with the dominator system. So here's the dominator system on QSR. This is the same day with the dominator system on QSR. All right, so if we go back here, we can see we took this trade about 11:30 in the morning. Right, so this is 11:30 right here on the dominator system. You notice on QSR we've got a dark green background. That tells me that the multi-time frame trend is bullish on QSR. Now, I could have entered right here off of this compression. This is where I entered because I took it off the compass system. I don't have any buy signals yet, which means I don't have any sell signals either, but this is telling me I don't have a big, huge disparity yet in the market internals that I'm looking for. But you can see when the buy signal popped in right here, now I know my market internals are also extremely bullish across all the indexes, and I can take it. Although I was happy to take the trade right here on this break to the upside, because this is neutral, compass was bullish. I wanted to get a little bit of an early run at this, so which is what I did. And again, ride it up, and you can see that you've got buy signals coming in here. Stay on the buy signals, you can stay with the trade all the way to the end. That's QSR. So again, that's aligning it on the compass system with the daily, the 5 minute, and the dominator system. All three together give you the highest probability trade setups right there. That was a very huge probability of winning, probably 95% on something like that. This is the SPY, and the SPY again is showing bearish here. Notice we get a black background that tells us we don't want to trade it. Now we've got a pink background that tells us it's a good short. Here's our signal telling us that we get market internals now that have gone to the bearish side. You can buy it right here on the sell signal and just ride it down, and then it just kind of compresses, and you take your profits on the SPY. I mean, I take profits on SPY fairly quickly. I'm not going to ride this through all this compression here. Just take this on 3 or 4 candles to the downside. And this is another one that's long here. And this was a SPY to the upside. And again, you can see a buy signal right here. We get this light green or light bluish background. This is a bullish setup, but not as bullish as the dark green for the multi-time frame trend. But you could buy it right here, but that's probably hard to get in because it's a pretty big candle. Or you could wait till it all goes to dark green and you buy right here, and you can just ride this trade for as long as you have buy signals, which you have for a long time. I want you to notice something. You see these red candles coming in here. Retail traders are always trying to pick tops and bottoms. These are retail traders trying to pick the tops here by shorting this SPY. They're trying to short it, thinking that, okay, if I found the top, I'm going to get in here. But you see what happens? The buy signals are still here, and we're mostly green across the board. And it comes right back up, and then takes these retail traders and takes them right out of the trade again. And this is why you've got to focus on what the institutions are doing and what the market internals are doing, because if you're trying to guess and pick tops and bottoms, it's not going to work. And again, this is Netflix. Another one, this is Netflix on the Dominator. So I'm kind of trying to show you the two systems that I use, the Compass and the Dominator system, and how they can work in conjunction with each other. So here's Netflix with a buy signal at 11:45, big green candle. Probably wouldn't want to chase that up. I would likely wait for this to compress, and then I get a compression breakout in the Compass system, buy it here, and then just ride it the rest of the day. Here's the retail traders trying to pick the top, and they get washed right away here as the stock moves up. Buy signals stay on, and they stay on all day. I'm not going to stay probably till the end. I'm probably going to ride it up to here, and because I'd have a big enough profit that I would get out. But that's what I'd be looking for. All right, and this is a SPY to the short side. Same thing. Look at how red this is down here. Look at these sell signals. Now, the proper place to get in here, you could try to front run this by selling, taking puts on the SPY when you've got a black background. That's a neutral background, but you're getting a sell signal. It depends on what the Compass system looks like that time. But this is the more ideal place to get in right here. As the colors turns to light pink or yellowish here, you would take this on a sell signal. You can get in right here and just ride this down. Again, this is the SPY, and you can see you can ride it down. A couple of pivot points here that it goes right through. But by here, you want to be out of the trade when it gets back down here. And you can see it starts to move back up again. But you've taken a beautiful profit on a trade like this just by looking at the market internals and the Compass system lining up with it. Again, another SPY. This is the same SPY on the Compass system. Notice all the red, yellow and red all the way. Here's a pop out of the box signal coming off the VWAP right here. Break into the downside. You try to pop out of the box signal, you take puts on the SPY and you just ride them down. You notice that the Compass system is giving you red across the board except for this one little blue. But that doesn't, you still got the multi-time frame momentum is still red here, and the quants are still red. So you would stay in here, and if you get in here, you could take profits if you wanted to as it compressed, and then you could try to get in again and ride it back down again. It's staying bullish all the way. Then we finally go over and switch over to some bullishness coming in. You're out of the trade. This is telling you not to stay in, but you had red a long way. That's the charts I had. This is just a quick profit loss target for the last quarter last year. I need to update this. I haven't done it, but I just kind of wanted to show you what this was based on. $2,000 per trade, and it's a nice P&L move up. But again, this is, I don't want to brag about this, but we typically have between 88 and 92% win rate. This is generally what your curve is going to look like, with obviously some drawdowns from time to time. Sometimes you get news on a stock that you take and that drives it down. So the Compass system, let's talk about what we just saw here. The Compass system is identifying when institutions are creating a trend, right? This is really important. We want to join a trend when the institutions are in there. The triple screen assessment that we just talked about, which is multi-time frame, it's looking at four things. It's looking at the momentum, which we've focused on quite heavily. I think that's one of the most important things. The trend, which we're looking for the multi-time frame trend. We only want to go long on a stock that's in an uptrend. We don't want to go long on a stock that's in a downtrend. The money flow, which is another one of the indicators, and then the quant, which is one of the ones I mentioned to you, which shows you stocks that normally trade with the stock that you're looking at, 70% of the time or more? Are they also trading in the same direction? All four of these together give you it's virtually assured. I mean, as virtually as it can be, 95% or more, that when you have all these things lined up the same way, that it's the institutions driving this trade. These are not retail traders driving this trade. This is being done by institutions. And then we have the market internals coming from the dominator that we just looked at earlier. That's telling us number of stocks moving up versus on up volume and upticks versus the number of stocks moving down on down volume on downticks. How many are there? How many more are there? Is there 600 each way? That would be just a neutral market. So it's looking for the total number disparity to be large. When the disparity becomes large, then it's going to start putting in buy signals and sell signals. And again, we use it in conjunction with the compass system to identify even higher probability trade setups. And I do use this on the SPY. If the dominator has got market internals with a buy signal, the compass has a green on the SPY, and the SPY is coming off a nice support level, like the VWAP or 15 EMA, some coming out of dynamic compression, then that would be what's called the SPY super system. You're using those two systems together to find the very highest probability trade setups, and it produces a tremendous win rate. Again, like 90%, 92% on the SPY super system. But again, you've got to be patient. Very important to be patient because you've got to wait for these trades to set up. You can't just be kind of jumping in willy-nilly. All right, and just kind of a last one I wanted to show you again. Here's the SPY. This is on the 5-minute chart. Here we get a compression, a pop out of the box signal. You buy it long, you ride it up, and this goes right to the end of the day. This was late in the day. This was 3 o'clock. This is 4 o'clock. Green across the board, and you stay in that trade that whole way. And here is the same exact trade on the dominator system. Again, you've got buy signals right here coming off this 15 EMA right here. That's kind of a nice spot to get in. Again, this would be a SPY super system. We get the dominator with buy signals. We get the compass system all green. We buy in here. We ride it up, and we get out right here at the end of the day. This is 4 o'clock. This is a SPY super system trade right here, and these can generate a lot of cash when you're buying calls on something like this or puts when it's going down. So that's what the SPY super system is. It is the compass system green coming out of compression, the SPY up for the day with the dark green background, so the multi-time frame trend on the SPY is bullish, and you get buy signals on it, you buy it. That's what it takes, and you just have to wait for those to take effect. We're working on some scans to actually identify those for other stocks as well, but the SPY you can just kind of watch and see when that occurs. And so this is the Compass Alert service. Just kind of go over this. I don't want to take up too much time here. It's 20 minutes of 5 already. So Compass Alert service is normally about $3 grand a year, $29.97, and we have we're selling it for right now for $9.97 a year, or $2.97 a quarter. Now that will give you the alerts on these trades that we put out, coming out by SMS alert, right text to your phone. And for the first 10 people that sign up, you're going to get a month in the live trading room. You'll get a free month in my live trading room, and you can be in there as much or as little as you want to be. That goes every day from about 9:15 till 4. There'll be a masterclass series. You'll get videos, very detailed videos on each one of the indicators on the compass system and the dominator system, how we use the compass system to find the highest probability trade setups, how we find the highest probability trade setups when the compass and dominator align. There'll be videos on basic options trading. There's also one on time spreads over earnings. Another one is on what's called weekly ATMs, which is a calendar spread to bring in premium. So lots and lots of videos. I have one called the funnel, which is basically when you find a trade that you think you want to take, you just run that stock through a funnel method, which is looking at the criteria. And if you put them at the top of the funnel, and if they drop out of the bottom of the funnel with most criteria checked, then it becomes a high probability trade. And you can learn the secret ingredients of my winning trades. And I do have a lot of winning trades, but I'm not going to brag about that. Again, so this is the compass system, the Compass Alert service. Now we also have the compass system we just talked about. and you can buy the Compass system. I bought this as soon as I saw it because it helped me increase my win rate even as a professional trader for 13 years. And this is $9.97 annually for the Compass system. And that gets you, with the first 10 orders, it also gets you a market scanner for a year. There's a scanner built into the Compass system that comes with it. You will get the live trading room access that we just talked about for a month. The trading room is free for a month, then it's a subscription. You can decide whether you want to be in it or not be in it. We also have a Discord room that you would become a member of, which we have 2 other professional traders in there during the day, posting all the trades we take, and also posting charts and answering questions about trades. And again, the masterclass series, you would get that. So that's your investment in the Compass system. Now, if you're interested in the both of them together, which is what I use to find the very highest probability trade setups, that's $14.97 annually, and that's for the Compass and the Dominator. Now, they'll both be installed on your TOS, on your Thinkorswim for the Compass system, and on Ninja for your Dominator system. And the tech support at the right line will take over your machine and put those on for you, get them set up so they look exactly like mine do. Again, if you get them both, you get the same thing we just had on the Compass system. You get the market scanner for a year, you get my live trading room for a month, and then the masterclass series on the videos. Now, one thing with the Dominator, if you have the Dominator, you also have to pay another company called Kinetic for the data feed. The data feed for market internals you can't get anywhere else. So to get the market internals, we have to pay for a data feed. I think it's about $75 a month that I pay for the data feed on Kinetic. But that's how you get that market internals information into the Ninja platform. That's the only way you can get it, and they don't sell it to any other platforms. I can't put it on TOS. I can't put it on any other platforms. It won't go on, Fidelity or Scottrade or any of those. They only allow Ninja to get this. So that's that's your investment on the Compass system and the Dominator system together. If you have any questions about this, and I'm going to answer some questions here in just a minute. If you're interested or think you might be interested, but you don't know if you really are, you want to talk to somebody, just put your name and phone number or Skype username in the chat box. Rory down at the right line will call you. We'll call you one time and just follow up and ask you to answer any questions you might have, tell you about the financing on it, things like that. And again, if you have any questions on it, because I know this was pretty quick and I went over a lot of information, but go ahead and put your name and phone number in there or your Skype username. And Rory's number is 786-732-4656, but he'll call you if you put your name and number in there to do that. So again, there's your investment into Compass system and the Dominator system together, $14.97, $9.97 for the investment in the Compass system, and the Compass Alert Service, again, $9.97 a year and $2.97 a quarter, with the first 10 getting access to the room. The room we call out trades in there. We talk about, we have a lot of people asking us to look at a stock. We post the charts up. We take a look at the technical analysis. We take a look at what it's doing on the Compass system. I mean, all of those things are really important. So that just that covers that. I want to drop this down for just a minute. Let me just drop that down. I want to show you the SPY today. And this is the scanner right here. This is the SPY today. All right. So here's the SPY from this morning. This right here at 11:25. This is when the current time frame momentum went from red to blue. This was a buy signal right here. Notice everything else was green. And you notice that except for this one little yellow box, this thing stayed green all day long. This told you you could stay in this SPY trade right up until here, till 3:20. That was a buy for the whole day on the SPY. And I mean, if you look at the SPY on the daily, this is what you're going to see today on the SPY. This big green candle right here. So I just kind of want you to show that in real time what that looks like. So that's how that system performed today, how we're able to find such good trades, and it's really, really important. I will point out one other thing. We had PXD short today. Now, today was a bullish day, but we had PXD with a put debit spread. This is where we took it this, whoops, we switched to the, you notice the daily was, we had red over here, but let me go to switch in the 5 minute. This is PXD this morning, right here. And this is where we took it at relative weakness. You see the market's gapped up, it's coming down, goes in and out several times during the day, and then it pulls down, and we were able to get 25% beautiful profits on a put debit spread on that. That's one of the methods that we use to trade debit spreads using weekly expirations. All right, so let me just see if there's any questions here. Again, I appreciate everybody taking the time here at the end of the day. Hope I didn't take too much time. Looks like it's been about an hour. And I know I ran through some of these things pretty fast, but I wanted to give you two things. I wanted you to see what the service includes, the alert service, but also how we're finding the trades that we're giving you. I think it's important to understand what the criteria is that we're using to find these trades for you and how we find these highest probability trade setups. And that gives them such a high probability of winning. Okay, so let's take a look at some questions. Let me see here. Let's see, get down to where I started. Okay, a couple questions here. What about WBD? Not sure what that means. Salvatore, thank you very much. Appreciate it. Appreciate the presentation. Yeah, thank you. Is the basis of a system using supply-demand zone trading? Not really. I mean, supply and demand zones are basically looking at as previous activities, and they're looking at orders that are queued up. But what we're really looking at is we're actually looking at the actual orders, because you know, orders that can go in, that's like people that use level twos. Institutions can go in there and spoof this stuff. They can go in and put orders in and pull orders out to basically make it look like there's a lot more orders in than there really are. So we're just looking at the actual multi-time frame information on the trend, the momentum, and the four that I showed you there. So that's how we're finding the institutions, because when those things line up across 3 different time frames, it generally has to be the institutions driving that. Can SPY be used for intraday trading? Absolutely. That's the best way to use it for SPY. Intraday trading, absolutely. You just use it with the compass system and the market internals when they line up. That's what we call a SPY super system. I almost always only trade the SPY intraday. I think somebody said they wanted to see the SPY. I just did show the SPY here just a bit ago. On today's chart, I did that already. Salvatore, again, you're asking about the supply demand zone, also known as demand by wholesale supply. No, it's not. It's looking at the actual selling and buying going on across multiple time frames. The actual selling and buying. In other words, it's actually looking at the selling and buying, not the demand at wholesale or retail. We're just looking across the multiple time frames. It's very difficult to have 3 different time frames going up strongly without institutions driving them. Retail traders don't do that. They don't have the power to do that. Well, what time do I usually post alerts for overnight trades? You know, Martin, usually, sometimes I'll do time spreads, which is something we do overnight. I'll do those. Sometimes I'll do them in the morning, but most of the time I post the overnight trades they're going to be posted after 12, somewhere between 12 and 2 usually. And sometimes I may take a time spread as late as 3 o'clock, but generally afternoon. It depends on when the setups occur. Both of these, Emmanuel, these are both desktop. They're not web-based. I don't like web-based. Web-based is just too slow. You know, when you're dealing here with trading in a real-time environment, it's really important to have your information on your PC being displayed in real time. If you're looking at that coming across, you know, if you're waiting on that software out on the web, it's just not, you're not going to get the kind of response that you need. It's going to lag too much. Hey, Gart, how you doing, sir? Appreciate it. Yeah, you're in the room. I appreciate it, Gary. Thank you very much. Richard, I think Rory will probably take care of that for you. Get your number in there, perfect. He'll call you and he'll go over that with you. Compass Alert will circumvent having to get the other two desktop systems. Well, Salvatore, if you get the alert service, you're not really looking at the chart. You're depending on me to send out the alerts to you. So the alert service is those trades are being generated by my looking at the Compass system, the Dominator system, and some scans and support resistance levels, all those things to put out the alerts. So to get the alerts, you don't have to have the systems. But a lot of people like to get the alerts and or be on those systems. In other words, they want to trade themselves, and they want to be able to use these systems because these systems are so effective. They want to be able to make their own trades and find their own trades because I can't see everything. You know, if you've got the systems, Compass and or Compass Dominator, you're going to have the ability to use those systems to find the trade yourself. Richard, thank you very much. What are the 3 time frames? Well, the 3 time frames, Emmanuel, when I'm up on the 5, I've got the 5, the 15, and the 45 is what the Compass system is looking at. If I'm on a daily chart, I'm looking at the 1 day, the 3 day, and the 9 day. All right, so it's looking at 3 times whatever your original is. So it's looking at 1, 3, and 9 on the daily, 5, 15, and 45 on the 5, and you can extrapolate to any other time frame that you want. Salvatore, you know, you want to check with Rory about that, but I suspect so. In other words, if you buy the Compass system at $997, I believe you'll be able to buy it each year for $997. I think you can check with Rory to be sure, but I would say pretty precisely that you'll once you pay for it, you'll be grandfathered in for your subscription rollover each year. Ron, if you subscribe to my room, we don't need the alerts. No, you don't. You don't need the alerts if you subscribe to my room. The thing is, you have to be in the you know if you're in the room, you're going to see them, obviously. But if you're not in the room and you'd like to get the alerts, that's important. It really depends on you know how long you can trade, how much you like to trade, where you're going to be. You know, it's all dependent upon your own kind of on your own personal preference. How much alerts do I put out each day? Typically, I'm not going to put out a lot on a day because we're only looking for the highest probability trade setups. You know, 2 or 3 a day would be max. And a lot of days they're on any, but you know, there's typically, I think this week I put out, I'm trying to think, maybe 6 or 7 trade alerts. Yes, Salvatore, just check with Rory, but I would say that, yeah, if you subscribe, you can resubscribe, you know, for the same amount. I don't think it. In other words, are they going to increase the price if you're already a subscriber? I would say no. Can you get the live room on your own? You can get the live room on your own. The live room is $149 a month for just the room. You can take advantage of that. What is the win percentage in trades alerts? Well, it's about, listen, it goes up and down from month to month, but typically on the trade alerts we've got right now, it's about 88%, 89% on the trade alerts. That's what you can figure that you're going to get between 8 and 9 out of 10 will be winners. I mean, and this is over a period of time. You're obviously going to have times where you get a few losers. We've had, in the room, we've had 18 winners in a row, but you're going to obviously have losers. You take a trade and some news comes out against the stock, there's not much you can do about it. All right, it's getting pretty late here. It's about 5 minutes to 5, so I probably need to wrap it up. I appreciate everybody with the questions and the comments. And on what time frames do I recommend analyze the trade alerts? What I do is, this is how I look at my trades. When I find a stock that I think I might be interested in trading a prospect, first I look at the daily chart. And I want if it's going to be a long trade, for example, I want the daily chart to be bullish. I don't want to trade something long that has a bearish daily chart. So I want the daily chart to line up. Then if I take the trade on a 5-minute, it's got to be bullish on the 5-minute. Now I've got them lined up together. That gives me the ability to stay in the trade a little longer and take it overnight if I need to. Salvatore, thanks very much. Appreciate it very much. Thank you. Okay, I think that's about it for me. I will wrap it up.
Thank you very much, David Wyse. Thank you. That SPY Super system looks amazing. And 18 winners in a row. Incredible. Ladies and gentlemen, whether you just want David's trade alerts with a greater than 89% win rate sent directly to your mobile device, or if you want the entire trading system running on your computer, Mr. David Wyse over at Right Line Trading has put the links for each one of those offers in the chat box. And we have run out of time today. It's wow. It's really been a great event filled with a massive amount of great information, a very talented panel that we had. If you have any questions for David, just type your name or phone number in the question box. You could call Right Line Trading at 786-732-4656. We will make sure that David receives your information. I want to thank you again, David. Incredible numbers.
Thanks very much, everybody. Appreciate it. Everybody have a great week, a great weekend coming up in one more day.
Thank you. And that concludes our presentation for today, ladies and gentlemen. We're going to be clipping the recordings and posting them to our YouTube channel. And we'll be sending all of the attendees, all of the registrants, a follow-up email with our YouTube channel included. I want to thank you again for joining us today. Have a blessed evening, everybody. So long.